Friends, welcome to the channel JIV and CIV Made Simple. Are you preparing for upcoming CTP examination and looking for a single source of material from where you can pass the examination? Look no further, you are at the right place. In this particular video, we are going to discuss 350 plus MCQs of the Certified Treasury Professional examination, and these MCQs are those which have appeared in the recent 1 year examination in the last 2025 and 2026. So you can go through the entire video, and it includes both numerical as well as theoretical question, and I will explain each and every option so that you get the logic behind each and every question. If you want PDF, if you want the question in the PDF format for practice purpose, then you can WhatsApp me on the number shown on the screen for more detail. So in this particular, watch the video till the end, and if you want to watch the video of a particular segment, you can check out the link in the description section. So let's get started about our video with very first
capital 800 crore, tier 2 capital 400 crore. Obviously if you add both of them, total capital will be how much? That will be 1200 crore, right? Now what happened in the forex department, that the bank has three position, right? These three position the bank hold. A spot position plus $50 million long, forward position minus $30 million short, and then we have the delta based position, or that we call option position. How much is that? $10 million long. Now also they have mentioned, given the exchange rate is $1 is equal to 80 rupees. Now we have been asked to find the NOP in rupee terms, that is net open position. NOP means what? NOP means net open position. In terms of rupee, how much it will be? And the second part is whether this position is within the RBI limit or not. So this is a very good question regarding the net open limit overnight position. So whether, first of all, you have to decide what is the limit, and then you have to tell that whether it is under the RBI limit or not. Option they have given A, B, C and D, right? 2400 crore, right, within the limit, exceed the limit. So these are the options. Now just pause the video, think about it, think about the answer. Now let me explain how to go about solving this problem. So tier 1 capital, tier 2 capital, spot position, forward position, net open position, these data they have provided you. Now friends, see, basically first of all, what should we do? We should compute the net open position. We should compute it, net open position in terms of dollar. How to go about computing it? Very simple. Net means what? You take the spot position, you take the forward position, you take the option, you add all of them, that will give you net open position. So how much is the spot position? I think they have given $50 million. Forward is minus 30 and net option is 10. So 50 minus 30 plus 10. So 50 minus 30 plus 10. That is $30 million, and it is net long. It is net long position, right? So bank is long $30 million. Now what we need to do? This is the net open position just we have computed. Now we need to convert this dollar into rupee, because we have been asked in rupees terms. That will be how much? $30 million multiplied by 80. So that will be 2400 million rupees. That is our answer. That is our position limit. Okay. So 2400 million. Now one more thing, most of the students get confused. That sir, is it 240 crore or 2? You know it very well that 1 crore, it means 10 million. Suppose if you want to convert into crore, because if you see the option, they have given in terms of crore. You can see now they have given in terms of crore. So if you calculate in terms of crore, that will be how much? 2400 divided by 10, which is equal to how much? 240 crores, isn't it? 240 crore. So that is the correct position, 240 crore. In option, I think they have made a mistake. There should be 240 somewhere, right? They have given 2400 crore. That's completely wrong. Now the second part of the question, what is NOPL? Let's compute the NOPL. So as per the standard RBI market risk practice, you know it very well that the maximum NOPL is equal to 25% of total capital. This is the thing that you have to keep in the mind. Sir, what is the total capital? Just now we have computed. Tier 1 capital is, I think, 800 crore. Tier 2 is 400 crore. Add both of them, that become 1200 crore. So 1200 crore is the total capital. So you just compute 25% of 1200 crore. That means 1/4 of 1200 crore, which is equal to how much? I think 300 crore. Right. So that is the NOPL limit. That is how much? 300 crore. Now you compare the position versus limit. On one side we have position, right? On one side we have position, on other side we have limit. Sir, position we have just computed, which is 240 crore, isn't it? Open position we have computed is 240 crore and the limit is 300 crore. So you can see it is within the limit. The position is within the limit. So yes, correct answer will be option number A. See what I'm doing, I'm just changing the values. I think in by mistake they have given 2400, it is 240 crore and within the limit. Yes, A is the correct one. Okay, so I hope this question is crystal clear. Now if any such question is asked regarding calculation of the net overnight open position limit or something like that, you can easily answer. So remember, what is the trick for FX open position? So how to compute the FX position? You remembered it as FO. So add spot, add forward, and then add option. Same currency, add algebraically, and long will be added, so short will be subtracted. I hope it is crystal clear. Spot, forward, and option. And always convert million to crore very carefully. That means 10 million is equal to 1 crore, and NOPL is 25%. The limit is 25% of total capital, and total capital includes two things: tier 1 and tier 2 capital, right? And if the open position if the open position is within the limit, in that particular case you say that they are following the RBI prescribed guideline. Is it clear? I hope it is crystal clear. Now let's focus on the question number 2. I think this was the easiest one, but you should know all these things that are required. Now very good question they have provided, that basically the question tells us that interest rate difference between two securities. On one hand we have 10-year government security, on other hand we have 2-year government security, and the interest rate difference also we can call it spread. Either you call it spread or you call it interest rate difference. Okay, so they have changed over 6 months. Over a 6-month period they have changed. Earlier it used to be 150 bps, now it become minus 20 bps. So now the question is asking you to identify what happened to the yield curve. What happened to the yield curve and what this change tells us about the economic sentiments. These are the two parts of the question. First part, it is asking what will be the impact on the yield curve, and the second part they are asking that what this change tells us about the sentiment. What it tells us about the sentiments. That's the question. So friends, before continuing further, let me introduce you to our CTP comprehensive course, which includes PDF, videos, mock test. As you can see, I have separated them. I have put them in separate folder. There are almost 8 previous year questions in the form of PDF, which cover all the question paper which have appeared in the 2025 examination. In addition to that, we provide you capsule content for fast revision, for quick revision of the entire syllabus. Further, you get mock test and quizzes for practice purpose. You can practice as per your convenience. In addition to that, we have PDF for theories and MCQs covering all the 5 modules. There is a separate theory PDF, separate MCQs PDF. Not only that, we provide you unit wise videos also. You can check out, there is a videos also which I have added for module A, B, C, right? So this will help you gain the conceptual insight. So all these things you are getting at a very nominal price. You can check out the link in the description section, or personally WhatsApp me on the number shown on the screen to get more detail related to it. So whenever I say this term spread, it means what? Long-term yield minus short-term yield. Long-term yield minus short-term yield. This difference is called spread. Now, if you look at this particular case, earlier long-term is 10-year government security. Short-term is 2-year government security. So first of all, understand the situation. That plus initial the spread was 150 bps. This means 10-year yield is much higher than 2-year yield. Okay. So this is called the normal. See, earlier if we talk about this 150 bps, what's the meaning of it? When I say that spread was 150 bps, it clearly means that 10-year yield is very higher than the 2-year yield, isn't it? Then only you will get this much. This is called normal or upward sloping yield curve. Either you call it normal or you call it upward sloping yield curve. It indicates growing economy, higher future inflation. Investor want higher return for the long-term money. Now understand the final situation. Finally, we have 20 bps, minus 20 bps. So it indicates a negative spread. It indicates what? It indicates a negative spread, right? So this means what? 10-year yield is much lower than the 2-year yield, isn't it? It's not lower, not much lower, lot lower. So that's called, inverted yield curve. So earlier in this case, it is a normal or upward yield curve because it indicates a growing economy. It indicates higher future inflation. That's why 10-year yield is 10-year yield is much higher than the 2-year yield. So higher future inflation. But in the second case, as 10-year yield is less than 2-year yield, it indicates what? It indicates inverted yield curve. It indicates inverted yield curve. It simply means that market expect future interest rate cut. What market is expecting? Market is expecting that in future interest rate is going to decrease. And what investor is expecting? Investor is expecting economic slowdown. Yes, investor is expecting slowdown or recession, to be more precise. So investors are happy to lock money for long term even at lower return, isn't it? So even at lower return, they are happy to lock money. Why? Because they are expecting economic slowdown or recession. So now let's interpret the transition. What happened to the yield curve? That is what we are looking at. See, earlier the yield curve was normal, which is indicated by the positive 150 bps. This is a normal case. Now it become yield curve become inverted. Why? Because the spread become minus 20 bps. So this clearly signal what? It signal the negative economic expectation, isn't it? It signal negative economic expectation. So what will be the final answer? Let's come back to the question. Option A, they have given it curve is steepening, indicating expectation of aggressive economic expansion. No, that's wrong. They're talking about steepening. See, steepening means your spread is increasing. Think about it. So by looking at the spread, you can decide what is the nature of the yield curve. If it is steepening, it means our spread is increasing, but here spread has decreased. So A is wrong. If you look at the option B, the curve has moved from normal to inverted, suggesting that investors expect a future economic slowdown. Exactly. B is correct. C says humped curve. See, humped curve need medium term rate. When I say humped curve, it means what? It means medium term rate, like 5 year, higher than the short and long. So no such data have been given. What about D? It says flattening but normal. See, negative spread means curve is already inverted. It cannot be normal. So what we learned from the discussion is that, let me just summarize what we learned. If it is normal, it means positive. If it is inverted, it means negative. And if it is positive spread, it means economy is doing well. And if it is negative spread, it means trouble ahead. Fine. So spread minus हुआ तो mood down हो गया, ऐसे समझिए. So what we learned from the discussion, we talked about the spread, how to go about calculating the spread. That is the long term yield minus short term yield. Spread is this, long term yield minus short term yield. And then we discuss if it is positive spread. If it is positive spread, it means normal curve. If it is negative spread, it is inverted curve. If it is inverted curve, it indicates the signal of recession. I hope it is crystal clear. Now friends, let's have a look at the next question that they have provided. The next question pertains to this one is. So what it is all about? See, this question is asking you that there is a corporate treasurer. He hold a Bermuda style receiver swaption. Yeah, this question is about the Bermuda option. So there is a corporate treasurer who hold a Bermuda style receiver swaption. Total tenure they have given 5 years, and exercise which are allowed on the last business day of every month. Specify that option can be exercised on the last business day of every month, starting after year 2 up to the final expiry. So we have to identify which type of option this is and how its flexibility and premium compared with European and American option. So basically this question rotates about the Bermuda style option. Total tenure they have given, and the contract specify that it can be exercised on the last business day of every month. Now option A, it can be exercised anytime. It may be more flexible. It offers discrete exercise date, and last it can only be exercised on the final expiration date. Very good question. So the moment you see this Bermuda style, stop and recall. So what is this Bermuda style option? So the moment you see this Bermuda style option, think about it. This is a kind of middle ground. This is a kind of middle ground between European and American option. On one side you have European option, other side you have American option, and this act like a middle ground. See, Whenever I talk about European option, think about it like this. If we talk about the European option, it means on final date. And that means expiry date. You can exercise it on the expiry date. If we talk about the American option, so American option means it can be exercised any time. It can be exercised any time till expiry. Okay. And if you have Bermuda means what, you know? Bermuda means on a specific prefix date. On a specific prefix date. Okay, so please remember this. A European option means you can exercise on the final date. American means any time till expiry. And third is Bermuda means on a specific prefix date. Now in this question, the option can be exercised monthly. They have given the option can be exercised monthly on the last business day from the end of year to till maturity, but not on any random day. So what I mean to say, in this particular question, the option can be exercised monthly. You can exercise it monthly. Okay, you can do that. The option can be exercised from the end of the year 2 till the expiry. On the last business day, it can also be exercised, but it cannot be exercised on any random day. Right? So it cannot be exercised on any random day. Please note it down. So that means what I mean to say, that exercise is not continuous. Please understand. Exercise is not continuous. This exercise is not continuous, so not American. So they are not American option. Exercise is not only at the final date. Yes. Since it is not at the final date, so it is not an European. If it is at the final date, then it is European. This is not a European. So this perfectly matches a Bermuda. Yeah. Exercise can be on the last business day. Right. So obviously it is a Bermuda. So the final answer is option C. It offers a discrete exercise date, right, making it premium, generally higher than its European option but lower than American option. So European option is least flexible. So now if we talk in terms of money, right, think about it. Golden rule for option is that if you offer more flexibility, if suppose some option is there which is offering more flexibility, it means it will have higher premium. Obviously in the case of option, you know, you have to pay the premium. So more flexibility, higher premium. Now can you tell me, out of European, American, or this Swaption or this Bermuda, which one will have higher premium? Think about it. If you look at the European, you're not getting any flexibility, right? You have to exercise only at the end date. So since least flexibility, so that's why they are the cheapest one. Now if you talk about the Bermuda, which is like a middle ground between these two, right, some flexibility it offer, so it is mid price. But if you talk about the American, it is a type of continuous. You can exercise it anytime. So it's offering you most flexibility. And since it is offering you most flexibility, so yes, they are costly. So Bermuda option is more expensive than European and cheaper than American. Right? I hope it is crystal clear. So option A says that it can be exercised at any time. No. It describe American option. Bermuda has a fixed date only. Option number B says that more flexible than American. No, American has the maximum flexibility. This statement is illogical. D says that it is exercised only on the final expiration date. That's European option. So remember, you can think of it like this. First of all, Europe, then Bermuda, and then America. This is a way to remember it. Just to be. So Europe means one date, annual expiry. Bermuda means few fixed date. You can exercise it. And American means any time. I hope it is crystal clear. Now friends, let's switch our focus to the next question that they have provided. So it is just on your screen. If you think that this video is adding value to your preparation, don't forget to hit the like button. Do hit the like button. So this is the table which summarizes every aspect of it. Now very good question we have. So what is happening here? This is about the treasury arbitrage, and we will learn practically how it works. So basically an Indian bank is there and they have surplus of 100 crore and for a period of 30 days. Fine. Surplus of 100 crore for 30 days. Now treasury has two choice. Option A, domestic lending, which says that you should invest in MIBOR. Annualized return is 6.5%. Option B say arbitrage. That's called FX arbitrage route. That means convert INR to dollar at a spot rate and invest dollar in the New York money market at this rate and cover exchange rate by selling 30-day by selling US forward at this rate. Matlab, this is called arbitrage, right? So we must decide. Now the question is asking you, we must decide which option give a higher return. So two options they have given: normal domestic option. Option B is the arbitrage option, which is giving you higher yield, higher return. And what is the gain? That these are the two part. Option A say yes, A is giving and gain is 0.5. B is giving, gain is 0.5. P is giving, gain is 7. A is giving, gain is 6.5. So very good question. So if you look at the option number A, that is a domestic return. Now it is quite straightforward. They have clearly mentioned that option A return is having 6.5. This is our comparison base. Yes, we are comparing with respect to what? 6.50. Now understand the forex foreign exchange arbitrage logic. Very important. See what happened. Let me explain it here. We are talking about arbitrage option with respect to the forex. Think about it. See what happened, when money is sent abroad. So you have money. What you have done? You have sent abroad. Why you have sent abroad? With full hedge. You have sent abroad with full hedge. So total return come from two components. So you have sent money for full hedge. Total return that you are getting, there are two components of it. What are the two components? The first one is the overseas interest rate. And the second thing is the forward premium. These are the two components. You have sent money abroad for hedge purpose with full hedge. Total return has two components: overseas interest rate and forward premium. And this forward premium is annualized. Why? Because this overseas interest rate is the earning on dollar investment. This is your earning. Earning on what? Earning on dollar investment. And this forward premium, this is gain from selling dollar forward at higher rate. This is the gain. Why you gain? Because you have sold dollar forward at a higher rate. Now exchange rate, what happened to the exchange rate? It is fully covered. Now exchange rate is fully covered. So both return are additive. Right. Now let's compute the total forex exchange return as per the option B. If you look at the option B, that is arbitrage, you have dollar interest rate how much? I think they have given dollar interest rate how much? 4.25%. Yeah, this is one. And forward premium how much? 2.75%. So if you add both of them, total return become how much? 4.25 plus 2.75. You may ask me, sir, why we have added? Because exchange rate is fully covered. Risk you have covered, right? You there is hedging you have done already done. So since risk you have covered, so just add both of them. That will give you 7% per annum. And this 7% per annum, this is annualized. So yes, option B gives annualized 7%. Now let's compute the arbitrage gain. Yes. So how to compute the arbitrage gain? How much we gain from arbitrage? So to compute the gain, what we need to do? We need to compare the return from both the option. Return at the rate B minus return at the rate A. What are A and B? A and B are the options that are available. So if you look at the return at the rate option B, we got 7%. Return at the rate option A, we got 6.50%. If you subtract both of them, that this is the annualized yield, that's 0.50%. So obviously the moral learning is that foreign exchange arbitrage give higher return. If you look at the option that they have provided, option A says A is giving you higher return, and no, A should not be selected because it is giving you lower return. A is wrong. C says option B is the correct one. Yes. C says 7% is the total FX return. No, that's not the gain. So remember, what we learned from the discussion is that there is a simple thumb rule for treasury arbitrage. What is the thumb rule? The thumb rule says that if you have fully hedged the foreign exchange, this is the very important thing to note. If you have fully hedged the foreign exchange, then just add both of them. Foreign interest rate plus premium, which means dollar कमाओ और premium लो, यही आपका forex return होगा. And domestic benchmark is linked to MIBOR. Forex arbitrage rate is the sum of overseas interest rate plus forward premium. And forward premium is the extra return. These are not the cost. Compare total return, not individual component. Okay. I hope it is crystal clear how to go about computing the arbitrage and how to decide which option to choose. Now, a very good question which is asked every time. And this is similar thing which I've been asking. Like basically the role of the front, back on mid office. Here, what is happening, front office dealer of an Indian bank has just completed a dollar INR spot trade worth $10 million. Fine. Now the question asks, after the deal is done, what is the front office role and what is the back office role for the same transaction? Because front office has concluded the $10 million spot dollar INR rate. Yes, they have done it. Now option A, they have given that front office negotiate the rate, back office generate the deal ticket and calculate the profit. B says that front office finalize the deal, back office handle the independent confirmation. C says that front office settle the fund via SWIFT, back office reconcile the nostro account. D says that front office authorize the limit, back office market the product to the corporate client. Very good question. So before answering this question, I request you to please pause the video, think about it. Now let me explain how to go about solving this question. You know, the treasury, this is the very basic thing to note is that treasury work on the segregation of the duties. Treasury work on the segregation of the duties. One person should never deal, should never confirm, should never settle the same transaction. That's why we have the front office. That's why we have the mid office. That's why we have the back office. Now, if you look at the front office, I think you know it very well that front office are the deal maker. They make the deal. Their job is to watch the market. They watch the market. They talk to counterparty. They negotiate and finalize the rate, and they execute the trade. So once the deal is done, now suppose the deal done, they generate a deal ticket. Yes, deal ticket they generate, and their role in the specific transaction end. They are not allowed to confirm or settle the deal. Now comes the role of back office, which is very much critical. So, you know, they are checker. They are called checker. Front office is called maker, deal maker. The BBO is called checker. Like in the bank, we have concept of maker and checker. Similarly, in the treasury also, front office is the maker, deal maker, and back office is the checker. Checker, or we can also call it the settler. Both are the same. So their responsibility, they independently confirm the deal with the counterparty. Yes, they will confirm that too independently. The deal with the counterparty. They will handle the fund settlement. Settlement handling is their role, and they send payment message. Payment message is sent via SWIFT or RTGS, and they handle the accounting error. So this separation prevent fraud, unauthorized transfer. Now if you look at the option that they have provided, A says that negotiate the rate, generate the deal ticket and calculate the profit. What do you think? No, that's wrong. Why it is wrong? Because profit and loss is mainly the calculating the profit and loss. This is the mid office role, not the front office role. Please note it down. Now if you look at and deal ticket is made by the front office, not the back office. A is wrong. What about B? B says front office finalize the deal, back office handle the independent and confirmation. Correct. C says that front office settle the fund. No. Settlement is done by the back office, right? And so that's why this is wrong. And D says that I think management. See, front office authorize the limit. No. All these limits are set by the management, or management you call it, or you call it the mid office. Limit has been set by them. So you can remember it like this. There is a trick which I have prepared. So dealer deal, checker check, and settler settle. So front office deals with the trade. In simple word, if just one line, if you want to remember it, and this question is sure short ask every time. So front office ट्रेड, या ऐसे याद रख सकते हैं कि डीलर फ्रंट का है, पैसा बैक का है. फ्रंट ऑफिस ट्रेड, मिड ऑफिस it deals with risk and profit and loss, and back office, you know, they do the confirmation and the settlement aspect. I hope this question is crystal clear now. Now let's look at the next question that they have provided. So yes, they're talking about the role of the, this particular table clearly lists all these things. Now, which of the following combination of statement accurately reflect the regulatory and operational guideline for the certificate of deposit in India? So basically the question give you 5 statements related to certificate of deposit and ask which combination is correct. So statement 1, they have given that CD can be issued by SCB, a scheduled commercial bank, and selected AIFI. B says that the minimum amount of CD shall be 5 lakh and multiple of 5 lakh thereafter. C says that the maturity period of CD issued by bank should not be less than 7 days and not more than 1 year. D says that state banks are allowed to buy back their own CD after a minimum period of 30 days from the date of issue. And last option, CD is issued at a discount to the face value and are freely transferable in dematerialized format. These are the 5 options they have given, and you have to select the correct option. Like 1, 3 and 5, 2, 3 and 1, 2, 3 and 5, 2, 4 and 5, all of the above. So now let's discuss the statement by statement. If you look at the statement number 1, which says that CDs can be issued by the scheduled commercial bank. What do you think about it? So let me tell you the basic thing to remember about the certificate of deposit. Remember, a certificate of deposit can be issued by a scheduled commercial bank, can be issued by AIFI, permitted by RBI. What are the example of AIFI? Yes, NABARD can be AIFI, right? SIDBI can be AIFI, and Exim Bank is also AIFI if permitted. So yes, statement number 1 is perfectly correct. Now 2, that's talking about the minimum size of CD. Yes, correct. I think this is also correct because the minimum is 5 lakh and further issuance only in multiple of 5 lakh. Yes, it is also correct. What about 3? Maturity period. Yes, remember for bank the minimum tenure is 7 days and maximum tenure is 1 year. So that is lasting from 7 days to 1 year. For AIFI, the tenure can be longer. It can go from 1 year to 3 years. So depending on whether the issuing institution is a bank or AIFI, the tenure varies, right? And this statement is specifically for bank. They have mentioned clearly bank. Yes, correct. What about 4? Buyback. Yeah. So remember, it's talking about the buyback. So basically, RBI law. Yes, RBI say that okay, you can buy back the CD. The CD you have issued, you can buy back them later. But the minimum lock-in period is how much? Minimum lock-in period is 7 days, not 30 days. The number 30 days is a trap to confuse the student. So that's why statement number 4 is wrong. And statement number 5 says that CD are issued at discount to the face value. Correct. They are issued at discount, redeemable at the face value. And since 2002, CD must be issued in dematerialized format, freely transferable. So yes, option number 5 is also correct. So what we learned from this discussion is that 1, 2, 3 and 5 are correct. Okay. 1, 2, 3 and 5. B is correct. So you can remember the code rule like this: 5 lakh, 7 days buyback, 1 year maximum maturity, discount, and demat. Yes, remember this line, and this summarize the CD. Friends, right. So question number 1 we have already done. Now question number 2 is on your screen. So question 2 is regarding the banker's acceptance. Which of the following statement most accurately define a banker acceptance within the context of the international trade and short-term money market? Option they have given: it is immediate demand draft payable by the importer bank upon the presentation of the shipping document. It is a method of self-financing where the bank retains the legal title to the good until the buyer completes the final payment. It is a time draft drawn on and accepted by a bank representing unconditional obligation of that bank to pay a specified sum. It is a revolving credit agreement provided by central bank to ensure commercial bank maintain adequate daily liquidity. So let me give you a simple example to make this banker's acceptance crystal clear. So imagine you are selling a massive shipment of spices to a buyer in another country. This is you, and what you are doing, you are selling massive shipment of spices to where? To a buyer in another country. The buyer say, I will pay you in 90 days. Buyer say that I will pay you in 90 days. Fine. You don't know this buyer very well. What if their business goes under before day 90? You would be completely out of luck. Now imagine the buyer bring their rich, highly reputable uncle. Yeah, buyer bring their rich, highly reputable uncle into the deal. The uncle who happened to be the major global bank. Yeah, this uncle is what? It happened to be, global major bank, right? He enter into that particular bank, enter into the deal, right? He takes the 90-day IOU, stamp it, sign his name across it. So what uncle did, he take the 90 days IOU and then he stamp it and take the risk, right? By doing so, uncle is saying, I personally guarantee this money will be paid in 90 days, no matter what is happening to my nephew. Suddenly, you are not worrying about the buyer ability to pay. You are relying on the bank deep protect because you are relying on it, because he has signed, because he has stamped, right? You are relying on the on bank's deep pocket. So this signed IOU is called basically banker's acceptance. The bank has literally accepted the responsibility to pay the bill at a future date, right? This signed IOU is called banker acceptance, and bank has literally accepted the responsibility, right, to pay the bill at a future date.
It takes the risk away from the exporter and puts it squarely on the bank's shoulder. So if you look at the option that they have provided, so it is an immediate demand draft, it is a method of self-financing, it is a time draft drawn on accepted by the bank, it is revolving credit. The correct answer is option number C, right? So here is exactly why other are wrong. Option number A talks about immediate demand draft. So bankers acceptance are always about the future payment, not immediate one. Option A is wrong. B describes something more like an auto loan or lease where the lender hold the title to your car until you pay it off. Yeah, this is not the correct answer. If you look at the option D, they describe central bank lending tool used to keep bank afloat with daily cash, which is completely unrelated to the international trade finance. So yes, whenever you see this banker acceptance on the exam, think of the letter B. I'm just giving you a trick to remember this. You can think of the letter BA and the word time. Remember, BA means what? BA means bank autograph. Bank autograph. So whenever the bank put it autograph on a time draft, right? On a time draft. Okay, they are locking in the future payment. Just picture a banker signing an IOU with a giant ticking clock next to them. If you see the word time draft unconditional obligation, you have found your right answer. And that is nothing but, banker's acceptance. Now, friends, let's look at the next question we have. Which of the following infrastructure of Indian financial system, right? Within the infrastructure of the Indian financial system, which of the following statement most describe the role and structure of the infinite? Option A. It is an open access payment gateway developed by NPCI specifically to process retail UPI and RuPay transaction. Option B. It is closed user group communication network operated by IDRBT that serve as a secure backbone for critical national payment system like RTGS. Option C. It is Reserve Bank of India internal code CBS core banking solution used exclusively for managing sovereign government account. Option D. It is a cross-border financing messaging system established as an alternative to SWIFT for Asian nation. These are the four options they have provided. So now let me break it down in the layman terms. So think about the regular internet like a massive public highway. You can think of them like a massive public highway, right? Anyone can drive on it. Okay, so you can think of the regular internet as a massive public highway. Anyone can drive on it. You, me, business, and unfortunately even hackers and thieves, they can also drive on it. Now imagine you need to transport billions of dollars between bank every single day. This is bank 1, this is bank 2, and you have to transport what billions of dollars. You have to transport billions of dollars between bank every single day. You would not want those digital armed truck driving on the public highway, right? There is too much risk. Instead, you would build a secret underground VIP tunnel. What you will do? You will build a secret underground VIP tunnel, right? Just for the bank. No regular card allowed. You would build a VIP tunnel for the bank. No regular card allowed. Because you have to transport if you think about you can think of regular internet like a public highway. Anyone can drive on it, right? But suppose you have to transport billions of dollars between bank every single day, so you will build a VIP tunnel. In the Indian banking system, this VIP tunnel is called the infinite. Yeah, in the Indian banking system, this VIP tunnel is called the infinite. It stands for the Indian Financial Network. What's the full form? Indian Financial Network, right? It is a closed user group. The point is that this is a closed user group, right? So which simply means it is an exclusive invite only club for the banks. So when you send a massive amount of money using RTGS or NEFT, the bank uses this highly secure private tunnel to talk to each other safely. So what is the correct answer to this question? The correct answer to this question is option number B. Closed user group communication network operated by IDRBT serve as a backbone, right? Now let's look at the other option they have provided. Option A talks about the UPI and NPCI, and RuPay, which run on a public facing network built by NPCI for everyday retail user, not the secret bank tunnel. If you look at the option C, it is wrong because Infinite is a massive network connecting all the banks, not just internal accounting software for RBI. It is used for connecting all the banks. C is wrong. What about D? D is also wrong because infinite is strictly for, it says that infinite is for no, cross border, no, it is actually for domestic use within India, not an international alternative to SWIFT. So option number B is the correct answer. So friends, to lock this into your brain, just look at the name Infinite, right? When you see infinite, right, it literally stands for, India Financial Network. When you see the word infinite, picture an exclusive, highly secure network where only bank have the Wi-Fi password. It is a closed club for a heavy lifter. It is a closed club for heavy lifter like RTGS or NEFT, right? If the answer say closed user group, whenever you see this word closed user group, right, and secure backbone, you have found the VIP tunnel, and that VIP tunnel is nothing but, now friends, before moving to the next question, let me introduce you to our comprehensive course of CTP. If you are looking for one stop solution for the entire CTP examination, which includes videos, PDF, mock test in English, right, you can check out our course. In this particular course you get mock test, which is, which is unit wise, module wise, available. Along with that you get videos explanation of each and every concept, and each module have a separate videos, unit wise videos available. Each videos will hardly take 1 hour to clarify the concept, along with separate numerical practices videos, because numerical account for almost 30 to 40% of your examination. In addition to that, we provide you PDF you can take download also, right? Module wise PDFs are available. Inside each module you will get unit wise PDF, you will get separate theory PDF, separate MCQs PDF, right? So this will entirely help you in your upcoming examination. And not only that, we provide you capsule content also for the final revision. So the entire set you can get. Just WhatsApp me on the number shown on the screen, or you can check out the link in the description section to get more detail regarding the course. Friends, now let's shift our focus to the next question that we have. This is regarding the option pricing model. Let's talk about the option pricing model. The question is, in the context of the standard Black-Scholes-Maton option pricing model, which of the following statement most accurately describe the principle of risk neutral valuation? Option A says that it assumes that all the market participants are inherently indifferent to risk. B says that it implies that the expected return of the underlying asset is mathematically irrelevant to the option current pricing. C says that it eliminates the need to estimate the implied volatility of the underlying asset. D says that it requires that the option can only be exercised at expiration, neutralizing early assignment risk. These are the four options that they have provided. So we have to answer the correct question. So to answer this question, let me introduce you to a very important concept. Imagine that you are at casino. Where you are at the casino. Fine. Usually, if you play a high risk game, suppose if you play a high risk game, so you will demand a high potential reward, isn't it? You will demand a high potential reward. But what if you found a mathematical loophole? Suppose you found a mathematical loophole, right? What if you could place a bet on both red and black at the same time? You could place bet on red and black at the same time, right? Balancing them perfectly, so you are guaranteed not to lose a single penny, not to lose a single penny, because your risk is perfectly balanced. This is right. Your risk is perfectly balanced at the rate 0, right? You are not gambling anyone anymore. You are not gambling, right? Your return would not just be a baseline guaranteed amount like earning interest in a regular saving account, right? Your return would be just be a baseline. So see what I'm telling you. What if you could place bet on both red and black at the same time, balancing them perfectly, so you are guaranteed not to lose a single penny, because your risk is perfectly balanced. In such case, your risk is perfectly balanced, right, at 0. So you are not gambling anymore. Your return would be just a baseline, right? That would be your return. Guaranteed amount like earning interest in a regular saving account. In the financial world, the Black-Scholes-Maton model figure out how to do this perfectly balanced bet. Yeah, this call, Black-Scholes-Maton, right? This model, they figure out how to do this perfectly balanced, right, bet. This called perfectly balanced bet with stock and option, right? With what kind of instrument? Stock and options, because they can magically hedge away all the risk. It absolutely does not matter how wildly profitable the underlying stock might be in the future. The stock expected return become totally useless for our pricing math. Yes, the stock expected return, it becomes useless. Expected return has no use, right? So instead, what we do, because we have engineered a risk-free scenario, we just use the safe, boring, risk-free interest rate to figure out the option pricing today. What we use? Risk-free interest rate. Yeah, we use the boring risk-free interest rate to figure out the option price today. Our objective is to figure out the option price today right? We price it as if the world is totally neutral to the risk. Our main objective is to find the option pricing. We price it as if the world is totally neutral to the risk. So if you look at the option that they have provided, the correct answer to this question is option number B. It implied that expected return of underlying asset is mathematically irrelevant to the option current price, allowing cash flow to be discounted at the risk free rate. If you look at the option number A, it is a trap. It says real people don't care about the risk. Market participants are inherently different to the risk. But in the real world, investors definitely care about the risk. Risk neutral is just a math trick, not a human psychology. If you look at the option number C, it says that it is horribly wrong because volatility is actually the most critical ingredient in the black skull recipe. It says that it eliminates the volatility. No, 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 that's wrong. Option number D, if you look at it, describe a European option. European option that can be exercised at the very end, which is the rule of the standard model, but is not what the phrase risk neutral, risk neutral valuation means. That's wrong. So to remember this for the examination, think of the car sitting in neutral. Yeah. So if you want to remember this black skull Morton Matter model, you can think of the car which is sitting in a neutral mode. When your car is shifted to neutral, you can stomp on the gas pedal all you want, right? You can stomp on the gas pedal or right all you want, but the car will not move forward. The engine, that is engine revving or the expected return, is totally disconnected and mathematically irrelevant to your speed. So remember, whenever I say this word risk neutral, right, risk neutral, it means expected return is disconnected. It simply means what? Risk neutral means what? Expected return has got disconnected and mathematically irrelevant. Just coast on the risk free rate. That's it. I hope this is crystal clear now. If you really think that this is adding value to your preparation, do hit the like button. Now let's shift our focus to the next question, calculation of modified duration. This is the numerical part, right? So what they have given, a corporate treasury desk hold a CAC. They have mentioned the semi-annual paying government bond. The bond currently has a McLeod duration of 7.5 year, trading at YTM of 6% per annum. You have been asked to compute the modified duration and estimated percentage price change if the market yield suddenly undergo a parallel upward shift of 50 basis point. They have given you the four options. You have to select the correct one. Friends, how do we go about computing the modified duration? Let's break this down into bite-sized pieces without the financial jargon. So first of all, you can think of the modified McLeod duration as a timer, right? So whenever I say McLeod duration, you can think of like a timer. Okay, it simply measure in years how long it will take for a bond to pay you back your true cost. So in this case, the time they have given is how much? I think 7.50 years. Fine. Yeah. So McLeod duration, this is the time they have given, 7.5 years. But investor don't care about time. They care about price swing. What investor care about is the price swing, right? To measure how sensitive the bond price is to the changing interest rate, you know it very well that bond price is inversely proportional to the interest rate, right? So how much sensitivity has bond price with respect to the interest rate, right? So what we do, we have to tweak that timer slightly. We have to change that timer slightly, and we call this tweaked version, right? We call this tweak version. Tweak means changing. We call this tweak version as a modified duration. Fine. Next, you need to know the golden rule of the bond, and the golden rule of the bond is called seesaw effect. I told you already that bond price and interest rate sit on the opposite end of the seesaw. If the interest rate goes up, the price of the bond goes down. In our story, you can see in this particular case what they have given, that interest rate just go up by 50 basis point, right? Upward shift of 50 basis point. That interest rate has gone by 50 basis point. That is just banking slang for a 0.5%. You can call it 0.50%. Because the rate went up, so we know for a fact that our bond price is going down, right? So now how to go about finding the modified duration? See, first of all, modified duration, you take the McLeod duration, right? You know it very well that modified duration is equal to McLeod duration divided by 1 plus YTM to the power n divided by n, right? So you can see they have already given it is a semi-annual bond. They have mentioned this word semi-annual. What does it mean? It means twice a year. So what is the annual interest rate they have given? Annual interest rate they have given is 6%. They have given 6%. So 6% divided by 2, which is equal to 3%. Right? Either you write it 3% or you can say 0.03. Okay.
So what is the math? McLeod duration they have given 7.5 upon 1 plus 0.03. That will be 7.5 upon 1.03. That will give us 7.28 years. Right? 7.28 years. If you look at the option, so this eliminate option number A and option number C. Right? B and D are maybe correct. One of them may be correct. Now, let's talk about the finding the price change. That's the second part of the question. How do you go about finding the price change? Very simple, right? So we are talking about the price change. It's very simple. What we need to do? We need to multiply the modified duration with the change in interest rate, right? So how much is the modified duration? 7.28. How much is the change in interest rate? That is 0.50 percentage. That means that will give us 3.64 percentage. Okay, so this is your price change. But remember the seesaw. Do you remember the seesaw? Yeah, I told you na. In one side of seesaw there is a price, other side there is interest rate. So interest rate is what? Interest rate is increasing, so price will go down. Okay, so interest rate went up, the price must goes down, so the change is negative. So this is minus 3.64 percentage. So this eliminate the option number, I think B. Yeah, it say plus 3.64. This is wrong. Correct answer is option number D. Okay, so to breeze through this in the exam day, just remember the phrase modify the MAC by half year and then seesaw the price. Just remember this, modify the MAC by half year and then seesaw the price. So which means, whenever you semi-annual physically slice the interest rate in half before you divide by the McLeod duration, and rate went up, so a huge down arrow next to your price, you can eliminate any positive price, right? I hope the concept is crystal clear. Now question number 7, we have very good question related to the uniform price auction. So the question is, in the context of primary market issuance of government security by Reserve Bank of India, which of the following best characterize the uniform price auction? Option A, bids are arranged in descending order of price. Any successful bidder pays the exact price they bid. Option B, all successful bidder are allotted the securities at the lowest accepted price, effectively mitigating the winner curse. Option C, the central bank allocates securities at the weighted average price. Option D, only non-competitive bid are accepted and the price is determined by the secondary market yield. These are the four options they have provided. And let me explain using an example. Friends, imagine you and your friend are bidding on a limited batch of 10 VIP concert ticket. Okay, so there's a limited batch of 10 VIP concert ticket. So you are desperate to go. So what you do, you bid 5,000 rupees. Fine. Your friend bid 4,000 rupees and someone else bid 3,000 rupees. Now the seller accept the top 10 bids. Seller accept the top 10 bids and the lowest winning bid cutoff is 30,000. So if this were a traditional auction, you would have to pay your full 5,000. You would immediately fill a pit in your stomach, realizing that you overpaid by 2,000, isn't it? You overpaid by 2,000 because the lowest bid is 3,000. Right? In the finance, that terrible feeling of overpaying, right? In the finance, that terrible feeling of overpaying is called the winner curse. It's called the winner curse. But a uniform price auction is different. We are here talking about the uniform price auction. It is different. The seller look at that 3,000 cutoff price and say, congratulations to everyone who bid 3,000 or higher. You will all get ticket and you all only have to pay uniform price auction. The seller look at that 3,000 cutoff price and say, congratulations to everyone who bid 3,000 or higher. Right, you will all get ticket and you all have to pay 3,000 only. Suddenly you feel great. You bid high to guarantee your spot, but you only had to pay the lowest accepted price because the seller is looking at that. He has decided the 3,000 cutoff price, and you will all get the ticket and you only have to pay 3,000. So you are getting your 2,000 back. So you feel great, right? So the RBI uses this method for government bond. So banks are not afraid to bid aggressively. That is the point. Okay. So the bank the same method RBI use, right, for the government bond. RBI use the same method for the government bond so that the bank are not afraid to bid aggressively because they know if they bid more aggressive, right, they are getting the minimum they have to pay only. That is the cutoff, and above that whatever they have paid they will return. Okay, that is the point. So if you look at the option that they have, that's called uniform price bid auction.
Now, if you look at the option they have given, yes, B is the correct answer. All successful bidder allotted the security at the lowest accepted price, a cutoff, mitigating the winner curse. Exactly. That is what the uniform price auction is all about. Okay. I hope this is crystal clear. So the correct answer is option B. Let's quickly eliminate the other. Option number A, describe a multiple price auction. Yeah, this is called, multiple price auction. Sometimes question may be asked, what is a multiple price auction? So in that case, you know what happened? Where you actually pay what you bid. Hello, winner curse. Yeah, that is the case of winner curse. That's called multiple price auction. Because whatever how much you have bid, you have to pay that. That's called multiple price auction. And if you look at the option C, it is also incorrect. Why? Because the RBI does not average the price out. It says that averaging the price. No, no, no. They strictly use the cutoff price. RBI does not average the price. What they use? They use the cutoff price. And if you look at the option D, it is completely wrong because competitive bid, are the entire point of holding an auction in the first place. Right? They say that only non-competitive bidding are accepted. No, no, no. Competitive bidding is are accepted. So when you see the word uniform, see to remember this. Let me tell you a trick. So whenever you see this word uniform, just remember, think of a school uniform, right? So uniform, you can think of a school uniform, right? What is the point of a school uniform? It makes sure that every single student looks the same, looks the exact same, right? So that nobody feel foolish or left out. So remember, in the uniform price auction, right, everyone pays the same price. Because everyone pays the same cutoff price, nobody feel foolish. It magically cures the winner curse. Now have a look at the next question we have. So this is question is regarding the annualized yield of treasury bill. Very good question it is. So a bank treasury department purchases a newly issued 91-day treasury bill with a face value of 1 lakh, cutoff price 98350, standard 365 day per year. What is the true yield or annualized yield of this T bill? Four options they have given. So let me give you a simple example to make it this concept crystal clear. Imagine that you buy a guaranteed winning lottery ticket. What you did, you buy a guaranteed winning lottery ticket, okay, from a friend. The ticket will pay you exact how much? 1 lakh. The ticket will pay you exact 1 lakh in 91 days. Your friend say, give me 98350 today. Give me 98350 today, and you can keep the 1 lakh when it's pay out. So your actual profit is the difference. How much is your actual profit? The profit is your difference, which is I think 1650 in this case. But here is the catch. When you brag to your family about how much money you made, you want to compare it to a normal bank saving account. Bank actually always advertise their interest rate for a full year. Right? What bank do? They advertise their interest rate for the annualized basis, or we call it full year basis. Right? You've only held this ticket for 91 days, isn't it? You've only held this ticket for 91 days. To find your true yield, you have to do two things first. Actually, what we are interested in, we are interested in finding the true yield. To find the true yield, you have to do two things. First of all, you have to calculate the profit you made based on the money that actually left your pocket. So the money that left your pocket is 98350, and the profit you made, first thing you have to calculate. And second, scale that 91-day profit up to see what it would equal if you kept repeating this exact same deal for a full 365 days. Right? So, because you want to brag about the profit you made to your family member, so you want to compare, you want to analyze it. First of all, you calculate the profit, right? And then scale that 91-day profit up to see what it would be equal if you keep the repeating the same for full 365 days. So first of all, you find the profit. So profit is very simple. 1 lakh minus 98350. That is how much? I think 1650. This is the profit. Now you find the holding return. So divide this profit. So basically you have to find the holding return. So you divide your profit by the money you actually invested. So 1650 upon 98350, right? That will give you 0.01677, or we can say 1.67%. That's called holding return. Now we analyze it. So in how many 91-day period are there in 365 days? So 365 divided by 91, right? Multiply your return by this into 360, yeah, into 0.01677 into 100. So that will give you 6.73%. So we can confidently dismiss the other option. Like you can see, other option they have given 6.62, 6.64, right? Because they are the trap, right? So to avoid the biggest trap in the calculation, remember the phrase, the true yield uses true out of pocket, true out of pocket, right? When you calculate your percentage, never divide by 1 lakh you have not received yet. Always divide by the true out of pocket cash that you spent today. Most of the time mistake what happen, we divide by 1 lakh. No, no, no. 1 lakh you have not received yet. What have gone out of your pocket, that is 98350. You have to divide by that. That give you the holding, right? Holding return. And that return, analyze it, that will give you 6.73%. So I hope scale it up to 365 days and you will get the math right every day, every time, whenever you calculate it. I hope this is crystal clear. Now let's look at the next question. This is the comprehensive treasury and portfolio concept. Very good question. This type of question are frequently being asked in the examination. So a treasury manager at a commercial bank is reviewing regulatory limit for money market operation and analyzing the recent investment performance. So which of the following statement correctly reflect the established RBI guideline and standard portfolio definition? Option number A. For when issued security, the aggregate net short position are capped at 95% of the RBI notified amount monitored on NDS OM platform. B says that when the bank issue interbank participation certificate strictly under a non-risk sharing basis, the maximum permissible period of issuance is 91 days. Option 3 say, during a portfolio analysis study, active return is calculated as active return is equal to portfolio actual return minus benchmark actual return. There are 4 options they have provided, right? So now let's break this big statement down into simple everyday concept. So friends, imagine a popular sneaker brand announced a new shoe. So let's suppose there is a sneaker brand and what they have done, they have announced a new shoe. Okay, but it has not actually been manufactured yet. It has not been manufactured yet, right? So sneakerhead start selling pre-order to each other. What they start selling? Pre-order to each other. So to prevent the chaos, the brand say you cannot pre-sale 100% of the factory capacity. What does the brand say? Brand say that you cannot pre-sale. You cannot pre-sale 100% of the capacity, right? Just in case something goes wrong, we are capping you at 95%. In the bond market, RBI does the same thing with the government bond that are announced but not yet issued. There are some government bond that are announced but not yet issued. So RBI does the same thing. They cap the pre-selling at 95% to keep the market stable. They cap the pre-selling at 95%. Okay, that is what statement number 1 is all about. As you can see, when issued, right? For when issued security, the aggregate net short position is capped at 95%. Exactly. Now let's look at statement number 2. So IBPC on a non-risk sharing basis. Yeah, statement number 2 is talking about the right IBPC on a non-risk sharing basis. Let's talk about it. Imagine you lend some money to a friend. This is you, and you lend your money to your friend, right? And another friend steps in to guarantee you get paid back no matter what. So this is the third friend. He is giving you a guarantee. He is giving you a guarantee. No matter what, I will pay you. So because it is totally risk free for you. The RBI has a strict rule for bank doing this, right? What is the RBI rule? That this super safe non-risk sharing, this super safe non-risk sharing loan between bank can only be short term. This super safe non-risk sharing, lending between bank can be short term. The maximum allowed time is exactly quarter of a year. That is 91 days. Quarter of a year. That is what statement number 2 is all about. It says that when the bank issues interbank participation certificate or IBPCs strictly under non-sharing basis, maximum period. Yes, exactly. Now let's look at statement 3. This is all about the active return. Let's talk about it. So think about your child bringing home a math test. So let me give you an example for statement number 3. Suppose this is your child, and what he is bringing? He is bringing math test, right? The class average was 75%. What was the average class? The class average was 70%. and your child actively studied and scored how much? 85%. This is your child scored. Your child scored 85%, right? So the active return, if you look at the active return, so that extra 15% is the extra 15% they earned above the class average. In finance, you just take your portfolio actual return and subtract the market benchmark. You take the portfolio actual return and subtract the market benchmark. So the correct answer is option D. All are correct, right? So remember, to remember the concept is for the examination, just remember this trick. What trick? 95, 91, AB, which means 95 means RBI stops you just short of 100% on a pre-order. When issued is capped at 95%. 91 means a risk-free bank loan. A risk-free bank loan lasts exactly quarter of a year. And AB means active return equal actual minus benchmark. AB means actual return equal actual minus benchmark. Just jot it down. 95, 91 and AB.
What option they have given? The first one is CMB carries short flexible tenor and serve urgent cash need, while T will follow fixed maturity with regular issuance. B says CMB are offered through a scheduled auction with fixed term, while T will are issued only when sudden liquidity gap arises. C says that CMB are long-term borrowing tool with routine auction, while T will support short-term deficit through ad hoc sales. Option D says CMB and T will both come with fixed term of 91 days, though CMB address routine fixal gap unlike T will. So you have to tell me which option correctly differentiate between these two. So let's start with our first option. So you can imagine the government of India like a person, and this person needs money for two situations, right? This person needs money for two situations. The first one is regular monthly expense. This person need money for regular monthly expense, like it can include rent, it can include groceries, right? It can include mobile bill. So these are quite predictable. These expenses are quite predictable, right? And for this type of planned need, the government issues treasury bill. So these expenses like rent, groceries, mobile bill, quite predictable. And for them, what government does? They issue T bill. And T will follow fixed maturity, 91 days, 182 days, 364 days. Okay. So the government issue them regularly on a fixed schedule. Now, the second kind of situation we have is we call, sudden emergency need, right? Sudden emergency need. So basically like a surprise hospital bill. You can think of it like a surprise hospital bill, right? Or a sudden repair. You can think of it like a sudden repair, surprise hospital bill, sudden repair. It's quite unexpected, it's quite urgent, right? Unexpected and urgent, right? And for this kind of urgent cash requirement, what government does? Government issued cash management bill. So what is the key point about CMB? What is the key point about CMB? The first point is that its tenor is quite flexible. Tenor is flexible. Second point is tenor is always less than 91 days. Third point is they are issued only when needed. They are issued only when needed. They have no fixed schedule. And fourth point is that the purpose is to manage the temporary cash mismatch. The purpose is to manage the temporary cash mismatch, right? So CMB are just like short term. CMB are like short term quick loan, while T bill are steady planned borrowing. That's the difference. Treasury bill is a steady planned borrowing, while CMB is a short term quick loan. Now let's look at the option that we have. Option A say CMB carries short term flexible tenor and serve urgent cash need, while T will follow fixed maturity. So if you talk about CMB carries short term, this perfectly capture for flexible plus urgent nature. Flexible plus urgent nature of what? CMB. Yes, CMB are flexible and they are urgent also. And what about T bill? Yes, T bill are fixed plus regular. T bill fixed plus regular nature of T bill. That's why A is correct. What about option B? Option B says CMB are offered through a scheduled auction with fixed term, while T bill are issued only when suddenly liquidity gap arises. C says that CMB are issued on a schedule. No, they are on a schedule. I again tell you that CMB are on a schedule. Right, CMB are on a schedule. So this is wrong. What about C? C says that CMB are long-term borrowing tool with routine auction, while T will support short-term deficit through ad hoc sale. What do you think about option C? So CMB are not long-term. First of all, it says that CMB are long-term. No, they are not long-term. CMB are short-term. They are very short-term. So that's why C is wrong. What about D? It says that CMB and T will both come with fixed term of 91 days, though CMB address routine fiscal gap unlike T will. So, CMB do not have any fixed 91-day maturity. They are always less than 91 days, below 91 days. So it says that CMB and T will both come with fixed term of 91 days. That is wrong. So the correct answer is option number A. So one way to remember it like this. One way to remember it like this. You can think of this CMB as a crisis money borrowing. Right. This is my definition of defining CMB. Crisis money borrowing. So crisis means what? Whenever you see this word crisis, it simply means urgent. It simply means urgent. Right. Urgent, short and flexible. Right. Unscheduled. And if you talk about the T bill, you can think of the T bill like this. You can think of the treasury bill like timetable bill. Right. You can think of them like timetable bill. So T means timetable and fixed tenor and regular auction. Right. Simple and memorable. So again I am repeating, CMB is crisis money borrowing. Crisis means urgent, short and flexible. And T bill timetable bill, which means timetable, fixed tenor, regular auction. So what we learned from this discussion is that CMB are short maturity are less than 91 days. It's quite flexible, it's quite unscheduled, and they are issued for urgent cash need. While T will have the fixed tenor. Fixed tenor means 91, 182 or 64 days. Regularly they are issued. Regular issues and planned borrowing. They have a planned borrowing. T will have a planned borrowing, right? I hope this answered the question. That's why option number A is the perfect one. Now friends, let's look at the second question. Please have pen, paper, calculator with you. So this is the question number 2, because we are going to discuss one numerical based question. Right. So the question is like this. A government bond of 100 rupees face value carry an annual coupon rate of 7.5%. The last coupon date was 1st April and the settlement date was 20th June of the same year. Assume actual basis and total 80 days have passed. What will be the accrued interest payable by the buyer to the seller? That's the question. You have to compute the accrued interest payable. So option they have given 1.50, 1.64, 1.80, 2.05. Exactly same question was asked in the examination. So let's get started. Let's understand the basic concept behind the question. How do we go about computing the accrued interest? So you can think of the government bond. One way to think of the government bond like a fixed deposit. One way to think of the government bond is like a fixed deposit that pay interest every 6 months, right? And that is called, coupon. Coupon is the interest that is paid, right? As you can see, they have written that, 6 months, right? It carries annual coupon of 7.5%. Last coupon date was 1st April. Settlement date is 20 June, right? And 6 months. So you can think of the government bond like a fixed deposit that pay interest every 6 months called a coupon. Now imagine this. What is happening? The seller held the bond from 1st April, 1 April to 20 June. Seller held the bond from this period. So that is, 80 days. 80 days have passed. During these 80 days, the seller earned interest. The seller earned interest, right? So, but they are selling the bond before the next coupon date. You see, basically what they are doing, before the next coupon day, they are selling the bond. Try to understand what is happening here. That let me explain on the timeline. It will be very better to understand. See what is happening here. That basically held the bond from 1 April to 20 June. So how many days are there? 80 days. And they have explicitly mentioned that annual coupon rate is this much. Last coupon date was 1st April. Settlement date this month April. What is the accrued? Okay. Suppose that it pays a fixed interest every 6 months. That is called coupon. So during these 80 days, the seller earned interest. Obviously, whoever have sold the bond, he might have earned interest during these 80 days. But they are selling the bond before the next coupon day, because next coupon day is scheduled on 6 months, which means 180 days. They are selling before 180 days. So the buyer must compensate the seller for the interest earned so far, right? So in this case, seller has earned interest and buyer must compensate the seller.
buyer must compensate the seller for what? For whatever interest they have earned. And that compensation is what we call, accrued interest. That compensation is called accrued interest. I hope it is clear. So how do you go about computing the accrued interest? Let me explain. So you can write it like this. Accrued interest is equal to face value multiplied by coupon rate multiplied by day elapsed or days elapsed divided by 365. Right. So let's substitute the value that we have provided. So the face value is 100 rupees. Yes, right, 100 rupees. Second, we have the coupon rate. What is the coupon rate? Coupon rate, I think it is 7.5%, right? What is the, how many days have elapsed? So the day have elapsed is, 80 days. 80 days have elapsed. Total 80 days have passed upon 365. So that will be give you how much? Try to think about it. So it will give you 100 multiplied by 0.075 multiplied by 0.21918. That is equivalent to 1.643 or 1.64. So the buyer must pay the seller this much interest in the form of accrued interest. So actually, this bond is just of 100 rupees. That's why this accrued interest is so much small. Actually, the bond which are issued in lakhs and crores, so it will be higher, right? So that is the option B is the perfect answer. That is the accrued interest payable by the buyer to the seller. So you can think of it, the formula is just like this. Let me write down the formula once more, because main thing is formula F into C into D upon 360. Now friends, the next question is, which of the following statement best describe the functioning and regulatory framework of TREPS as per the updated 2025 guideline? So this question is about, TREPS. Options are given. TREPS is an unsecured overnight borrowing facility for bank only, settled directly between counterparties without collateral or tri-party involvement. B says TREPS is a secure tri-party repo system where CCIL manage collateral, settlement and counterparty risk. Participants include bank, mutual fund, insurer and NBFC. Rate are market driven. Tenure can extend up to 1 year. C says TREPS is a long-term debt issuance platform for Government of India, while T-bill are issued through a tri-party agreement, where T-bill are issued through a tri-party agreement with interest accruing only at maturity and regulated solely by SEBI. D says TREPS is a corporate bond trading platform where repo interest is calculated only monthly, haircut are not applicable, and CCIL does not act like a central counterparty under RBI direction. So this is a very good question. So basically, let me explain it using one example so that it becomes crystal clear to you. Imagine that there are two people, right? So imagine there are two people. So the first one is the lender. So lender, what he has extra money. Lender has extra money, right, for 1 day. He has extra money for 1 day or few days. Okay. And suppose on the other end we have borrower. We have borrower. Borrower, he needs short-term fund. Borrower need short-term fund. Right. So, but both want safety. Either it is lender or it is borrower. Both want safety. Borrower says that I will give you my government security as collateral. If I don't return your money tomorrow, you can sell them. See, what borrower say that, borrower has extra money and lender has extra money and borrower needs short-term fund. Both want safety. So borrower say that I will give you my government security as collateral. He says to the lender that I will give you my government security as collateral. If I don't return your money tomorrow, you can sell them. This is exactly how a repo work. Right. Basically, now what happened, a third party who checks collateral, right? A third party enter. What he checks? He checks the collateral, right? He keep it safe. He keep the collateral safe. He manage the settlement. He mark it to market, right? And he guarantee the deal. He also guarantee the deal. So the third party which enter is called CCIL. Clearing Corporation of India Limited. Please remember it. That is called CCIL. And when CCIL act like this tri-party agent, the system is called, whenever CCIL, basically, this CCIL is acting like a tri-party. This particular arrangement is called TREPS. TREPS full form is, tri-party repo dealing system. Right. So the full form is very simple. Tri-party, right, repo dealing, tri-party repo dealing system. These are used for overnight to short-term borrowing, and this is secured by government security. Now let's look at the option that we have. So that is the basic point regarding TREPS. So if you look at the option number A, it says that unsecured borrowing. No. It is never unsecured. It's always secured. Right. TREPS is just secured because, collateral like government security, collateral like T-bill, as SDL, these are placed. They are not unsecured, not corporate bond. They are not long term. Right. So option number A, if we talk about, A is wrong. What about B? Yes, this is the correct. Secure tri-party repo system. CCIL manage collateral settlement and counterparty risk. And rates are market driven. Tenor can extend up to 1 year. Option number C says that TREPS is a long-term debt issuance platform for the government of India. So basically it is talking about the participants, which means, that traditionally overnight but updated guideline allow tenor up to 1 year. And then, system timing 2025 revised. So from 1st August, the operating hour were updated to 9 a.m. to 4 p.m. Right. So market driven, tenor flexibility. There are different kinds of participants like bank, mutual fund, insurer, and NBFCs. Okay. And then we talked about the tri-party mechanism. Who are the parties? Basically CCI act like a tri-party agent. Okay. So why option are wrong? So if you talk about the option number C, it says that TREPS is a long-term debt issuance. No. Actually, and bank only, and it is unsecured. It is saying option number C is saying long-term debt. Actually, completely wrong. TREPS is a short-term repo, not bond issuance. It has nothing to do with bond issuance. What about option D? It calls TREPS a corporate bond trading platform. Actually, the answer is no haircut. Actually, this is wrong. Repo is never corporate bond trading. Okay. So tri-party repo ensured by CCIL with securities. So TREPS, just remember the keywords. TREPS, it is a secured collateralized tri-party repo. CCIL handle the risk, settlement and collateral. Rates are market driven, never fixed, not RBI fixed. And participants, just now I told you that participants are bank, mutual fund, insurer company, NBFC and other regulated entity. Tenor overnight up to 1 year. Timing I told you 9 a.m. to 4 p.m. Now the next question is, which of the following accurately describe STRIPS and regulatory framework governing their creation, trading and valuation after the 2025 RBI update? So friends, the option they have mentioned is that STRIPS is newly issued zero coupon securities created by RBI for state and central government. So this question revolves around stripes. So and it says that it valued only at the face value without accrued interest and cannot be reconstituted once strip. Option B says STRIPS are separated coupon and principal component of eligible fixed coupon government and state security. They are treated as a zero coupon instrument on NDS-OM, valued using discount factor. C says that STRIPS are unsecured money market borrowing used by bank to manage liquidity created from treasury bill without coupon separation. Option D says that STRIPS represent the long-term corporate bond stripped by PD, where interest strips pay periodic coupon. So now let's see the option that we have. So strips sound something like complex security, but it's actually very easy if you understand one simple thing, right? One simple thing is that you take a normal bond, right? Break it into pieces, and each piece become a zero coupon security. Suppose this is a normal bond. This is normal bond. You break it into pieces, right? And each one become a zero coupon security. So let me explain this, what this strips is all about. Imagine that the government bond that pays regular coupon. Suppose there is a government bond, and this government bond is paying what? This government bond is paying a regular coupon. What is the meaning of regular coupon? It means interest after 6 months. Okay. So basically, and return the principal at the maturity. So principal is also returned at maturity. Right. Now think of breaking this bond into small parts. What you are doing, you are breaking this big government bond into small parts. You are breaking the bond into small parts. And every future interest payment is one small piece. Every future interest payment is a small piece. Okay. And the final principal repayment is another piece. Final, obviously you will get principal repayment. This is the final piece. So remember, each of these pieces become zero coupon security. All these pieces, become what? Zero coupon security. and that is what we call strips, right? Strips. So strips stand for separated part of an existing government bond. Separated part of an existing government bond. It is not a new bond, rather it is not issued separately. So in simple word, it is just like bond broken into interest pieces plus principal piece. So we have a bond and we broke that bond into two parts. One is the interest piece and other is the principal piece. Right. Now let's look at the option that we have. So option A says that they are newly issued zero coupon security created by RBI for state and central government. So what do you think about this definition? So it says that strips are newly issued by RBI and cannot be reconstituted. Right? It cannot be reconstituted. It is saying that newly issued. Actually, this is wrong because they are derived from existing security and reconstitution is allowed. That's why option number A is wrong. I think B is saying that they are separated coupon and principal component of an eligible fixed coupon government. Exactly. B is the correct one. That perfectly match all the technical and regulatory facts. First thing is that as the full form is itself, separate trading of registered interest and principal of security. Separate trading. Right. So you can take eligible fixed coupon government security, separate coupon flow and principal each become a zero coupon instrument. So that's exactly what option number B says. Second thing is that there was an update in the year 2025. What was the update? Recently, in the year 2025, it has been updated. That earlier only central government security were eligible. But in June 2025, RBI allowed state development loan or state development security to be also stripped. So earlier only central government, bond could be stripped. But now, SDL can also be stripped. Eligibility includes, it must be fixed coupon. So basically, if SDL has to be stripped, there are some certain conditions. What are the conditions? The first condition is that it must be fixed coupon. It must be fixed coupon security. The residual maturity should be less than equal to 14 years. Minimum 1000 crore should be outstanding and must be SLR eligible. Right. So that is when SDL can be stripped. The next case is creation and reconstitution. Obviously, two processes always exist, stripping and reconstituting. In the case of strips, just remember, these two processes coexist together. So what is the name of the process? Let me write it down. The first thing is striping. What is the meaning of striping? Striping means, breaking the bond into coupon stripes plus principal stripe. So we have a bond, we have a regular bond, and we are breaking into two parts. The first part is called, principal strip. The second part is called, coupon strip. So basically we have break the bond into two parts. That's called stripping. And the second thing that we do is called reconstituting. Right. Which means recombining all the strips. We are recombining all the strips back into the original bond. We are recombining all the strips back into original bond. And we look at the option number B. That is what saying. It says that they are separate coupon and principal component of an eligible fixed coupon government. They are treated like a zero coupon instrument on NDSOM. And they are valued using discount factor and eligible for STM classification. Exactly. B number is the correct one. What about option number C? Option number C says that there are unsecured money market borrowing used by bank to manage liquidity created from treasury bill without coupon separation. So if you look at the option number C, it says that strips are unsecured money market borrowing. That is what it's saying, right? Actually, this is completely incorrect. It is completely incorrect, right? This is completely incorrect. The strips are not, unsecured, completely incorrect. What about option D? Strips represent long-term corporate bond stripped by PD. Yes, it says that corporate bond and pay periodic coupon. Totally false. Strips are zero coupon and from government security only. Remember, strips are zero coupon and they are from, government security only. Right? So it says that, they are long-term corporate bond stripped by PD while interest is still pay periodic coupon. Actually, strips are zero coupon and from government security only. That's why it is wrong. So what is the correct answer? Strips. So there is a trick to remember it. So whenever you hear this word strips, just think about it like this. Strip the bond. Strip the bond. What is the full form? Separate trading. Separate the registered interest, principal, security. That means separate trading of registered interest and principal of security. So what we learned, just let me summarize. So what we discussed, right? A strips is a coupon plus principal part separated from an eligible government security or a state development loan has also been included. And Basically this is a traded license like a zero coupon security. It will not offer you any security. Zero coupon security. It must be fixed. It must be for residual maturity must be less than 14 years and minimum outstanding 10,000 crore plus outstanding. SLR eligible, yes, it must be. You can include in SLR calculation. They are traded on NDSOM. They are valued using discount factor and ZCYC. They are eligible for STM classification, right? They can be classified under STM, held to maturity category. Please remember it. Now friends, we have a very good question. This is a numerical type question. Let's try to solve this one. So basically what the question is all about, there is a bank and this bank borrows 750 crore from RBI for 3 days. So the bank borrows 750 crore from RBI for 3 days. The RBI repo rate was 5.50%. But after the 25 BPS cut on 5 December 2025, the applicable repo rate for this borrowing become 5.25. What is the interest payable by the bank to RBI for the 3-day borrowing? Exactly such type of question are most frequently asked in the examination, and that is what we are practicing. So friends, if you want complete set of previous year question, because in this particular lecture I am not discussing the complete set, I have included the complete set of MCQ discussion in our paid course. For more detail regarding the paid course, you can WhatsApp me on this particular number. So here the question is all about 750 crore the bank has borrowed, and out of this 750 crore RBI repo rate was 5.50%, and there is a 25 basic point cut on 5 December 2020, and applicable repo rate become 5.25%. So the question is, what is the interest payable by the bank to RBI? Option they have given some crores. So repo question becomes super easy once you remember one golden rule. And what is that golden rule? See, if you have to solve any kind of repo based question, there is a golden rule to remember. So let me write down the golden rule. The thing is that interest is always calculated for the actual number of days, right? See, let me write it down. This one is the golden rule for any kind of repo calculation. Interest always calculate for the actual number of days, and that too using latest repo rate. Right, interest always calculate for the actual number of days using the latest repo rate. Now you can think of it RBI like a bank for bank. Obviously, think of what it is actually. RBI is the bank for bank. Whenever bank needs short-term fund, suppose this is a bank, and this bank need what? This bank need short-term fund, right? So it can borrow from RBI. This short-term fund it can borrow from RBI. At which rate? At the rate repo rate. So what is happening here? That this bank is borrowing short-term fund from RBI at the repo rate. Now basically in this particular case, how much it is borrowing? It is borrowing 750 crore, right? For how many days? For 3 days. At the new repo rate, what is the new repo rate? There is a 25 basis point cut, so it now becomes 5.25%. Right, and the question is asking you to compute the interest. The interest is very simple. What it is? P into R into T upon 100. I think you know it very well. Now, first of all, what we do? We convert the percentage to decimal. Now, how much is the interest? They have given 5.25. So that becomes 5.25 upon 100, or we can say 0.0525. Let's apply the formula here. Principal is how much? Principal is 750. Right, crore obviously. And R is just now equal to 0.0525, and T is almost 3 months. I think they have invested for 3 months. Yes, for 3 days, sorry, 3 days. So 3 upon 365. Right. So that will give you 0.3236 crore. So round value is 0.323 crore, right? So that's a very simple question. Right, you have to compute the interest P into R into T upon 100. Now, have a look at the next question. Very important and very good question. So friends, which statement best captured the design, operation and objective to 3 years? VRR is a standing facility with no auction. LTRO, TLTRO inject liquidity only through CRR cut and do not use government security as collateral. So basically, RBI liquidity tools. You might have heard about term repo, VRR, LTRO. So these are the RBI liquidity tools. Term repo, right, VRR, LTRO. So it may sound complicated, but if you understand who borrow, at what rate borrow, for how long borrow, the entire chapter becomes super easy. You can think of the RBI as the main water tank of the financial system. Bank need water, that is money for different duration, right? You can think of RBI you can think of the main water tank. For what? For financial water tank of the financial system. right? So bank need money for different duration. It can be either very short term. It can be either short term but longer than overnight. It can be long term structural need. To supply this water efficiently, RBI use three tools, right? Basically, it can be, the money can be for short term, it can be overnight, it can be for longer term structural need. So to supply this water efficiently, RBI use three tools. The first tool is called term repo. The first tool is called term repo. This is the kind of short term injection. The second is called VRR. VRR is variable rate reverse repo. This is a kind of short term absorption, right? And the third thing that RBI can use, the tool that you can use is LTRO or TLTRO, which means long term injection at a stable cost. Term repo, VRR, and LTRO, TLTRO. These are the three ways. So if you talk about the term repo is for 7 to 14 days. So think of it like RBI giving water to bank for few days, not the every night, right? That is called LTRO. Or sorry, we call it term repo. So term repo means RBI giving water to the bank for few days, usually 7 to 14 days, and platform is e-Kuber auction, and timing of often alternate Friday. Right, amount is how much? Amount 0.25% of NDTL, and rate is variable rate discovered through auction, and typically higher above the policy repo rate. So this helps bank avoid heavy dependency on overnight borrowing. Then the second thing, we have VRR, that is called variable rate reverse repo. So this is for liquidity absorption. Name itself suggests variable rate reverse repo. Liquidity absorption is the main thing here. So the key feature is, again, it is overnight for up to 14 days. First point. Second point is method is competitive auction. Method is competitive auction, and rate stay near the reverse repo. Rate always stay near the reverse repo. It keep money market rate stable. It keep the money market rate stable. So VRR is a kind of short-term liquidity absorption through auction. The third thing we have is LTRO, or we can call it TLTRO. So this is for 1 to 3 year long-term cheap funding. So these are RBI long pipeline support in supplying steady long duration water at a stable cost. The key features are 1 to 3 year tenor. Rate, I told you, they are fixed at the policy repo rate. They are fixed at policy repo rate. Purpose is to provide long-term liquidity, support bank ALM, simulate lending, direct bank to inject in an NBFC MFI health instrument. Then we talk about the TLTRO. TLTRO is the targeted So TLTRO is the targeted deployment. So basically it is for 45 days. TLTRO is for 45 days, and in the recent TLTRO 2.0, it is for 45 days. So TLTRO help the bank lend long term without needing the repo rate cut. So that bank can lend for long term without needing the repo rate cuts. So if you look at the option number B, it capture all these things. Term repo or LF. Auction mechanism is variable rate auction, VRR that we call it, and correct liquidity amount is almost 0.25% of NDTL, and accurate VRR description, accurate LTRO, TLTRO description. So this is all, everything is correct. So option number B is the correct one. Now friends, what we learned from this question is that for term repo, typically it is 7 to 14 days e-Kuber auction, and variable rate above repo rate, and it inject 0.25% of NDTL. Then we talk about the variable rate reverse repo, that's called VRR, which is a liquidity absorption tool for up to 14 days, 13 to 14 days, and competitive bid happens near the reverse repo. Then we have LTRO or TLTRO, which is provide 1 to 3 year fund at a policy repo rate, and it help ALM and NBFC MFI. Now friends, let's see the next question. So the question is on your screen. It is about which statement correctly explain how PVP operate in India for USD INR forex settlement under CCIL along with the risk control and legal framework. So option they have mentioned that PVP settle forex trade after netting using RBI for INR and bank for US dollar, ensuring simultaneous two-way payment that remove principal risk under PSS Act rule. B says that PVP process forex deal through CCIL system, settling INR at RBI and USD at bank, providing synchronized settlement. C says that PVP handle currency trade via multilateral netting, settling one leg at RBI and one at bank, giving real-time two-leg transfer that mitigate hostage risk. D says PVP conduct cross-currency settlement through CCIL using RBI and bank for legs, ensuring match payment that avoid counterparty loss. So which option do you think is correct here? So let's get started with option number A. So friends, forex settlement risk can wipe out the entire trader in trade if one party pay but the other does not. So we are talking about forex settlement risk. It can wipe out the entire trade. So basically, the India solved this problem using a powerful mechanism that is called PVP. PVP stands for payment versus payment. Right. Let's understand it in the easiest way possible. Imagine that there are two traders who are doing USD INR forex deal. Right. So the trader number A, they give Indian rupees, and trader number B, they give dollar. The danger is that what if one person pay but the other does not? That is exactly what happened in the case of hostage risk. You are familiar with this hostage risk. This is exactly what happened. One person pay but other did not pay. So India designed a system so that the both payment happen together. Both payment happen together, not at all. Right? Not at all. So that system is called payment versus payment. How it works, So first of all, in this case, CCIL, Clearing Corporation of India Limited, they take all the US dollar, they take all the INR deal from different banks. Right? It does multilateral netting. What it does? It does multilateral netting. So that each bank pay only the net amount. For example, let's say a bank has to receive $10 million, right? And they have to pay, suppose this is the bank, right? They have to receive $10 million and the bank has to pay $8 million. So what is the net amount? Net amount is $2 million, right? They have to receive. So net $2 million they have to receive. So basically what happened, this reduces the liquidity pressure. Ultimate effect is that liquidity pressure get reduced. So this is how the step number 1 happened, that is CCIL nets trade. Step number 2 is about settlement through two different systems. Settlement through two different systems. So basically PVP need two safe settlement leg. One is called INR leg which are settled in RBI account. Second is called USD leg which are settled through designated USD settlement bank abroad. So basically two leg system, it is INR leg and USD leg. But CCIL coordinate both the leg. And the third step we have is simultaneous payment. This is called true PVP, which means CCIL ensure that dollar transfer happen only if INR transfer also happen. Dollar transfer happen only if INR transfer also happen, and INR transfer happen only if dollar transfer happen. So both the payment are released simultaneously. So this remove the principal risk. So principal risk get eradicated, and obviously they are backed by the law. PSS Act 2007, right? That is Payment and Settlement System Act 2007. So it is protected under this act. The entire settlement system is protected under the PSS Act. So let's look at the option that we have been provided. So option number A says that they settle forex trade after netting, use RBI for INR and bank for USD, ensuring simultaneous. Yes, I think A is the correct one. CCIL use multilateral netting, INR settle at RBI, USD settle at designated bank, payment release simultaneously, it remove hostage risk. What about option B? So they have mentioned here, synchronized settlement. Here you can see they have mentioned synchronized settlement. Actually, it does not mention multilateral netting. It did nowhere mention multilateral netting, right? And or PSS Act protection. That's why it is half truth. It is incomplete. I'm not saying that this is wrong, but it is incomplete. What about option C? Option C says real-time two-leg transfer, right? It says real-time two-leg transfer. The incorrect thing is that it used batch-based net settlement. Here they have written, right? they use batch-based net settlement. So they have mentioned that it use real-time gross settlement. No. Actually, they use batch-based real-time settlement. Right. The option number D says that, vague misses some core feature like netting, PSS Act and simultaneous payment. So you can think of this PVP like, pay, and payer. So both currency may pay together as a pair. If one fails, the other cannot. So what we have discussed, so we have just talked about PVP. So PVP, please remember, this is a simultaneous settlement of both the currency leg. Simultaneous settlement of both the currency leg. It removes the Hurstead or it removes the principal risk. And CCIL use multilateral netting. And USD settles at the settlement bank. And legally protected under the PSS Act 2007. Now friends, have a look at the next question. So, the question is, which statement correctly explains how CLS functions globally and how it complements CCIL settlement system for India's related forex trade? So, option they have mentioned that CLS settle match FX deal with using multilateral netting and RTGS overlap across 18 currency, cutting liquidity needs sharply and removing the Hurstead risk. B says CLS process currency flow on global gross basis without netting, settling only INR trade for Indian bank and operate without RTGS link. C says CLS handle only unilateral system for selected trade without PVP, relying mainly on manual nosto transfer. D say CLS offer delayed payment without simultaneity across currency and provide no liquidity benefit, while CCIL independently manage global foreign exchange trade. These are the four options they have mentioned. So we have to explain which one is correct. Friends, the bigger danger in the forex risk settlement is always the one risk that's called, Hurstead risk. This is one of the biggest risks in the forex settlement. What's the name of that risk? Hurstead risk. Hurstead risk means what, when you pay. The biggest risk is what, Hurstead risk. Hurstead risk means when you pay your currency but the other party currency never arrive. You pay but the other party never arrive. The global solution to this is CLS. India's solution just now we have discussed, PVP mechanism. But India domestic solution is PVP, CCIL, PVP. But we are talking about global solution is CLS. So basically imagine that two banks are doing USD dollar or euro trade. So bank A, they pay dollar, right? And bank B, they pay euro. If one side pay early while the other side pay late due to time zone difference, suppose because of the time zone difference, one side pay early, other side pay late. So obviously there is a huge risk is there. So global forex market solve this using CLS. What is the full form of CLS? CLS stands for, let me write it down. Continuous linked settlement. Continuous linked settlement. Right. Think of the CLS like a global clearing house. You can think of it like, it is a kind of global clearing house. Right. It is a kind of global clearing house that takes both the side currency. That take both side currencies, right? They settle them at the same time. Take both side currency. They settle them at the same time, and only releases if the other is ready. If the other is ready, then one will be released. So it's kind of global clearing house that take both side currency, settle them at the same time, and only release one if the other is ready. Now think about India. India need the same protection for India need the same protection for USD INR trade. So domestically, we will use CCIL PVP for the USD INR leg. But when the Indian bank does a global foreign trend, then CLS handle the global leg, CCIL handle the domestic rupee settlement. So suppose the Indian bank is doing global foreign exchange trade. So in that case, two legs are there. One is the global leg and other is the domestic leg. Right. So please understand, this global leg is handled by CLS and this domestic leg is handled by CCIL. Together they form a complete safety net. Now, how CLS work? So CLS settle trade using PVP. They settle trade using PVP, that is payment versus payment. Both the currency settle simultaneously. And it works across, 18 major currency. It uses multilateral netting. Right, this reduces liquidity requirement by over 90%. Right. And it settled during 5-hour RTGS overlap. Its settlement happened during, 5-hour, RTGS overlap. So that all the central bank payment system are open. Settlement happened during a 5-hour RTGS overlap window. It removes hosted risk or principal risk. So friends, how CCIL work for India? If you talk about CCIL working for India, you know it very well that suppose it is USD INR spot forward or swap done within India. So INR leg settled at RBI, and USD leg settled through designated settlement bank. CCIL perform multilateral netting. CCIL perform multilateral netting. Through PVP ensure simultaneous settlement. And when Indian bank do global foreign exchange trade, CCIL handle domestic INR leg, CLS handle global currency leg. Together they ensure both global and domestic PEP protection. Now let's look at the option. Option number A says that it matches the foreign exchange deal using multilateral netting and RTGS overlap across 18 currency, cutting liquidity needs sharply and removing the hosted risk, while CCIL use local PEP for USD INR trade with CLS supporting global leg. Exactly. Correct. B says CLS processes currency flow on global gross basis. So gross basis without netting. That's wrong. Actually, and also it says that it settles CLS, it settles only INR. No. Actually, and one more thing is that CCIL does not replace PEP with CLS. Option C say that no PEP and manual nostril transfer. No, actually it is wrong. And CLS is automated RTGS linked PEP system. And option D claims, CLS offer delayed, non-simultaneous settlement, completely opposite of reality. It says that it offers delayed settlement without simultaneous. It's completely opposite. So you can think of it like this. Just one trick to remember it. CLS is the global PVP, right? And CCIL is the India PVP. India payment versus payment, and one is global payment versus payment. So just remember, CLS protect global foreign exchange trade, while CCIL protect USD INR trade inside India, right? So CLS global PEP, CCIL domestic PEP, 18 currency in CLS, and CCIL INR versus via RBI. Now friends, let's see the next question. Which statement correctly describes the concept and calculation of the bond dirty price along with its market uses and price behavior? Right, very good question. It is disregarding the dirty price of the bond. So option A say that dirty price equal clean price plus accrued interest using day count fraction form the actual settlement value rises daily and until the coupon date. B says dirty price exclude accrued interest and stay constant between coupon date, serve only as a quoted benchmark. C say dirty price remove coupon related adjustment to simplify comparison, decline steadily before coupon date. D say dirty price uses only semi-annual compounding without day count rule, calculate purely from yield, ignoring coupon timing. These are the four options they have mentioned regarding the dirty price. We have to say which one is correct. So option number, bond pricing confuses many learners because they hear some clean pricing, they hear something called dirty pricing. But don't worry, if you understand just one simple idea, everything becomes clear. Imagine that you buy a house. Suppose that you buy a house, right? But the seller has already paid property tax for half a year. Seller has paid property tax for half year, right? So when you buy the house, you compensate the seller for the tax they prepaid. Bond work exactly like this. A bond, what it pay? The bond pay you periodic coupon, right? Bond pay you periodic coupon, or we call it interest, right? If the seller has held the bond for say 40 days, suppose this particular seller, he has held the bond for 40 days since the last coupon date, they have earned some interest. They have already obviously earned some interest because the seller has held the bond for let's say 40 days since the last coupon date. They have earned some interest. But when you buy the bond, you must pay that interest to the seller. So suppose you are buying the bond. So in that case, you must pay that interest, whatever seller has paid. So this earned interest is called, accrued interest. I think we have discussed one numerical based on it. Accrued interest. Right. So the total amount you actually pay is the clean price plus accrued interest. So the amount you pay is the clean price plus accrued interest and both of them when combined, that is called dirty price. So one formula you can just remember it like this. Let me write it down. You can write it like this: P dirty, that is dirty price, is equal to clean price plus accrued interest. Right. So what is the how to compute the accrued interest? Let's see. How to compute it? C into 1 upon period per year multiplied by days elapsed divided by day in coupon period. Right. This is how we compute it. So dirty price, a dirty price actually, because interest keep accumulating every day, so dirty price rises daily. And accrued interest becomes zero. If the suppose on the coupon payment date accrued interest becomes zero, so dirty price drops sharply and dirty price become clean price immediately after the coupon. And between two coupon date, clean price stay relatively smooth and dirty price keep rising. So this daily staircase pattern is a classic CFA FRM concept. So US market quote clean price because it gives a smoother number unaffected by the day count, and European market quote the dirty price. Now let's see the option that we have. Option A says that it equal dirty price equal clean price plus accrued interest exactly, right? And uses it says settlement is always at the dirty price. Yes, correct. Third point is it rises daily. Yes, correct. It fell at the coupon date exactly. And US is the clean quote. European Union is the dirty quote exactly. So option A is the correct one. What about option B? Option B says that dirty price exclude accrued interest and stay constant between coupon date. Actually, dirty price exclude accrued interest, it is false. Also say US use dirty quote, this is also wrong. Option C claim dirty price decline before coupon date. Actually no, it is wrong. Actually it is opposite of the reality. And option D claims dirty price ignore coupon and day count. Actually it is incorrect. Dirty price literally depends on day count. Because in the formula also you will see the day count. So dirty means actually what you pay. What you actually pay. What you actually pay for the bond. You pay clean price. Clean price is the market value. And also you pay the accrued interest, which is the interest that seller has earned. Together they form the dirty bond that you settle. So dirty price means clean price plus the interest. So it is the actual settlement price.
Important word. And they ask this question, which impact the legal impact of novation during the clearing of the trade, right? Both in process and the legal terms. So the key word here is the novation, and the context is CCIL role as a central counterparty, or called CCP. So options they have given that CCIL act like an agent to facilitate the exchange of fund and securities between the buyer and the seller. B, original contract between the buyer and seller is rescinded and replaced by two new contract where CCIL become the buyer to every seller. Option C, CCIL provide a guarantee to the seller that the buyer will pay, but the legal contract remains strictly between the original bilateral counterparties. D, novation refers to the process where CCIL revalues the outstanding position at the current market price to calculate the daily margin requirement. So basically these are the four options that they have provided, and you have to choose the correct one. So just pause a little bit and think about it. Now let me explain. Let me explain using an example so that it becomes crystal clear what novation is all about. So assume that there are two banks, right? So this is the bank A and this is the bank B. They do a trade in the government security or forex. So what they do, they enter into a bilateral contract. Initially they enter into a bilateral contract, and this trade is then reported to the CCIL. Once CCIL accepts the trade, suppose they accept the trade for clearing and settlement, something important happen, and that we call novation. Now listen carefully. The original contract between bank A and bank B is cancelled. What happened, whatever was the contract between these two, it is now cancelled. Okay, so it is replaced by two new contract. It is cancelled and it is replaced by two new contract. Now you may ask me, sir, what are the two new contract? Yes, I will explain. So the contract number one, contract number one is for CCIL become the seller. CCIL become the seller to the bank A. So think about it. So this contract between A and B is cancelled. Now this CCIL, it act like a seller to the bank A, and bank A is the buyer obviously, and CCIL become buyer. It become buyer for the bank B, who is the seller. Fine. So legally bank A no longer deals with bank B, rather, and bank B no longer deals with bank A. Both deal only with CCIL. So that means CCIL become buyer to every seller and seller to every buyer. See, this is the so much important concept that they ask this question every time. So CCIL become buyer to every seller and seller to every buyer. And if you understand it, you can easily answer this question. Now, if you look at the option, let's check out the option. Option number A says that, let me highlight the key point. It says that, right, CCIL act only like an agent. No, it's wrong. In novation, CCIL does not act like an agent. Rather, CCIL act like a principal party. Here the keyword is, principal party. Right? Principal party, not an agent. Option C, if you look at, they say CCIL only guarantee amount. It provide a guarantee. No. Guarantee is not novation. Guarantee and novation are separate thing. Right? Here the original contract itself is replaced. So what is happening here? Contract is replaced. It's not a guarantee. Now, if you look at the option D, they have provided, which says that novation means mark to market. Clearly, they have mentioned that novation means, mark to market. What do you think? Actually, no, mark to market is a risk management process. If you look at the MTM, this is a kind of, risk management process. But novation is a legal replacement of the contract. Okay. So, what is the correct answer? B is the correct answer. This is the correct one. So, remember, why novation is so much important. Let me tell you about this. Why it is so much important, because so a kind of risk is always there between when two parties are contracting, and that risk is called counterparty risk. I think you know about it, right? So suppose what happened, the bank B default tomorrow, bank B fail to fulfill their obligation, so that means defaulted. So bank A is still safe here. Why? Because it is a contract with CCIL. They have made the contract with CCIL, not with the bank B. Right. Second benefit of this novation is that, anonymity. Yes. Which means bank don't worry about who is on the other side of the trade. They trust the CCIL. The third thing is multilateral netting. Very important. This is another benefit. Please note it down. Super important. Multilateral netting. So you may ask me, sir, why are you explaining all these things? So sometimes it may happen that in the upcoming examination they ask you a question that what is the benefit of novation to the context of bank. So you must answer multilateral netting is one benefit. What is this multilateral netting? It means because CCIL is central to all trade. CCIL is central to all trade, right? That's why it can net multiple buy and sell position into one final obligation. So what is the correct answer? B is the correct answer. I hope it is crystal clear. So remember, novation means new contract, original contract is cancelled, vanishes, CCIL is the center, buyer to every seller, seller to every buyer. That's the point. Now let's look at question number 2. So question number 2 is on your screen, and everything has been explained in detail in this particular PDF. You can check out. Now question number 2 is one numerical based question, calculation of modified duration. So friends, we are given a 5-year bond and some details like they have given. Let me highlight it. 5-year bond they have provided. Face value 1000 rupees. Coupon is, annual coupon is 8%. YTM they have given 10%. Fine. So what they are asking you, and also they have given the McLeod duration. McLeod duration they have given 4.28 year. The question is not asking just to calculate the McLeod duration. It is asking if McLeod duration is 4.28 year, what is the modified duration? So our job is only conversion, not full bond calculation. Had it been the McLeod duration, we have to do the full bond calculation, which will take a lot of time. But in the examination, they don't ask for that much lengthy answer. They just ask you to compute whether you know the formula or not. Let me explain. So let's first understand the idea first. So this McLeod duration, it tells us on average after how many years we get back the bond cash flow. On average, after how many years we get. Before continuing the discussion, let me introduce you to our CTP comprehensive course, where you get entire everything content likewise as per the syllabus prescribed by IABF, PDF, videos, mock tests at just one place. You can check out the content. You will get a separate folder for previous year question, capsule content, which help you revise the entire content in a very short time. PDF section is there, which consists of theory and MCQ. Unit wise, module wise, mock test quizzes is there, video section is there. In the video section, I provide you explanation of each and every concept in a very lucid manner, and that too only 30 to 40 minutes per video, right? And the previous year question, you get to see what kind of question have appeared in the recently held examination. As you can see, these are the PDF which you can download also. Everything is downloadable, completely downloadable. In the PDF section, you get the module wise PDF, right? So you can check out every unit, and inside unit you will get theory PDF, MCQ PDF. You can download them also, and in the mock test and quizzes folder you get to attempt the quizzes based on the concept which we discussed in the video. So this is a fully fledged course. If you go through the entire content, it will hardly take 1 to 2 hours per day, and for 1 month if you go through it, it will surely help you. Many aspirants have cracked the examination using our content. So you can also check out the link in the description section, or you can WhatsApp me on the number shown on the screen. Discussing that McLeod duration tells you on average after how many years we get back the bond cash flow. But what this modified duration tells us, it tells us how sensitive the bond price is to the interest rate change, right? So modified duration is always derived from McLeod duration. And what is the formula? How to compute modified duration from McLeod duration? Let me tell you. So remember, this modified duration is equal to McLeod duration divided by 1 plus YTM upon N. Now just apply the formula. In this case, McLeod duration they have given. I request you to please pause the video, think about your own. So McLeod duration they have given 4.28. This is the value, and YTM they have given 10%. Okay, and N is 1. N is 1. Why N is 1? Because the coupon is annual. It is annual coupon. That's why no compounding is there. So if you look at the denominator, we have 1 plus YTM upon N. So 1 plus 0.1 upon 1, which is 1.10. That is our denominator. And we have to divide the McLeod duration by this 1.10. So remember, 4.28 divided by 1.10, that will give us 3.89 year approx. So the correct answer to this question is obviously 3.89 year. So just it was very easy question. Just you have to apply the formula and get the answer. So you can remember it like this: MOD is equal to MAC divided by 1 plus YTM upon N. Okay. So MAC under the pressure of YTM become modified. Just remember, MAC under the pressure of YTM become modified. Or simpler, modified duration is always smaller than McLeod duration. If the YTM increases, modified duration decreases, and if YTM are 0, right, both are equal. So what we have discussed, that McLeod duration is given first, and then modified duration is derived from it. MAC divided by 1 plus YTM upon N is equal to modified duration. That's the formula that we need to keep in the mind. Now a very good question in the front of your screen. This is regarding the VIX. So friends, the question asks you that when Indian VIX increases, what usually happen to the market volume and what happened to the liquidity? So what is happening here? That Indian capital market increase in the India VIX. How it impact the market volume and the liquidity? That's the question. So we are not talking about the index level here. We are talking about the VIX, right? So option they have given, an increase in VIX usually lead to decrease in the trading volume. Option B, high India VIX level are generally associated with a surge in the Nifty option volume. Option C, they have given that Indian VIX and trading volume are inversely related. And option D, Indian VIX is a price-based sentiment indicator and has no statistical correlation with the physical volume of the contract. Very good question. So we are not talking about the index level, we are talking about the VIX. What is the VIX? V for volatility. Volatility, which is the India VIX. Okay. Then we are talking about the trading volume. And the third thing, we are interested in the liquidity dynamic. So the keyword you must focus on, increase in the Indian VIX. So VIX has increased. So now what is Indian VIX? So Indian VIX is called the PE of the Indian stock market. What we call it, there is a term that we often call it. This is called the peer gauge, okay, of the Indian stock market. What happened, when this India VIX goes up, it shows trader expect big movement in Nifty. Trader expect big movement in what? Nifty, right? And either sharp up or sharp down. So big movement, whenever Indian VIX goes up, either they expect a sharp up or a sharp down. And uncertainty between urgency to trade. So in VIX goes up, what happened? Trader expect big movement, either the sharp increase or sharp movement can be on the other side, right? So it means more uncertainty. It means more urgency to trade. More urgency to trade. And when urgency is trading activity increases, so urgency increases, right? So what happened to the trading volume? So remember, trading volume also increases. That's the correlation, right? Okay. So now how the volume relate? So Indian VIX calculates the Nifty price. Not like an institutional investor. Market uncertainty is very high. Market is very uncertain. What will happen? So fear of loss increases. Fear of loss increases. What institutions should do? They buy put option. What do they buy? The put option. Put option for hedging purpose. You know what put option is? Right. Option means buy, put option means sell. Okay. So they buy they buy this put option for protection. This causes massive demand for option. And since demand for option increases, right? So option demand increases. What happen? The premium of the option, the premium, it also increases. And what happen ultimately? That option trading volume increases. So what you observe that high India likes higher option volume. Now that's from trading volume. You can see now option trading volume has already been increased. Now let's look at the liquidity angle. So here's a tricky but very important point, that during high VIX, market move fast. So VIX is high, market move fast, and volume is also high. But liquidity quality may reduce temporarily. Why liquidity quality may reduce temporarily? Because market movement, because market maker face higher risk. Market maker, they face high risk. They widen the bid ask spread. So whatever spread is between the bid and ask rate, that get wide, and then they demand higher premium to trade. So remember, whenever I say this high VIX, it means high volume but stressed liquidity. If you look at the option, option number A says high volatility scare away institutional investor. It says that now high volatility scare away institutional investor. This is wrong. Institution actually trade more during volatile period, right? For hedging, rebalancing and arbitrage. What about option C? Option says that volume only during low VIX period. You can see. So actually this is wrong, because low VIX represent complacency. Volume often dry up in very low VIX period. Option D says that Indian VIX has no correlation with the volume. Indian VIX has no correlation with the volume. So actually, this is completely wrong. Indian VIX is built from the active coupon order, right? So remember, the correct answer to this question is none but option number B. That high India VIX are generally associated with a surge in the Nifty option volume. Okay, so B is the correct one. So you can remember it like this. Let me give you a memory trick to remember. Just remember it, that suppose you have a high VIX. It means high VIX, high fix, right? So you should fix your risk. Fix your risk. So what happens, whenever fear rises? See this logic. VIX increases, fear rises, right? Hedging increases, and option volume increases, right? So Indian VIX is a fear gauge. Rising PIS signal expected large market move. High VIX lead to heavy option hedging. I hope the concept is crystal clear. These are the now let's look at the third question of today's session. So I think this is the fourth one, and this is a numerical based question. Very good question. So friends, let's understand what the question is asking. We are being given the market price of government security. How much is the market price? 105.50 per 100 rupees face value. Okay. And then modification also they are provided 7.20. And the question is, what is PV01? That is the price value of a base point of the bond. Yeah, remember, this is not a duration question. It is a price sensitivity question, right? So options that these are the options. Now you may ask me, sir, what is the meaning of this PV0? Okay, let me explain. See, this is not just a question answer session. This is the concept building session also. I explain everything from the scratch, right? And then I explain each and every option, why one option is correct, why one option is wrong, so that you could have a complete understanding of the entire concept. See, PV01 means how much the bond price will change. How much the bond price will change if yield increases by 1 basis point. Okay. So now very important point I'm telling you, that 1 basis point, that is equal to 0.01%. That is equal to 0.0001. Right. This is not 1 basis point. 0.01%. So yield is increasing by 1 basis point. How the bond price will? I know this equation very well. I think you are familiar with this equation. That when yield increases, price decreases, and when yield decreases, price increases. So PV01 is the risk in rupee or price to not percentage. Please remember, PV01 it tells the risk in terms of rupee. So what is the formula to use? Yes, you just have to command over the formula. PV01 is equal to modified duration multiplied by bond price multiplied by 0.00001. Now let's apply the concept. What is the modified duration they have given? 7.20, right? And then price they have given, I think, how much is the price? You can see 105.50. Okay, and 1 basis point, 1 basis point, let me write down. 1 basis point is 0.0001. Okay, so now just apply the formula. So you can write it like this: PV01 is equal to 7.20 multiplied by 105.5 multiplied by 0.0001. So that gives us how much? After computation, you will get 0.07596. Yes, that's the, yes. Option number B is the right one. So it means that for every 1 basis point increase in the yield, what it clearly means that suppose your yield increased by 1 basis point. So what is happening to the bond price? It will fall approximately 0.07596. That is what I mean to say. So what is the PV01? PV01 simply means that it means what, it's a price sensitivity. How much the bond price will change if the yield change by 1 basis point. So when we get this value, what I mean to say that if the yield increases by 1 basis point, bond price will decrease by 0.07596. And how do we compute it? Write the modification. We multiply by the 1 basis point and we further multiply it by the bond price. Right? That is how we do. You can remember it like using a trick. I always use a trick to remember it. How you can remember it? PV01 is equal to D into P into what? Is equal to D into P into PV. BP, sorry. BP to be more precise. D into P into BP. Fine. So BP means what? 0.0001. So the modified duration is given. Okay, multiplied by price and then knock off the 4 decimal. Just have to modified duration multiplied by price, right? And then knock off by 4 decimal. So what we discussed, PV01 measures the price change for 1 basis point yield movement. Always use modified duration, not Macleod duration. And 1 basis point is equal to this 0.0001. Higher duration, higher interest rate risk. Now the second part of the question, same question, second part. Now let's break down the question. So treasury desk is there. They hold total face value is 10 crore. This is written in numeric term also. BPV they have given 0.05 per 100 rupees value. Market yield has risen by 5 basis points. So the question is, what is the estimated impact on the portfolio value? So what will be the impact on the portfolio value? So they can put loss of this much, gain of this much, loss of this much. This is like these options. Here we must be clear about this BPV. What is the BPV? That is the second point. So basis point value, you must understand it clearly. What is the meaning of the 1 basis point? See, when I say this BPV, it tells us how much the bond price will change for a basis point, that is 0.01% change in the yield. Right? That is what BPV is all about. So how much the bond price will fluctuate for 1 basis point change in the yield. In PV01 also I told you how much the bond price will change if the yield change by just 1 basis point. Okay. Similar concept is there, BPV, basis point value. Okay. So that means how much the bond price change for 1 basis point change in the yield. And you know the relation very well, that yield increases, then bond price decreases, and yield decreases, then bond price increases. So because yield are rising, so in this case what is happening, in this case yield are rising, because clearly they have mentioned here that yield are rising, yield have risen by how much? 5 basis point. Because yield are rising, what will be the impact? Bond price portfolio will face a loss. So what we need to do, we need to convert this total face value into per 100 unit. Okay, how do we go to do what? Because BPV is given per 100 face value, so we first calculate how many 100 units are there in the total face value, that is 10 crore divided by 100. So we write face value per 100 unit. We want to make this unit same. Okay, that is how much? I think it was 10 crore, right? 10 crore divided by 100, that will be 10 lakh units. Okay, now the first step is to compute the FB per 100 unit. Now calculate the total BPV of the portfolio, total basis point value of the portfolio. How to go about doing it? So they have clearly mentioned that per 100 rupees face value, the BPV is 0.045, right? And total face value is how much? This much. This is just 10 lakh. Just multiplied both of them. So 1 000 000 multiplied by 0.045. That will give us 45,000 rupees. That is the total BP. Total BPV. Total BPV is 45,000. Now you apply the, how much is the actual change here? Actual change is 5 basis point. Okay. So that BPV is 45,000. It means, bond price change by this amount for 1 basis point change in the yield. So this is amount for 1 basis point change in the yield, but actually yield change by 5 basis point. So how much will be the price change? just multiply it by 5. So price change will be how much? 45,000 multiplied by 5. That will give you 2,25,000. Okay, so wait, look carefully. Actually, this is wrong. I think this is not 45,000, 4,500. So 1 0 will reduce. 2,25,000. Sorry, 22,500. The correct answer is 22,500. Yes, the correct answer is option number A. Right. Correct answer is option number A. And obviously there will be loss because yield. So yield rose. Now you may think about the direction. So yield increases. So bond price fall and the bond price falls. So this is a loss because the investor want bond price to increase. So this is a loss for them. Okay. I hope it is crystal clear. Now so remember, just you can remember this formula like this: BPV multiplied by BPS is equal to price impact. Okay, BPV basis point value, and we have multiplied by the BPS change, basis point change. How much the basis point has changed? 5 basis point in this particular case. That will give you the price impact. And one more thing, yield up, price down. More basis point multiplied by BPV. Now the third question of the same, given 850 and the market value is 10,20,000. The question is the modified duration of this position. So remember, DV01 is already calculated. We only need to reverse the formula to find the modified duration. What is this DV01? Let me explain. See, when I say this DV01, it means how the value of the bond will change if the yield change by 1 basis point. Right. So DV01 means value of bond, how it will be changed if the yield change by how much? 1 basis point, or we can call it 0.01%. So DV01 we can call it, price sensitivity. We can call it price sensitivity, and this is always measured in the currency term. See, in this case what is happening, that we are talking about the value of the bond will change, DV01. Okay, in the previous case we talked about the price of the bond and yield change by 1 basis point. So it is a price sensitivity measured in currency term. And what modified duration tells us? Modified duration tells us percentage price change for 1% change in the yield. So modified duration always tells us the percentage price change. Please understand, percentage price change. Okay, so it tells us that, so see, price will change by this much percentage for 1% change in yield. So both are directly connected by a formula. And what is the linkage of the formula? Let me write it down. So you can write it like this: DV01 is equal to modified duration multiplied by the market value multiplied by the 0.001. That's it. Okay, now you can rearrange the formula. You can rearrange it like this: MD is equal to DV01 upon market value multiplied by 0.001. Okay, now just put the value. So DV01 is 850 and market value, how much they have given? Market value is I think 10,20,000, right? It is 10,20,000 multiplied by 0.001. This gives us how much? So if you look at the denominator, that is 102. So that gives us 8.33 as the modified duration. So if you look at the option, what are the options they have provided? Yes, 8.33 is the correct answer. That's the correct. So remember, DV01 is equal to duration multiplied by value multiplied by BP, and BP is always how much? 0.0001. Okay, so if DV01 is given, divide by market value and knock off the 4 decimal. So it measures rupee or price change for 1 BP. Okay, that's the point. Now let's look at the next question. So we have computed the DV01 also, and in the previous case we have computed the PV01 also. Now one question may arise in your mind: sir, what is the difference between DV01 and PV01? Okay, so in that case I told you this is not a duration. PV duration means how the bond price will change if the yield change by just 1 basis point. That is what PV duration is all about. PV01 is all about. Okay, and in that case what formula we use? Same formula: modified duration multiplied by bond price multiplied by basis point. But in this case we are not using the bond price, we are using the market value. That's the difference. Okay, so here the point is market value, dollar value of basis point. So here we are using the market value, there we were using the bond price. That was with respect to the bond price. Okay, that's the difference. Formula is equally simple, similar, no difference in the formula. Now the next question we have is regarding the IBPC. Very good question. That's called interbank participation certificate. So what it is all about, that in the context of IBPC, which of the following statement correctly describe the regulatory framework regarding the risk sharing and asset classification? So option they have given, IBPC is who without risk sharing can have a tenure exceeding 180 days to help the bank meet long-term liquidity requirement. Then in an IBPC with risk sharing, the participating or buying bank must treat the amount as a loan in advance. For option C, for IBPC issued with risk sharing, the health code of the underlying crop loan or SME loan remain the responsibility of the issuing bank. And option D, IBPC can be issued to non-banking financial company and mutual fund to broaden the secondary market for priority sectors. These are 4 options, and you have to select the correct one, correctly describe. So see, before getting into detail of this question, let me first explain what this IBPC is all about. So remember, IBPC are the instrument through which one bank sell participation in its loan portfolio. Right, let me write it down. IBPC are the instrument through which, this is the one bank number 1, they sell participation in the loan portfolio, and this is the bank number 2. What they do, they buy participation. So this is buyer and this is the seller. Okay, mainly it is used for priority sector lending management. Okay, and it also used for liquidity and risk distribution. Between the banks. So that's the point. So what we have discussed so far, that IBPC are instrument through which one bank is selling participation, other bank is buying participation. Mainly it is used for priority sector lending and liquidity and risk distribution between the bank. And IBPC are only issued between bank. Please remember, this is the bank 1, this is the bank 2. Okay. Priority sector lending management is the main objective. Now there are 2 kind of IBPC. One is called with risk sharing. One is called with risk sharing. So what is the meaning of it with risk sharing? That means buyer, that is the participant bank, they share the credit risk. So in the case of risk sharing, the buyer share the credit risk. And suppose the loan become NPA, the loss is shared proportionally. Okay. So when with a buyer, the bank share the credit risk, and loan become NPA, loss is shared proportionally. And usually this with risk sharing is used for PSL, and tenure is usually 90 to 180 days. That is with risk sharing. Now the second kind of IBPC is without risk sharing, which means what, that buyer never take any kind of credit risk. Buyer does not take a credit risk, means no risk of default. So risk remain with whom? Risk remain with the issuing bank, whoever has issued this certificate. Okay, and it acts like a short-term interbank borrowing, less than 90 days. Now, asset classification. This is the most tested concept. Very, very important thing. Let me explain. So regarding the concept regarding the asset classification, that even when IBPC is issued, issuing bank remain the loan manager. Okay, so what they do, they monitor, they recover, and they do the asset classification. So participant bank only share the risk but does not classify the asset independently. If you look at the option that they have provided, option number A says that IBPC issued without risk sharing can exceed 180 days. This is wrong, because without risk sharing is always less than 90 days. Maximum tenure is 90 days only. Option number B says that is 3 months. B says that participant treated like a loan. So asset classification, just now I told you that even when issuing bank remain the loan manager, monitoring, recovery, asset classification done by the issuing bank, right? Participant bank only share the risk but does not classify the asset properly. So if you look at the option B, what it is taking, it is telling that participating bank, they treat the amount as a loan. Issuer remove asset from the balance sheet. No, that's wrong. Issuing bank never loses management responsibility. Management responsibility always lie with the issuing bank, right? And asset cannot be fully de-recognized. What about option C? For an IBPC with risk sharing, the health code of underlying crop or SME loan remain the responsibility of the issuing bank. Yes, correct. C is the perfectly correct. And option D says that IBPC can be issued to NBFC and mutual fund. It is completely wrong. I think we have already discussed that IBPC is a kind of instrument which are interbank only, right? It can never be issued to NBFC or any kind of mutual fund, right? So what we learned from this discussion is that there is a very important learning. Let me write down, right? We got to learn that, you cannot, risk can be shared, right? Risk can be shared, right? But responsibility cannot be shared. Very important line. Responsibility cannot be shared. You can share the risk, but you cannot share the responsibility. Or remember that IBPC with the risk sharing, loss is shared, classification is never shared. So responsibility means what? Responsibility means classification. You never share the classification. You share the risk, and that too with a risk. So what we have discussed regarding IBPC, let me just summarize the point. So they are, bank to bank instrument. Two types I told you, without risk and with risk. So in the case of with risk, what happened? The credit risk is shared. So risk is sharing happen, and asset classification remained with the issuing bank. Issuing bank asset classification. I hope this is crystal clear. Now, very good question. Last question of today's discussion. We have many much question available that will be available in our paid course. If you want to get answer to all this question, you can join our paid course, and surely many aspirants have cracked the paper. You can also crack in the very first attempt. Let's look at the question. In the context of the Government of India debt instrument, which of the following statement correctly distinguish the CMB from a treasury bill? Cash management bill and treasury bill difference they are asking. So option number A, the T-bill are issued to fund the long-term fiscal deficit. TMBs are issued strictly to manage temporary mismatch. Option B, TMB have a fixed standard tenor, while CMB are non-standard and are typically issued for tenor less than 91 days. Option C, CMB are issued eligible for a statutory liquidity ratio, while T-bill are considered part of the STM portfolio. Option number D, T-bill are issued at a discount to face value, while CMB are interest-bearing instrument. Very good question. So first of all, this question is focus area are, tenor, purpose and issuance pattern. So, both T-bill and CMB, who issue them? Either you call it T-bill or you call it CMB. Both are issued by the Government of India. Both are, short-term borrowing instrument. Both are, zero coupon security. No interest. Zero coupon means you will not get any interest. And they are issued at a discount and redeemed at the par. But why do we have two similar instruments? Yes, you look at, there is much similarity, but why do we have different instruments? See, because their tenor and predictability differ. See, in the case of T-bill, what happened, it is very much predictable. This is very much predictable. They are issued in a fixed tenor, like 91 days, 182 days and 364 days. And auction calendar is announced. Their auction calendar, they are announced in advance. And this is the regular part of the government borrowing program. But if you look at the CMB, this was started way back in the year 2010 and issued only when required. When required, they are issued. Okay, there is no any time schedule for CMB. And tenor is flexible. And tenor is always less than 91 days. They are used to match the temporary cash flow mismatch. Okay, so they are used to match the temporary cash flow mismatch. So it is a kind of short-term liquidity tool. So if you look at the option, A says that treasury bill are used to fund the fiscal deficit. No. Both of them are short-term instrument, not long-term deficit tool. C says that CMB are eligible for SLR. No, that's wrong. Both are eligible for SLR. Both are SLR eligible. D says that CMB are interest-bearing instrument. No. Nothing give you interest. Actually, both are, discounting instrument, zero coupon instrument. Zero coupon means they don't provide you any coupon. Okay. So remember, there's a trick you can use to remember it like this. You can think of T-bill like a 3 tenor. 3 tenor, isn't it? 91, 182 and 364. And CMB, you can call it, cash mismatch bill. This is my definition. Cash mismatch bill. Right. So issue only when cash gap suddenly appear. So that is all we need to learn from this particular chapter. We have some more questions that will be available in our paid course. For more detail, you can WhatsApp me on this particular.
Greenway Energy, it is a renewable energy firm. They issued a 10-year corporate bond 4 years ago. The detail of the bond at the time of issuance were like this. Face value $1 lakh, coupon rate 8%, maturity 10 years, right? And currently the market interest rate for a similar risk profile bond have risen to 10%. As a result, the bond is trading at a discount in the secondary market. and investor Sarah is considering buying this bond at the current market price of $920. The bond now has 6 years remaining until maturity. So the first question is asked. So this is a set of two questions. What is the current yield of the Greenway Energy bond based on Sarah purchase price? So first of all, what are the data that have been given? Let me just write it down. So data they have given you is the face value. So FB, let me write it down. Face value they have given $1,000. Okay. Coupon rate they have given how much? Coupon rate is 8%. Okay. And current market price is how much? Current market price they have given, how much is they have given current market price? $920. Right. Current market price they have given $920. Okay. And remaining maturity is how much? 6 years. Okay. And Sarah want to buy this bond at $920. So we need to find the current yield. So how to go about finding the current yield? So what is the current yield? Current yield means, annual return. Whenever I say current yield, it means, annual return based on the current market price. So the formula is very simple. To compute the current yield, what you need to do? In the numerator, you write the annual coupon. In the numerator, you write the annual coupon. And in the denominator, you write the current market price. That's it. So what is your annual coupon here? So as you can see, the annual coupon they have given is, yes, first of all, let's compute the annual coupon. So it is very simple. Coupon rate have been mentioned 8% and face value is $1,000. So obviously 8% of $1,000. So that would be how much? I think it will be 80 rupees, $80. So $80 is the annual coupon, right? So annual coupon is $80. Just apply the formula. So this coupon yield, current yield will be 80 divided by 920, isn't it? 80 divided by 920. What is 920? 920 is the current market price. So 80 divided by 920, that will give you 8.70%. Right. So the correct answer to this question is 8.70%, option number C. So current yield of the Greenway Energy bond is 8.70%. I hope it is crystal clear. So whenever a question asks you about current yield, there is a trick to remember. You can think about it like coupon over current. Coupon over current. So just remember the formula. Coupon divided by current price. Right. C over C. C over C. That's it. So coupon over current. That is the formula for computing the current yield. Now let's have a look at the second question. So the same data, you have to use the same data. You have to apply the approximation formula and you have to tell what is the YTM or yield to maturity if the Sarah hold the bond until it mature in 6 years. Option they have given 9.15, 9.72, 10.05, 10.42. So YTM, the question is regarding the yield to maturity. So what is happening here, Sarah buy the bond for $920. Face value they have given is $1,000. Right. Coupon rate is how much? 8%. And 6 years remains till maturity. So time till maturity, how much time is remaining? I think it is 6 years. Right. Please understand. So basically, we need YTM if she hold it till maturity. So what we need? We need YTM if she hold it till maturity. YTM is obviously, if you are holding till maturity, then only YTM comes into picture. So what is YTM? You know what is YTM? YTM is the total return. YTM is the total return that Sarah will earn. Total return that Sarah will earn if she keep the bond till maturity. Right. So YTM includes annual coupon. It includes annual coupon plus it also includes the capital gain. So it includes both the thing. Right. So what is the approximation formula for YTM? Let me tell you. The approximation formula for YTM is like this. C plus F minus P upon N upon F plus P divided by 2. Right. So this is the formula. This is the formula for, approximation for YTM. What is C? C is the coupon, annual coupon. So annual coupon is how much? Just now we have computed. I think it was $80, right? So annual coupon is $80. What is F? F is the face value, right? So face value, I think they have given $1,000. What is P? Purchase price $920. What is N? Number of year till maturity. So number of year till maturity is 6 year, because 6 year is remaining, right? 6 year. So now let's see. Let's plug the value. So coupon, we know coupon is $80. So first of all, let's come to capital. What is the capital gain per year? See, face value is $1,000, and purchase price is $920. So 1,000 minus 920 over 6 year. So that will be 80 over 6. That will be near about 13.33. So what is our numerator? So numerator is, if you look at the numerator, so numerator is 80 plus 13.33, right? 80 plus 13.33, which is 93.33. And what is our denominator? Denominator is the average price. Denominator is the average price. What is the average price? Which is the face value plus purchase price divided by 2. That is equal to 960. So what is YTM? YTM is the numerator divided by denominator. 93.33 upon 960, which is equal to 0.0972, which is equal to 9.72 percentage. So the correct answer is option number B. 9.72% is option number B is correct. So this is how we compute YTM. So one trick to remember the formula for YTM is simple. Think of coupon plus gain over, right? Think of coupon plus gain over average price, right?
Now friends, we will solve a practical question on forward rate agreement. So let's get started with the question. So first of all, understand the question. What is happening here? That Apex Manufacturing, which plan to take out a 10,000, I think it is not 10,000, it is 10 crore dollar floating rate loan in 3 months for a duration of 6 months. To protect itself against a potential rise in the interest rate, Apex enter into a 3/9 FRA with a bank. And some data have been given. Notional principal is the same. So because you can see it is 100 lakh, or you can call it 1 crore, right? Same thing. And FRA rate they have given you 5.50%. Day count convention is 360 days, right? So after 3 months, what happened? The market reference rate, which is 6-month LIBOR, is found to be 6.25% per annum. So the question they are asking you, what is the settlement amount that Apex Manufacturing will receive from or pay to the bank? So that is, you have been asked to compute the settlement amount. So option they have given: Apex pay $36,215, Apex receive $36,373, Apex receive $37,500, Apex receive $36,364. So these are the 4 options that they have given you. So this is the question. Let's understand. Let's write down the key points. And you are, I think you are familiar with the formula that we will use. So as you can see, notional principal is given to you is nothing but 100 lakh. Okay, and FRA rate has also been given. What is the value of FRA rate? 5.50%. As you can see it here. Yes, you can see it is 5.50%. Third point is that they have also given the market rate. How much is the market rate? Market rate, it is linked to 6-month LIBOR, which is 6.25% per annum. The market rate and this FRA rate. So what you can see, so please compare the market rate and FRA rate. So as you can see here, that the market rate exceed the FRA rate, isn't it? Market rate is exceeding the FRA rate. So what does it mean? Since the market rate is higher than agreed, so this is the agreed rate. So FRA rate is the agreed rate that both these parties agreed, and the market rate is higher than the FRA rate. So what will happen? So in this case, what will happen? In this case, basically the Apex will receive money from the bank, isn't it? Apex will receive money from bank. Okay. since market rate is exceeding the FRA rate, so Apex will receive money from the bank. So what is Apex? You know, Apex is a manufacturing is firm, right? It is a manufacturing firm, as you can see. So it will receive money from the bank. Now the question is how much? That is what the question is asking you. What is the settlement amount, right? How much they will receive? So since the market rate is higher than the agreed rate, Apex will receive money from the bank. Now the question is, let's compute how much they will receive, isn't it? So how to compute that? So it's very simple. First of all, what you do, you see the differential. First of all, you calculate the differential, right? You calculate the differential. So what is the differential? Just see the difference. This is 6.25% minus 5.50%, which is equal to 0.75%, or you can call it 0.0075. Okay, so that is the interest differential. You can call it, to be more precise, you can call it interest differential. Second thing is calculate the future value of payoff. See the steps. This is exactly the same step you have to follow. So second thing you have to compute is the future value of payoff. Future value of payoff undiscounted. So what will the future value of payoff undiscounted? So it is very simple. First of all, you take the 1 crore, okay, and then you write 0.0075, which is the differential rate, and for how many days they have given. Let me show you. So the days they have mentioned, obviously you have to day count 360 days, but in this particular question, after 3 months they have mentioned, right? After 3 months the reference rate is found to be. So 3 months means what? How many days? Okay, so what is the settlement amount manufacturing will receive? And floating rate also. Okay, for duration they have given 6 months. Here you can see duration is 6 months. So friends, duration they have given 6 months. So 6 months is equivalent to, I think it 180 days. So we have to compute the future value of payoff on the basis of this 180 days. 180 divided by 360. Okay, so that will give you $37,500. That is the future value of payoff, right? $37,500. Now what we need to do? We need to discount to the present value. We need to discount it to the present value. How to go about discounting to the present value? So you know it very well that FRA is settled at the start of the loan. FRA is always settled at the start of the loan. So we discount using the market rate. What is the market rate? The market rate is now 6.25%. So use it for discounting. So let's finally find the settlement amount. So settlement amount, what is the formula to compute settlement amount? Let me write it down. So settlement amount is equal to 37,500 divided by 1 plus 0.0625 multiplied by 180 upon 360. That will give you 37,500 upon 1.03125, which is near about 36364. That's it, right? So this is the amount that Apex will receive. This is the amount that Apex will receive, 36364. Let's see the option that they have given. So pay 36225, no, wrong. Option number B, receives 36364. Yes, D number is correct, right? So what is the memory trick for FRA settlement question? The memory trick is very simple. Let me just write it down. So what you have to see? So first of all, you have to calculate, you have to see the difference. First of all, you have to write down the difference multiplied by principal and multiplied by time, right? Difference principal and time. That is what we have done here in this particular formula, as you can see. So this is our difference, this is our principal, and this is our time, right? So rate difference multiplied by principal and time, and then finally we have to discount it using the market rate. This is what we have done, discounting using the market rate. So just remember the keyword DPT. This way you can remember it. DPT, which means discount after principal time calculation, right? So quick summary, just have a quick let's look at the quick summary. First thing, we have to compute the FRA settlement is the present value of the interest difference. So if you want me to write a single formula which in capture everything. So first of all, you write the notional amount multiplied by market rate, subtract the FRA rate, right? So these are the rates multiplied by days upon 360 and divided by what, 1 plus market rate into days upon 360. So this is the formula that you can use to compute the settlement amount. So in this particular case, the final settlement amount that we got is how much? That is how much? 36364. Option number D is the correct one. I hope this question is crystal clear now. Every aspect we have touched one by one. Friends, let's switch our focus to the third question. Friends, let me tell you, if you are obviously preparing for CTP and if you want last minute revision points, all unit wise theory, unit wise MCQs, such kind of previous year memory based question, you can WhatsApp me on this number for more detail, or you can check out our course on CTP, using which many aspirants have cracked the paper on the very first attempt. So now let's see the third question that we have. So this question, what is happening? That they have mentioned that Apex agreed to borrow at 5.50%. Okay, earlier also that was the FRA rate, right? So what was the, so this question is also second part of the earlier one. So FRA rate, it is the same, which is 5.50%. And that means, this particular Apex agreed to borrow at 5.50% using FRA. But what happened? Let's have a look. So in this case, what happened at the end of the 3-month period, right? It has fallen to 5%. So actual 6-month LIBOR is 5%. So in this case, let me write it down. This is the FRA rate. And what is the market rate? Market rate is just 5%. So now you can check in this case that FRA rate so you can check out easily that FRA rate is higher than the market rate, right? Or market rate is lower than the FRA rate. Both way you can say the same thing. So who pays whom? That's the question. Who pays whom, right? So since Apex logged in higher rate, isn't it? They have logged the rate 5.50% higher rate. So Apex compensate the bank for the difference. So because they logged the higher rate, he says that I will buy at this rate and the market rate is just 5%. So obviously what Apex will do? Apex will pay the bank and Apex will compensate the bank. Apex has to compensate the bank, right, for the difference. So let's compute step by step. Okay, so what you have to compute? You have to compute the interest rate difference. How to go about computing it? Let me explain. So we have to compute the interest difference. See how to go about computing the interest difference. So you can see they have mentioned that 6-month LIBOR has fallen to 5% and the FRA rate. So just find the difference, right? FRA rate is how much? 5.50. Market rate is how much? 5%. So difference will be how much? 5.50 minus 5%. That is equal to how much? 0.5%. Now second thing we have to compute is the undiscounted payoff. What is the payoff? So the amount is the same, 1 crore. So amount remained the same and just multiplied by 0.0, because you can convert this percentage to decimal, it will be 0.005, isn't it? Multiplied by 180 upon 360, right? So just after computation you will get $25,000. That's the payoff, right? That's the payoff. And the final third step which we have to apply here is the discounting. Discount to the present value, right? Discount to the present value. So if you discount it to the present value, the final settlement amount will be how much? $25,000 is how much? 25,000 in the numerator. In the denominator, 1 plus 0.05 multiplied by 180 upon 360. तो ये आपको दे देगा वैल्यू 25,000 divided by 1.025. That will be $24,390. That will be our discounting value. So how much the bank received? Bank received $24,390. That's the correct answer. So Apex option they have given, Apex would receive a settlement payment. No. The bank would receive, yes, correct. B number is the correct one. Bank will receive how much? 24,390. Now let's look at the next question that we have. So the next question is related to the duration, one of the super important topic from where question are asked every year in the examination. So let's do one practical question on duration. So what they have given is that, Zenith Capital, right? So Zenith Capital, they have a you can see 15-year bond with 7% coupon, and the coupon is paid annually. And also they have given the face value of $1,000. Face value they have mentioned is $1,000. So obviously, as you can see, they are currently trading at par value. They are trading at the par value. So what is the YTM? YTM is also 7%. So see, this is the peculiarity of the question, because they have mentioned the bond is trading as a par value. So that means YTM is also 7%. Right. So let me just summarize the key point. You can see Macleod duration is this much, modified duration is this much, and convexity also they have given. And one more thing is that basically David is preparing for the potential shift in the market where interest rates are expected to increase significantly by 100 basis points. So let's write down the key points which we have seen here. So let's summarize. Basically 15-year bond they have given. 15-year bond, first point. Second point is the coupon they have given 7% coupon. Third point is face value they have given. Face value is how much? $1,000. Right. And clearly they have given that trading at par. So YTM they have given 7%. Right. So YTM is 7%. Then let's compute the what is the expected percentage change in the bond pricing using the modified duration. What the question is asking? The first question is we have to impact of duration. So using the modified duration only, what is the estimated percentage change, right? Estimated percentage change in the bond price if the interest increase by 150 basis point. That's the question. So now let's first of all understand what is the meaning of this modified duration. Let's first of all understand the meaning of the modified duration. Whenever I say modified duration, it tells us how sensitive the bond price is with respect to interest rate change. How sensitive the bond price is with respect to interest rate change. Please understand. So what is the formula to compute modified duration? So formula is very simple. As you can see, percentage change in price is equal to negative of modified duration multiplied by change in yield, isn't it? Now one thing you can see here that they have given the negative sign. What does it indicate? Negative sign because price and yield, price and interest rate they move basically opposite. That's why negative sign is there. So let's plug in the value. Percentage change in price is equal to minus of MD. How much MD they have given? Let me show you. So MD they have given is just wait a minute. So I think modified duration, yes, here you can see 9.11 year. Okay, 9.11 year. Let me just write it down. So so this minus 9.11 multiplied by percentage yield. Yield, as they have mentioned, clearly mentioned that yield have yield where the bond price if the interest rate increased by 150 basis point. Yes, so they have mentioned 150 basis point, right? So you can write the yield as yield as 0.015. That's 150 basis point. Okay, so 0.015. So either you can write, see, 150 basis point means what? 150 BPS means 1.5%, or 1.5% means just divided by 100, it will be 0.015. So that is how 150 BPS is equal to 0.015. Right. So I hope this is crystal clear right now. So now just plug in the value. So what is the final value we are getting? That we are getting is minus 0.13665. right? Or we can also write it like another way to write it like in terms of percentage, right? Minus 13.67%. So what we are observing is that bond price is decreased by 13.67%. so if you look at the option that we have, yes, B is the correct one. 13.67% is the correct one, right? I hope this is crystal clear. So what we have learned from this question, so minus duration into yield change first thing. So whenever the question asks you to compute the price change, just write minus D into delta Y. That's it, right? So let's quickly revise the key points. So what I told you that this modified duration represent the sensitivity of bond price to interest rate change. It shows the sensitivity of what? Bond price with respect to what? Interest rate change. Second thing I told you that please understand, if the rate increases, interest rate increases, bond price will go down. That's why negative sign. In this particular case, interest rate increased by 1.5%. So price dropped by how much? 13.67%. That is what we are observing. Is it clear? I hope it is clear. Now let's do one more question based on convexity adjustment. Very, very important. So the question is again, interest rate increased by 1.5 percentage or 150 basis point. And convexity they have also given you. How much is the convexity? Convexity they have given, I think yes, you can see convexity they have mentioned is 115.33. that is the approximate convexity, isn't it? So first of all, let's understand what is the meaning of this term so called convexity. What is the meaning of this convexity? First of all, let's understand. So what is the convexity adjustment? First of all, let's understand what is the meaning of convexity. Convexity measures the curvature. It measures the curvature of the price yield relationship, right? Curvature of the price yield relationship. So when rate change a lot, the actual price change is slightly different from the straight line estimate given by duration. See, obviously whenever you compute the duration, whenever you use the duration to compute the price change, so duration assume a straight line estimate, but in actual what happened, it follow the curvature, right? So when the rate changes a lot, so suppose interest rate is changing a lot, what will happen? The actual price changes slightly. So when the rate changes a lot, what happened? That the actual price change is slightly different. So price change is slightly different from what duration computes. Okay. So the what happened, for suppose we have a positive convexity bond, suppose we have a positive convexity bond. So in that case, what will happen? Actual price is higher than the duration estimate, right? So in this case, actual price is higher than the price estimated by duration, right? So what we do, we add the convexity adjustment. Please understand, this is a very important thing I'm talking about. So in this case, we add the convexity adjustment. The reason being yet actual price is higher than the price duration. Now you may ask me, what is this formula for convexity adjustment? Let me write it down. So formula for convexity adjustment is just simple. Half of convexity into delta yield square. So half of convexity into delta yield square. Just plug in the value. Half means 0.5. What is the convexity? 115.33. What is delta yield? I think it is 0.015 square, right? 150 basis point. So if you compute it, this will give you 0.01297, or approximately we can say 1.30%. So the correct adjustment is plus, obviously it is plus 1.30%. So option number B, I think, is correct. So yes, B option is correct, that is 1.30%. Now there is a memory trick to remember the formula for computing the convexity. What is the memory trick? Let me write it down. Half, first of all, write half multiplied by convexity and take the square of yield. Take the square of yield change. So half of convexity multiplied by square of yield change. Now you may ask me why we have done the square. So because convexity deals with curvature and convexity never deals with a straight line. I already told you convexity always deals with what convexity always deals with a curvature. And convexity never deals with a straight line. That's why a square. So adjustment, whenever the question asks you to compute the adjustment, just remember the simple formula, half into convexity into delta yield square. So let me quickly summarize the key learning from this question, that convexity improve the accuracy of price change estimate for a larger interest rate move. Yes, the one of the biggest advantage of convexity is the improving the accuracy, is improving the accuracy. Second thing, I told you the formula which is written here, half into so that's the point. Now second thing is improving the accuracy formula. Just I told you, half into convexity into delta yield square. And I told you positive convexity means what? Adjustment is added. Positive convexity means what? Adjustment is added to the duration estimate. In this particular case, the adjustment is 1.30%. Now let's look at the third question of the same data. From the same data, you have to compute the third question. Very good, right? So let's compute the impact of duration and convexity adjustment separately. So now friends, convexity. So now let's combine the impact of duration and convexity adjustment separately. So earlier what we have done in the first question, what we have seen in the first question, we have seen the what is the impact of duration, right? And second question, we have seen the impact of convexity adjustment to the price change, isn't it? The same thing we have done. Okay, now let's combine both of them, right? So what is the situation is the same, right? The situation is the same. Let me write it down. What is the situation? So what we have seen is that your interest rate, just let me write IR, your interest rate increased by 150 bps, or we can say 1.50%. So we have seen that duration effect on price is that how much? Minus 13.67%. Let me show you. See, the first question we have done, right? The first question we have just computed that the effect of duration is percentage change in price 13.67% negative. And the second question, convexity effect, we have seen 1.30%, right? So duration effect minus 13.67 and convexity adjustment is how much? 1.30% plus 1.30%. Now the question is asking what is the total estimated what is the total estimated percentage change in the bond price considering both of the case. So duration effect, we already know that from the first question that bond price drop by negative sign clearly indicate that bond price has decreased due to the duration. And convexity adjustment, from the second question, convexity add back plus 1.30% because the actual price is slightly higher than the straight line estimate. See what is happening, actual price is slightly higher than the straight line estimate. So that's why convexity add back 1.30%. So you combine both of them. So you combine. So total change is how much? So total change is, you just combine the effect of both the duration and convexity adjustment. So duration effect plus convexity adjustment effect. So that is how much, minus 1.3667. Let me write it down. Minus 13.67% plus 1.30% minus 12.37%. That's our answer. So what is happening ultimately, that bond price is falling. This negative sign increase that, bond price is falling by how much? 12.37%. Yes, B is correct one. So convexity, soften the blows of the interest rate hike. Without convexity, the drop was how much? Without convexity, the drop was, let me write it down. So convexity, what it has done, it has softened the blow of the interest. Without convexity, the drop was 13.67%. But with convexity, it is only minus 12.37%. So duration gives you the big picture.
convexity fine tune it, and the total change is the sum of both of them, duration effect plus convexity effect, which is minus 12.37%. I hope it is crystal clear. Now, one more question based on the same data. This is the kind of case study which we are doing right now. Suppose the bond current market price is $1,000. What is the price base value of the basis point? That's called PVBP. Very good question. So bond price they have given you. Modified duration already we know. So here we have to apply the modified duration data. So what is the modified duration data? Let me show you. Just wait a minute. Yes, 9.11 year. McLaw was 9.7%. Modify is 9.11 year. Right. So let's apply this 9.11 year. Okay. So first of all, let's understand the meaning of this so-called, PVBP, price value of basis point. You know the meaning of it. Let me explain. What is the meaning of this PVBP? So basically it tells us how much the bond price change in dollar. How much the bond price change in dollar when the yield change by 1 basis point. So basically whenever you talk about PVBP, it means, simple meaning is that how much the bond price change in dollar when the yield change by 1 basis point. So the formula is very simple. What is the formula to compute the PVBP? Let me just write it down, the formula. PVBP is equal to modified duration multiplied by price multiplied by 0001. So you may ask me why we have written this 0001. So this means 1 basis point in decimal. So 1 basis point is very well 0.01 rupees. Just divide it by 100. So 1 basis point. Just now plug in the value. So 9.11 is the modified duration. Price we have given. $9.11 multiplied by 1000 and just multiplied by 0.0001. That will be how much? 9.11 multiplied by 0.1, which is equal to 0.911. So $0.91, right? $0.91. The PVP we have got is $0.91. Option number A is correct. So remember, whenever the question asks you to compute the PVBP, price value of a basis point, just do one thing. First of all, write the duration multiplied by price and multiplied by 0. So called, NOOP, right? That is called net overnight open position. Don't worry, by the end of this question, you will understand it the simplest way possible. So the question is, which of the following statement correctly describe the NOOP limits applicable to the bank? Let's go through option by option. Option A say NOOP limit is fixed by RBI and apply only to onshore exposure of the Indian bank. Option B say NOOP limit is the maximum allowed foreign exchange exposure a bank can keep overnight and should not exceed 25% of the bank total capital. Option C say NOOP limit include only derivative transaction such as forward and option excluding a spot transaction. Option D say NOOP limit do not apply to offshore branches of Indian bank. So we have to answer that. First of all, option number A. So this statement sounds partly correct, but is actually wrong. Why? Because RBI gives guideline. Remember what RBI does, RBI gives guideline. Okay. But each bank board decide its own NOOP limits within the RBI overall cap. So cap is provided by the RBI, and the board of bank, they decide, right? That every board decide its own NOOP. Also, NOOP apply to both onshore. Remember, it apply to both onshore as well as offshore exposure, right? So the bank has to consider its total foreign exchange exposure both inside and outside India. So let me give you one example. Let's suppose SBI. SBI has a branch in India, right? That is called onshore, and it also has a branch in Singapore, right? So that is called offshore. Both branches deal in dollar, right?
So the total USD exposure in India plus Singapore together count toward the NWP limit. So why? That's why, option number A is right, is wrong, partially wrong, because it says that fixed by RBI. No, this is wrong, because fixed by the, actually RBI gives a cap, but actually it is fixed by the on bank board management and applies only to the onshore operation. This is completely wrong. What about option B? Option B says, see, this statement is correct. Why? Because here are some keywords. The first word is overnight. Here you can see the word overnight they have written. So what is the meaning of this word overnight? Let me explain here. So overnight means, position the bank carry when the forex market get closed. That is called overnight position. That means position that the bank carry when the forex market get closed. Then you will see the word NWP limits. What does it mean? It means, it ensures that bank don't take excessive currency risk. Yes. So that's why this NWP limits is there. NWP limit is there to ensure that bank do not carry excessive currency risk. Because, currency value can fluctuate when market will reopen. When market will reopen, currency value will fluctuate continuously. And one more point they have written, the limit cannot exceed 25% of the bank total capital. Yes, this is also correct. Right. It's like, safety limit to make sure that bank don't bet too heavily on currency movement overnight. So all these three terms are very good, are correct. So first of all, it is overnight, which means the position that the bank carry when the forex market is closed. Second thing is NWP limit, which ensure that bank don't take excessive, currency risk. And the limit cannot be more than 25% of the bank total capital. Yes, it is wholly correct. Option number B is completely correct. What about C? C option says that, NWP limits include only derivative transaction. This is wrong. This is incorrect. Let me highlight it. This option number C is incorrect. Why it is incorrect? Because, if I tell you that, NWP limits cover all kind of foreign exchange transaction. Remember, it cover all kinds of forex transaction, whether it is spot, whether it is forward, right, or whether it is derivative, right. So everything get covered, because whether it is forward contract or a simple currency purchase, it all adds to the bank total exposure, right. So you can think of NWP as the total foreign currency balance that the bank is holding. It does not matter how it got that exposure. What it is saying, it includes only derivative transaction. No, that's why it is wrong. What about option D? It says that it does not apply to offshore branch. Again, it is wrong. I told you now. And NWP does apply to offshore branch. However, offshore exposure are not netted off against the onshore exposure. Remember, this is the very important thing. Some people think that, there are some offshore exposure, and there are some onshore exposure. But, netting off is not done. They are not netted off, right? This means that offshore exposure is seen separately, but the total of both the onshore and offshore exposure must stay within the limit. So let me give you one example. Suppose there is a bank named ABC Bank. Okay. It has $10 million in India. Okay. In India. And suppose it has $5 million in its Dubai branch. Okay. So the total exposure is how much? Total exposure is $15 million. Right. Both count toward NWP. So both of them will count toward net overnight limit. Net, right. So I told you the full form of NWP, you remember it? Right, net overnight open position. Both of them will count toward the NWP, right? So that's why the correct answer to this question is option number B. So what we learned from this question, let me just summarize you. So I told you that. So friends, what we learned that, this NWP is just like a, it is just like a safety cap, right? On how much foreign currency exposure a bank can hold overnight. It protects the bank from losses due to currency rate change, right? It protects the bank from losses due to currency rate changes when market are closed. Now, it is set by the bank board. I told you now, it is set by the bank board and it cannot exceed 25% of total capital, right? And now, it applies to, sorry for my handwriting, but I am telling you, it applies to both onshore and offshore, branches. And it includes all the kinds of forex transaction, whether it is spot, forward, derivative, etc. So the next time someone asks you what NWP limit means, just say it's like a nighttime safety lock on how much currency risk a bank can carry. That's it, right? I hope this is crystal clear. So friends, please hit the like button. And if you want a study material for CTP, then you can check our course which is available on my JIB and CIB Made Simple app. The link is provided in the description section. You can see the content. We have theory and MCQ PDF which cover the entire syllabus. Previous year question already three PDF I have added, and this one will be fourth one, right? And also I have added capsule content which contain module wise quick revision notes, module A, module B, C to E, F and G. So through this course, many aspirants have cracked the paper, right? And also we are offering 10% discount. For more detail, you can WhatsApp me on this particular number. Let me show you the number. So now let's move to the next question that we have, which is regarding FRA. So please note down the number if you want. If you have any query related to this CTP, you can WhatsApp me on this particular number. So the second question is, which of the following statement about FRA is correct? FRA, forward rate agreement, right? Sounds technical, right? Don't worry. By the end of this slide, you will understand in plain English what it means, how it works, how to remember it easily. So option number A says that, FRA settled periodically through multiple interest payment over the contract duration, similar to an IRS. Option B say, FRA is a forward contract to fix the interest rate for a single future interest period, with settlement occurring at the start of that period based on the difference between the agreed fixed rate and actual floating reference rate. Option C say, the floating reference rate in an FRA is determined at the end of the interest period and interest settlement occur 1 month after the period end. And option D say, FRA rates are derived solely from the current spot interest rate without any reference to yield curve or swap market data. These are the 4 options that we have, right? So now let's go through each and every option. Option number A. Let's see option number A. Option number A says that FRA settles periodically through multiple interest payment. See, this statement is incorrect. Why it is incorrect? Because, in an IRS, see, basically, it is saying that it's similar to IRS. No, that's why it is wrong. Because, if we talk about interest rate swap, right, if you compare with the IRS, let me just give you a glimpse of IRS. In IRS, there are multiple payment. Remember, in the case of IRS, there are multiple payment. And it's like, exchanging fixed and floating interest payment every few months. So what you do in IRS, you exchange fixed and floating payment, right? Fixed and floating interest payment every few months, right? Over several years. That is what we do in IRS, right? We exchange floating interest payment and fixed interest payment every few months over several years. But FRA is just for one single future period. This FRA is just for one single future period, right? Which means one rate, one settlement. That's it. Nothing of that. You can think of it like this way. If IRS is like a series of EMI that you pay every month, but FRA is like a one-time payment for one future only, for one future period only, one-time payment. That's it. So FRA and swap are not equal. It is much simpler and shorter, right? So that's why option number A is wrong. It says that multiple interest payment. No, that's wrong. Option number B. Yes. See, FRA, this statement is absolutely correct. Let's make it simple. What is FRA? Let me explain what is FRA. FRA is basically like a deal. FRA is basically a deal to lock your interest rate today. You lock your interest rate today, right? For a future period. For example, suppose that that 6 months later, right? You will take a loan for 3 months. That after 6 months, right? After 6 months, you will take a loan for how many days? 2 3 months. Fine. You are worried. What if interest rate rises by then? So today what you do? You sign an FRA to fix that future interest rate. Your motive is to fix future interest rate. That is your motive, right? So when that 6 month period arrives, right? So suppose the market rate goes up. What will happen? You gain. Why? Because you already locked. Since you already locked it earlier, at a lower rate, so obviously you have gained, right? But suppose market rate goes down. Suppose the market rate goes down. What happened? You lose. Why you lose? Because you fixed at a higher rate, obviously, right? So settlement happened. So I hope this makes sense, right? And the second point they have mentioned, the settlement occurring at the start of that period based on the difference between the agreed fixed rate. See, settlement happened at the start of the loan period, not at the end. So yes, this is correct. And only the difference between the fixed rate and the market rate is exchanged. So no actual loss, no actual deposit changes hand. Only the interest difference is settled. Yes, this is absolutely correct. What about option C? Option C says that, the floating reference rate is determined at the end of the interest period. Remember, in FRA, this floating reference rate is determined just before the period start. Typically 1 or 2 days before. And settlement happened at the beginning of the period. I just told you, settlement happened after the beginning, not when it ends. So it's like, you know, agreeing today about what interest you will pay next season, not waiting till the end to decide, right? What about option D? Option D is also incorrect because, you know, FRA rates are usually derived from yield curve. Remember, it is derived from where? It is derived from yield curve, right? Basically, you know, especially the government security yield curve. Yes, GSEC. You know, if we talk about the GSEC yield curve. So remember, FRA rate are derived from government security yield curve. In more developed market, FRA rate are linked to swap, right? They are linked to swap market data because swap market reflect the real time expectation of the future interest rate. So spot rate is not enough. It is saying that, you know, a spot rate, this is not enough, right? That's why this is wrong. So remember what we learned, correct answer is option number B. What is the key learning from this question? Let me just summarize for you. So what I told you that, you know, whenever you see this word FRA, think about it like a deal. Deal for what? You know, deal for fixing a future interest rate. Deal for fixing a future interest rate, right? That is a deal. Second thing, what it covers? It covers only future. It covers only future interest period. It covers only future interest period. Second point. Third point, settlement. When settlement happen? So remember, settlement happen at the start of that future period. Settlement always happen at the start. And what is the basis of payment? So I told you the basis of payment is the difference. Difference between what? Difference between the agreed rate and actual market rate. So difference between the agreed rate and actual market rate is the basis for payment, right? So remember, again I am telling you, so next point is that reference rate. So reference rate is decided before the interest period begin, right? Before interest period begin, reference rate is decided, and rate comes from yield, right? Yield curve or swap market data. So remember, FRA means you fix rate in advance for one period, right? So next time someone asks you what is FRA, you can confidently say, you know, it is a one-time deal to fix your future rate, future interest rate today and settle the difference when that period starts. That's it. I hope this is crystal clear. Now friends, have pen, paper and copy and just solve these MCQs, right? Just solve these MCQs. And one more thing I want to tell you, that this is the convention of showing the FRA, 6 into 12 FRA, which means, you know, that the period start in the 6 month, right? This notation, sometimes question they ask in the form of this notation, 6 into 12 FRA, right? So which means, you know, it will start 6 months and it will go till next 6 months. That is the point, right? Now have a look at this question. Please solve this question. Very, very important, right? So the question is asking you that, you know, basically treasury bill are issued at the discount and redeemed at face value, right? If 91-day T-bill is priced as 99.26, what is the implicit annualized yield? Rounded to decimal. So let's first happen what is happening with the T-bill. See what is happening here. Let's understand what this question is all about. Let me explain here. So friends, you know what is happening here, that you buy a T-bill below 100. You bought a, just wait a minute. You bought a T-bill below rupees 100, right? At a discount obviously. And the government pay you 100 when it matured. So government pay how much? Government pay 100 at maturity. Is it clear? Now the difference is your earning, right? Difference is your what? Difference is your earning, your return or your yield. So here in this case, what is the T-bill price? What is the treasury bill price? Treasury bill price they have given you, I think 99.26 as you can see, right? Treasury bill price they have given you 99.26, right? And what is the face value? Face value they have given 100 rupees. You can see face value they have given 100 rupees, right? So how much is your gain? Obviously, so your gain is 100 minus 99.26, which is equal to 0.74 rupees per treasury bill. What the question is asking, what is the implicit annualized yield, right? Now you know this bill maturing in 91 days, right? So we will analyze it using the formula. There is a formula that you need to remember for analyzation. What's the formula? So see, this is the formula. Yield is equal to 100 minus price, which is your gain, upon price multiplied by 365 upon days, right? That's the formula, right? So now in this case, you know, what is our 100 minus price, which is 0.74, right? 0.74 divided by 99.26 multiplied by 365 by days. How many days are there? So I think days they have 91 days, right? They have mentioned it, 91 days.
So that would be near about 2.99%, right? Or we can say 3%. So that is how you find the annualized yield. And you know, this question is the most important question. They ask every time, right? So the implicit annualized yield is 2.99%, or we can call it 3%, right? So basically, in short, you know, treasury bill gives you profit though discount, right? Through discount, not interest. And this profit is expressed as annualized yield. I request you to please remember this formula. This will be asked most frequently. Now have a look at the next question. Question number 2, again, see, there was a case study which was asked based on the treasury bill, and that is what I am presenting before you. So the question they ask you, which of the following statement about the auction participation in treasury bill is correct? Option A, only bank and primary dealer can participate in T-bill auction. Option B, retail investor can bid competitively but cannot participate via non-competitive bidding. Option C, non-competitive bidding for treasury bill is open to state government, designated foreign central bank, provident fund, a special entity. And option number D, non-competitive bidding allotment count within the notified amount of the T-bill issue. So tell me which one is correct. So friends, see, there are two ways to participate in treasury bill auction. What are the two ways? The first way to participate is, you know, let me just change the color. Yes, the first way is, you know, competitive bidding. You know what happened here? That participant quote their price. Participant, what they do? They quote their price or they quote their yield, right, in the competitive bidding. And the second kind is non-competitive bidding. What happened here? That participant just apply. Participant just apply and RBI give them allotment. RBI give them allotment at the average price. RBI allot them at the average price, which is decided in the auction, right? So that is what is happening in the NCB. That is called non-competitive bidding. So competitive bidding, you know, what happened? That participant quote their price, participant quote their yield. But in the non-competitive bidding, participant just apply and RBI give them allotment and RBI give them allotment at the average price decided in the auction. So that's the difference. Okay. So now let's look at the option. So if you see the option number C, yes, it explained it correctly. Option number A is wrong because, you know, not just bank and primary dealer, even individual can also invest. It is saying that only bank and primary dealer. No. Individual can also invest. What about option B? It says that retail investor can bid competitively but cannot. No. This is also wrong because, you know, retail investor cannot bid competitively. They must go via NCB route. Retail investor, for them, you know, competitive bidding is not allowed. What about option C? Yes, this one is the correct one because, you know, non-competitive bidding is allowed for, you know, a state government, designated central bank, provident fund, specialized entity. Correct. Even retail investor can invest this way, but they have a 5% limit of the total amount issued. Right? This is a very, very important. So a small investor can also buy treasury bill easily through the non-competitive bidding. Competitive bidding is not available. I hope this is crystal clear. What about option D? Option D is wrong because it says that non-competitive bidding counts within the notified amount. No, they are outside the notified amount. They are not counted within the notified amount. So remember, what we learned from this question is that very, very important point. Please remember it. Retail. If you are a retail investor, you can go through non-competitive route up to 5%. Up to limit is 5%. So this question may be asked in the upcoming examination. I hope it is crystal clear. Right. Very good. Now friends, let's look at the third part of the question. Again, based on the treasury bill. The question is asking you, when is the auction issued of 182 days treasury bill? So the question is, when is the auction issued? When is the auction? What is the auction schedule? Auction schedule they have been asking of 182 days treasury bill issued by the government of India. So options are weekly every Wednesday. Option B, fortnightly on Wednesday preceding a non-reporting Friday. Option C, fortnightly on Wednesday preceding a reporting Friday. Option D, monthly on the last Wednesday of the month. So I think you know it very well that, you know, treasury bill are issued for either 91 days, 182 days, 364 days, right? And each has its own auction schedule. This one has in a schedule, which is, this one has a schedule and also this one has a schedule. And who decides the schedule? This is decided by the RBI. So if we talk about this 182 days treasury bill, the auction happen every 2 weeks, right? Auction happen every 2 weeks and that is what we call, you know, so this every 2 weeks is what we call fortnight. This every 2 weeks is what we call fortnight. Or on Wednesday, just before a non-see, auction happen every 2 weeks on fortnight, right? And it is usually Wednesday, right? Just before a non-reporting Friday. So the question is, why such kind of timing? Because non-reporting Friday are weak when bank don't have to submit balance sheet data. So liquidity is smooth, making it good time for auctioning the midterm bill. right? So, they are reporting Friday, non-reporting Friday. Non-reporting Friday are those week where bank don't have to submit the balance sheet data. So liquidity is smooth and making it good time for auctioning the midterm bill, right? That's why non-reporting Friday. So let's look at the option that we have. So option number A says that weekly every Wednesday, again wrong, because this weekly apply to 91 days bill, not to 182 days bill. See, I'm telling you some other fact also. This fact may come in the examination, in the upcoming examination. So please make sure that you understand each and everything. What about option B? Yes, this one is correct one. What about option C? It is again wrong, because it says that reporting Friday. No, not a reporting Friday, but non-reporting Friday, right? And option D is wrong, because treasury bill are not monthly. It's saying monthly. No, they are not monthly. They are fortnightly. So remember what we learned, what we have just discussed. Let me just summarize regarding the treasury bill. This may help you in the upcoming examination. So think about treasury bill like this. Remember, they are issued at a discount, right? And they are redeemed at the face value. Second point, their yield formula, please remember 100 minus P upon P into 365 upon days. This will give you the annualized yield, right? So I hope this is clear. Auction, two types of auction, competitive and non-competitive. Right, retail investor are allowed. Yes, the retail investor are allowed, but limit is non-competitive route only. They are not allowed through competitive. They are allowed through non-competitive route only, and the limit is 5%. 5% limit. Right, and the last point I just discussed that 182 days treasury bill. Remember, right? They are auctioned. Auction happen fortnightly. Right, on Wednesday before a non-reporting Friday. That is how treasury bill works. Simple, safe, and super important for understanding the money market. Now friends, have a look at the next numerical question. Please try to solve on your own. So this question is asking that investor is considering a mutual fund with an expected annual return of 14%. The risk-free rate they have given is 5%. The standard deviation they have given is 9%. What is the Sharpe ratio? So now we are going to understand one of the most common ratio used to measure investment performance, right? You know about this Sharpe ratio? Basically, this is one of the most common ratio, right? This is one of the most common ratio that we use to measure the investment performance. That's called the Sharpe ratio. Don't worry if it sounds technical. By the end of this slide, you will know exactly what it means. So investor is considering a mutual fund. Expected annual return they have given, as you can see, 14%, and risk-free rate is given 5%. The standard deviation of the mutual fund return is 9%, as you can see. So Sharpe ratio have been asked. First of all, what is the meaning of this Sharpe ratio? Let me explain. What is the meaning of this Sharpe ratio? So basically, when I say Sharpe ratio, it means, that it measures how much extra return. It measures how much extra return you get for every 1 unit. For every 1 unit of risk you take. Means how many extra return you get for every 1 unit of risk that you take. Right. So simple idea is that the higher the Sharpe ratio, the better your investment return compared to the risk you're taking. See, it is nothing but return upon risk. See, if the Sharpe ratio is higher, it simply means, return will be higher per unit of risk. Is it clear? So what is the formula for Sharpe ratio? It's very simple. So what we do, please remember it, please note it down. Return of portfolio minus risk-free rate. That is the premium, risk-free rate, and divided by standard deviation. Just wait a minute. The standard deviation. That's the formula, right? Now tell me, what is the return of the portfolio here they have given you? As you can see, return they have given 14%. Just write 14%. What is the risk-free rate? 5%. Right. And what is the standard deviation? 9%. That's it. Just plug the number. Okay. So that will give you 1. Just see, it will give you 1. So answer will be option number A. Now let's interpret it. What does it indicate? So option number A is correct. That's what our calculation gives. It means that, our mutual fund give 1 unit of extra return for each unit of risk taken. Pretty balanced, right? Not too risky, not too inefficient. Okay. And rest option are incorrect. See, let me explain using one example. Right. Let me explain using one example. So friends, you can think of it like this. Imagine that there are two mutual funds. Right. Imagine that there are two mutual funds. So this is the mutual fund number A. Its return is 14%. This is the return, right? And risk is suppose 9%. And this is mutual fund number B. The return is 11% and risk is 4%. Now both earn above the risk-free rate, right? Both earn above the risk-free rate, but which one give better return for the risk? That is exactly what Sharpe ratio help you see. if fund A has a Sharpe ratio of 1% and fund B has a Sharpe ratio of 1.5%, then fund B is more efficient because it gives higher return per unit of risk. Okay, so see, Sharpe ratio can be less than 1, can be greater than 1 or equal to 1, or it can be 1 to 2. So if it is less than 1, what it means, it is below average. It means it is below average, not great return for the risk, right? If it is between, if it is 1, exactly 1, it means it is good. It is fair balance of return and risk. If it is 1 to 2, it means very good, right? Very good, which means efficient performance. And if it is greater than 2, that means excellent, top performing fund is there, right? So remember what we learned from this question is that Sharpe ratio formula, just remember it, return of portfolio minus risk-free rate upon standard deviation. In the book, nowhere it is written, right? That's the peculiarity of this session. I explain you each and everything so that from the nutshell, if you have don't any idea, you can understand it from the basic, from the, from scratch. Okay. So it measures the return earned per unit of risk, right? And greater the Sharpe ratio, better the performance. And if it is 1, then it is a balanced investment. If it is greater than 1.5, it means very efficient fund. I hope this is crystal clear right now. Now friends, have a look at this next question that we have. This question is all about, DVP. That is called, delivery versus payment. So the question is, which of the following statement correctly describe the DVP settlement method in security transaction? Yes. So basically, what are the options? That DVP ensured that securities are delivered only after funds have been fully transferred, eliminating principal risk by synchronizing the delivery of security with payment. Option B, DVP allows security to be delivered before payment is made, relying on trustworthiness of the transaction party. DVP and RVP, that is called receive versus payment, refers to two unrelated settlement systems used only in different countries. Option D, in DVP Model 3, securities are settled individually on a gross basis without multilateral netting of fund. Let's look at option number A. What do you think about option number A? Yes, this is the correct one. Why this is the correct one? Think about it. Imagine that you are buying a share worth rupees 1 lakh. Let me explain. Let me explain what DVP is all about using the simplest example possible so that you can memorize it for the lifetime. See, imagine that this is you. This is you. And you are buying a share. What you are buying? You are buying a share. How much? Worth 1 lakh. Fine. You don't want to send the money unless you are sure that you will receive those shares. Right? You don't want to send the money unless you are sure that you will receive those shares. Right? Obviously, you don't want to send the money unless you are sure that you will receive those shares. And the seller also don't want to give away the share unless they are sure that they will get paid. Obviously, both sides want, right? So DVP makes sure that both happen at the same time. Like suppose this is the seller, this is you, and this is the seller. So what happens through DVP? That you pay and you receive share. You make the payment and you receive the share, right? So this way, no one gets cheated. That is why we call DVP remove the principal risk. Here you will see the word they have written, eliminating the principal risk. What does it mean? It means, no one loses out if the other party default, right? DVP ensure that it eliminates the principal risk. Suppose if any party default, no one loses out, right? That's the peculiarity of this DVP. Yes, this is the correct one. What about option B? It says that it allows security to be delivered before payment. No. Because if only one party deliver first without getting money, it is quite risky. Actually, this delivery versus payment was actually created to avoid exactly this kind of trust-based system. Earlier, this was a trust-based system. To avoid such kind of system, this DVP came into picture. It ensured no delivery before payment. Simple as that. What about option C? It says that DVP and RVP refers to two unrelated settlements. In fact, DVP and RVP are two sides of the same coin. दो एक सिक्के के दो पहलू हैं ये, right? From the buyer point of view, think about it. Please understand. See, from the buyer point of view, like you are the buyer, right? Please understand. From the buyer point of view, that if DVP is DVP, I will deliver money when I will receive security. What I will say that yes, I will deliver money. I will deliver you the dollar when I will receive security. Who say this? Buyer say this. Yes, I will deliver the dollar when I receive security. One friend, this is from buyer point of view. What is from seller point of view? He says it is RVP. He says that I will receive payment when I will receive payment. I will receive payment when I will deliver security. See, seller has to deliver security. Buyer has to pay money. From buyer point of view, it is DVP. From seller point of view, it is RVP. That's why it is called, two sides of the same coin. So both terms describe the same settlement process. just from the different perspective. Is it clear? Right. So it is in that there refers to two. No. That's completely wrong. What about option D? This is also wrong. If we talk to the context of model number 3, both securities are both securities fund are settled on a net basis, right? They are settled on a net basis, not individually. That means all the transactions between multiple parties are first netted off, and only the final balance is settled. That is called net basis. This save time and this save money also. So in short, we can say, there are 3 models of DVP, right? Model number 1, model number 2, model number 3. In model number 1, they are settled individually. That is called gross settlement, right? Individual settlement happen. In model number 2, securities settled gross. Securities, they are settled gross, right? And funds, they are settled net. And in the model number 3, both netted multilaterally for efficiency. So 1, 2, and 3. Security model number 1, both are settled individually. Model number 2, securities are settled gross, funds are settled, funds are netted, and in model number 3, both netted multilaterally for efficiency. So remember, the key takeaway from this question is that DVP means no delivery without payment. No delivery without payment. It eliminates the principal risk, and DVP is from buyer's point of view, and RVP is for seller's point of view. Right. Model number 3 says that both side nettled. So you can think of a DVP like a shopkeeper who say, I will hand over the item only when you pay the bill. That is exactly how the financial market ensures. This is regarding the mutual fund returns. Very good question asked in the previous year. The question is, a mutual fund manager review the fund annual result, right, to assess how much value has been added above the market standard. See the keyword they have written. How much value has been added above the market standard? What is the correct formula for the excess return in the portfolio analysis? So the question is asking you to tell the correct formula for excess return in the portfolio analysis. So there are 4 options. Option number A, portfolio total return minus benchmark index return. Option number B, portfolio total return divided by benchmark index return. Option number C, portfolio total return plus benchmark index return. Option number D, benchmark index return minus portfolio total return. So the basic question it is, you have been asked to compute the excess return. So let's look at the option number A. Option number A says, that portfolio total return minus benchmark index return. This is actually the correct answer. Why? Because excess return also called active return. Either you call it excess return or you call it the active return. Both means the same, right? So it simply means it measures how much extra the fund made compared to the market, right? It measures how much extra the fund made compared to the market. Imagine that your fund made 12% this year, right? And the benchmark index rate, let's say Nifty 50 is 8%. Right. So how much excess return you have? You have 4% excess return, right? So this means your fund add 4% extra value above the market standard. So that is exactly what investors want to know. That's why option number A is correct. If you see option number B, it's completely wrong, because dividing does not tells us the exact value added. It gives a ratio, not the actual outperformance. So option number B is wrong. Option number C is also wrong, because adding the return together does not make sense here. You are adding total return. This does not make sense, right? You are not trying to combine the fund and the market. You are trying to see how much your fund beat or lagged the market. So C is wrong. What about D? It says excess return is equal to benchmark index return minus portfolio total return. This is tricky because it is just the reverse of the correct formula. If your fund two things can happen. Your fund can outperform, right? If your fund outperform, this would be a negative number. Investor want to see how much you added, not a negative value. So it is not the standard formula, right? So remember, the correct answer to this question is option number A. So remember these key points, right, about the excess return. I'm just telling you just summarizing the fact. So it is also called the active return. First point, please keep in the mind. Excess return or the active return, both are the same. What is the formula? Difference between the portfolio actual return and the return of the chosen benchmark. If you subtract actual return and the chosen benchmark return, it will give you the excess return. And if the positive excess return, it means fund outperform the market, right? A positive active return indicates the fund outperform the market. A negative excess return, it means fund underperformed. It shows value added by the fund
manager, it does not show the absolute return. It highlight how much manager value addition has been done. It does not tell you the absolute return level, right? Simple tips: always subtract the benchmark from your portfolio return to see the real performance difference. I hope this is crystal clear. Now friends, let's have a look at the second question that we have. So friends, question is, over the time, liberalized financial regulation have encouraged which of the following trend in government and corporate bond market? Option A, appearance of more volatile and opposing trend in domestic and offshore yield curve. Option B, creation of isolated domestic and global security market with very limited interaction. Option C, gradual alignment of yield movement between local currency and global currency denominated bond. Option D, development of unique yield curve for each individual institution. So which option do you think is correct? Basically the question is asking you about the trend. Which trend in government and corporate bond market has been encouraged by the liberalized financial regulation? That's the question. So let's look at the option. So friends, if you look at the option C says, gradual alignment of yield movement between local currency and global currency. Yes, this is the correct one. Yes, option number C is the correct one. Why? Because when financial regulation are liberalized, basically this question is about, liberalization of what? Financial regulation. Try to understand. When financial regulations are liberalized, restriction on cross-border investment are reduced. See, cross-border investment. Right, cross-border investment, whatever restrictions is there, it get reduced because of the liberalization. As a result, domestic bond and foreign currency bond start moving in a similar way. Right, so what happened, local currency bond, global currency bond, they start moving in a similar way because the restriction has been removed. Right, and a similar US dollar bond, right, which yielded 3%. Okay, after liberalization, what happened? As global investor move money between markets, so these yield tend to move together. So this difference was bridged, right? The gap was reduced, and these yield tends to move together depending on the global interest rate and the risk. This shows that better integration of the market, right? That's why option number C is correct. What option number A says? A says appearance of more volatile and opposing trend in the domestic and offshore yield curve. This is completely wrong. This is opposite of what is happening. Liberalization break barrier. It does not create isolation. Rather, it break the barrier. Right? It encourages cross-border flow. It encourages, more integrated market. So that's why option number A is wrong. What about option number B? It says creation of isolated domestic and global securities market. See, this is the opposite of what happened. I told you, liberalization breaks barrier rather than creating isolation, encouraging cross-border flow. So option number B is wrong. What about D? D says development of unique yield curve. Yes, that is exactly incorrect. Why? Because while different institutions may have slightly different yield due to credit risk, basically liberalization aligning market-wide yield. What liberalization does, they align. Alignment is being done, right? They align the market-wise yield, right? Rather than creating unique curve for it. No, they don't create unique curve for each institution. Rather, the focus is on market level convergence, not individual uniqueness. That's why it is wrong. So here is what you need to remember. First thing is that liberalized regulation reduce barrier between domestic and global bond market. So ultimately what happened, barrier get reduced between domestic and global market, barrier get reduced. First point. Second point, it encourages cross-border investment. Cross-border investment is encouraged by the liberalized regulation. And third point, result is that local currency bond yield start moving like a global bond. You can see, resulting in yield for local currency bond increasingly moving in a tandem with those of the foreign currency bond. That is the final outcome. So I hope if this made you clear, please hit that like button. And if you are looking for a study material for CTP examination, we have a study material available on our app. App name is JIV and CIV made simple. For more detail, you can WhatsApp me on this particular number for more detail. Now friends, let's look at the next question. So the question is asking you regarding the advanced option pricing. I'm skipping this question. This is a very simple one, right? So we are trying to cover more typical type of question which require little bits understanding. Yeah, this question is more frequently asked. Please go through it. So the question is asking you, we are learning a super important concept, and this is related to option trading, right? This question is related to option trading. Super important concept, right? The Greeks. So the question is, in advanced option pricing framework, which risk parameter specifically quantify a derivative sensitivity to change in the volatility of the underlying asset? How much the derivative is sensitive to the change in volatility of the underlying asset? Option they have given gamma, vega, theta, alpha. So which option do you think is correct? So basically, The correct answer, think about it. Option, basically they are talking about the advanced option pricing framework. So derivative sensitivity to the change in the volatility of the underlying asset. The answer is Vega, right? What is the answer? The answer is Vega. Why? Because Vega tells us how much the price of an option changes if the volatility of the underlying asset changes by 1%. Try to understand. Suppose volatility changes by 1%. So it tells us how much the price change. How much the price of option changing. Volatility changed by 1%. In simple word, Vega measure volatility risk. Means how sensitive the option price is to the market uncertainty. See, this volatility means what? Market, it clearly indicate, market uncertainty, right? It indicate market uncertainty. And this time, this thing, indicate the option price. Means Vega measures how much, volatility risk, how sensitive the option price is to the market uncertainty. Let me give you one example to illustrate the concept of Vega. See, suppose there is an option, right? This is to the context of option. Suppose there is an option which is priced at 10 rupees when the volatility is 20%. This 20% is what? Volatility. This is the price. Price is 10 rupees, volatility is 20%. Now suppose volatility increased to 21%, right? And the option price increased to 10.50 rupees. So that extra, how much extra? 0.50 rupees extra. That extra 0.50 is due to the Vega, right? This extra 0.50 is due to Vega. So higher Vega means option price move more when market volatility change. See, this 20% and 21% indicate the volatility of the market. So basically, suppose our Vega is higher. So Vega is higher, what does it mean? It simply means that, that bond price will move more when the market volatility change. And trader use Vega to manage how much volatility exposure their portfolio have, right? So let's look at the options. Option A, they have given gamma. That's wrong. Because gamma measures how much the delta of an option change when the underlying asset price move. You can think of gamma as an acceleration of delta. For example, if the delta changes fast when the stock price move, gamma is high. But it has nothing to do with sensitivity or volatility. So it is not the correct answer. Gamma is wrong. What about theta? Theta is also called, time decay. You can also call it time decay, right? Theta tells us how much an option price will drop as the time passes, even if nothing else changes. How much the value of option price will drop. That is called time decay, right? You might have heard the word. Have you heard the word time decay? So this time decay is what is indicated by theta. For example, suppose the option near expiry, its time value melt away. So that is theta in action. But again, this is about time. This is not about the volatility. Because, in this particular question, it is, centered around the volatility. The question is asking you to avoid volatility. So theta is not the answer. What about alpha? Alpha measure the excess return compared to the market benchmark. I think we have done one question based on it previously. So you must know all these parameters, gamma. So see what I am doing here, right? I'm not just telling you the correct answer and moving away. No, I am explaining each and every option so that you have conceptual clarity. Suppose in the upcoming examination they ask you about alpha, you must answer. What is the alpha? In simple word we can say alpha is the excess return, right? Excess return compared to the market benchmark, and it is mostly used in portfolio performance. So alpha is how much better you did than the market. It is not about volatility or sensitivity. So remember, option number B is the correct one. Let me summarize what we have discussed just now. So whenever you see this word Vega, it represents the sensitivity to volatility. Right? Sensitivity to delta, theta means sensitivity to time decay, and alpha means excess return. Right? So these are the four parameters which are related to the option pricing. Right? Now friends, let's look at the next question that we have. So the question is asking you regarding this question is regarding a corporate bond. So a corporate bond having face value of 1000 rupees, pay annual coupon at 8%. If similar bond in the market are offering a yield to maturity of exactly 8%, what will be the most likely price of the bond in the secondary trading? There are four options they have given: above 1000, below 1000, unpredictable, exactly 1000. So let's see what is the correct answer. The correct answer to this question is, first of all, try it on your own. And let me explain. The correct answer to this question is exactly 1000. Option number D. Why? Because try to understand the coupon rate they have given of the bond. How much is the coupon rate? Let me just explain here. Okay, so I can write it here also. As you can see. So the correct answer is option number D. Why? Because coupon rate they have given 8%, right? And the market yield means what investor currently expect to earn, that they have also given 8%. So Y to maturity, yield to maturity means what the
what is the meaning of YTM? Means what the investor currently expect to earn. They expect to earn 8%. And coupon is given 8%. That means investors are happy getting the same return from this bond as they can get from the market. Investors are quite happy because they are getting 8%, right, from return from this bond as they can get from the market. So the price, so the bond price will trade at par. It's called trading at par or trading at the face value. That is what the word we use, right? So let me give you one example to make it more clear. Suppose you buy a bond worth rupees 1000. You buy a bond worth rupees 1000 that pay 80 rupees per year. That pay 80 rupees per year. That is exactly what 8% of 1000 is, isn't it? Okay, so basically, you bought this bond, and if the market is also offering 8% return, how much return market is off? This is the coupon rate. This is the coupon, and the YTM means market is offering also 80 rupees per year or 8% return. So there is no reason to pay more or less. It is the perfectly match, right? That's why option number D is exactly correct. What about option C? Option A say above 1000. See, this would happen only if the bond coupon rate is higher than the market price. See, whenever coupon rate is higher than the YTM, then only this par value pricing of the bond will be above 1000. For example, let me give you one example. See, these things are very, very important from understanding as well as examination point of view, because bond is the most important topic. They ask question every year. Let's say that a bond pay 10% interest rate. Okay, but the market is just offering how much? Market is offering 8%. So this is our coupon rate and this is our market rate. So as you can see, it is 10% and it is 8%. So coupon rate is higher than YTM. In that case, what would happen? Investor would love this bond because it gives extra income, isn't it? Because it is giving extra income, so investor would love this bond. So they are willing to pay more. Maybe they are willing to pay 1050. Maybe they are willing to pay 1100. So this is called premium bond. Because the return they are getting is higher than the market return, that's why they love, right, to buy this bond, and that's why they are ready to pay premium, right? So this is the point, very, very important aspect I'm telling you. So option number A is wrong, right? Option number A is not the correct answer. It's called the premium bond. What about option number B say? Option number B say that the price of the bond is below 1000. Think about it. So this is when this happen, when the bond coupon is less than the market rate. Let me give you one example. Suppose bond pay only 6%. Bond pay only 6%, right? While the market offer 8%. So this 6% is the coupon rate and this 8% is the YTM. So as you can see, coupon is less than YTM. So nobody wants less return, isn't it? So to attract buyer, the price must drop. Maybe the price can drop to 900 rupees. Maybe the price can drop to 950 rupees until the effective return match. This is called the discount bond. So see, try to understand, when coupon rate is less than YTM, bond price will drop. When coupon rate is higher than YTM, bond price will rise. Why it is rising? Why it is decreasing? Think logically, you will be able to answer. Option number C is unpredictable, but actually, bond pricing follow a clear mathematical logic based on the coupon rate. It is not random at all. So option number D is the correct answer. What is the key learning from this question? Please understand. Let's quickly summarize. Let me just write it down, the quick summary. Please note it down. This will be helpful. See the coupon rate and see the YTM. If coupon is equal to YTM, so this is called par, trading at par. If coupon is higher than YTM, this is called premium trading. This is called bond trading at premium. If coupon is less than YTM, this is called discount trading. Right. So bond price moves opposite to yield change. When yield goes up, price fall down. Right. Please note it down. Very, very important aspect. Now friends, let's have a look at the next question that we have. This question is related to the European style swaption. Right. This is the favorite topic of IABF, swaption. So question is, what is European style swaption in the context of derivative market? Option A, an option granting the right but not the obligation to enter into an interest rate swap only at the option expiry date. B, an option that can be exercised at any time before or on expiry to initiate a swap contract. C, an option where only the seller can choose to enter into a swap after the contract start. D, an option allowing the buyer to modify the terms of an existing swap at any time. So which option do you think is correct in the context of swaption? A, B, C or D? See, if you look at the option number A, it is exactly correct. Because when we see this word swaption, please try to understand. Whenever we see this word swaption, it is made up of two words. See, swap plus option, isn't it? So basically, it means it is an option to enter into an interest rate swap in the future. It's just like an option to interest into it is just like an option to enter into a basically interest rate swap in the future. That's called swaption. Now the question is specifically talks about European. See, swaption means swap plus option. It's just an option to enter into interest rate swap in the future. But the question is talking about what? The question is asking you about, swaption. You can say European style swaption. The question is specifically asking you about European style swaption, which means it can be used, I think you know it very well. European means, it can be used only on the expiry. E for European, E for expiry. Just remember this word. Okay. So it means it can be used only on the expiry date, not before. So let me give you one example to make it more clear. Imagine that you think that interest rate might goes up. You think that interest rate will go up after 6 months. So what you do? You buy a swaption. You buy a swaption that give you the right. Obviously, swaption will give you the right. It will not give you an obligation because it is a type of option, right? It will give you a right, to enter into an interest rate swap 6 months later. Yes, you can enter into interest rate swap 6 months later. If the rate do rise, you can use your swaption to fix lower rate. If not, you simply walk away. That's why we say right but not obligation. Simple, right? Now, let's look at the option that we have. Option number B, let's look at first option number B. It says that an option can be exercised at any time before or on expiry. That actually describes the American style option, right? This is about the American style swaption, not one in the question. So yes, this type exists. It gives you more flexibility, but the question clearly say only at expiry, which means European style, hence B is wrong here. What about C? C says an option where only the seller can choose to enter into swap. You can see now, only the seller can choose to enter into swap. That is totally wrong. Why? Because in option it is the buyer who has the right and the seller has the obligation. So the seller does not get to decide anything. They just wait to see if the buyer exercises it or not. What about option D? Option D say an option allow the buyer to modify the terms of an existing swap. That is completely wrong. Swaption is about starting a new swap, right, in the future, not changing an existing one. So this one is also incorrect. So which one is correct? Correct one is option number A. Yes, this is exactly correct. Because swaption, European swaption is a kind of, swap plus option, right? So basically option to enter into interest rate swap in the future. That is what we call, swaption. And remember that I told you, right, to enter into interest rate swap only on the option expiry date. So remember the difference between European and American option. American option can be exercised any time before the expiry, whereas European option can be exercised only at the time of expiry. Please remember it. So friends, what we learned from this question, let's quickly summarize. Let me just write it down. So what are the keywords? What are the key points that we have just gone through? I told you about, swaption. So swaption means, two words just combined together. Let me show you. It means, swap plus option, right? It gives the right but not the obligation. If it is European, remember, if it is European swaption, it can be exercised at only at expiry. It can be exercised only at expiry. And if it is American swaption, it can exercise any time. You can exercise it any time before expiry. And it is used for hedging interest rate risk or speculating on rate movement, right? You can think of it like a future deal on interest rate. If it benefit you, go for it. If it not benefit you, skip it. That's it. I hope it is crystal clear. Now friends, let's look at the next question that we have. Yes, so this is the next question. In the context of an integrated treasury setup within a financial institution, what does a vertical integration most accurately signify? Right. So basically this question is to the context of vertical integration. So in the context of an integrated, as you can see the word they have written, integrated treasury setup within a financial institution, what does the vertical integration signify? So option they have given the merger of front, middle and back office operation under unified procedure, oversight and shared technology system. B. Combining all the regional treasury into a single head office for better geographical coordination. C. Pooling only those treasury units which handle similar asset class. D. Separating dealing room from risk management and settlement activity. So tell me, what does vertical integration signify? Which option do you think is correct? See, whenever I say this word vertical integration, what I mean to say, it means that all the level of treasury operation. So what does it mean? All the level means, front level, middle office, back office, they work together as a one single unit, right? Please try to understand. Vertical integration means all the level work together as a one single unit. That's the meaning of vertical integration. Let's break them down. Please understand. So first of all, what is the role of front office? If you look at the role of front office, they does the actual trading. Yes, actual trading is being done at the front office. Question may ask you, what are the role of front office? So actual trading is being done. What is the role of mid office? They manage the risk. they manage the compliance, they manage the limits, right? And what is the role of the back office? So back office does handle the settlement. So settlement process are handled at the back office, and also they handle the record keeping, right? Record keeping. So front office actual trading, mid office risk compliance and limit, and back office deals with settlement and record keeping. So whenever a bank follow vertical integration, these three parts use the same policy. That is the meaning of vertical integration. Try to understand. To the context of vertical integration, all these three, all these three parts use the same policy. They use the same policy. They use the same technology system, right? They use the same reporting structure. That's the peculiarity. I hope it is clear, right? So let me give you one example to make it more clear. Imagine that earlier each office worked on its own software and report. Earlier what used to happen, that each office worked on its own software. Each office were having its own software, on report, right? Front office working on Excel, right? Mid office working on another system, and back office working on paper file, right? So earlier, each one has its own system. Again, I'm telling you, front office on Excel, mid office on another system, and back office on paper file. But vertical integration means now, all three uses one common platform. They follow the same rule. They report to the same management system. This avoids confusion, duplication, and error, making treasury work smoother and safer, right? So that is the correct one. So what is the correct answer to this question? Yes, option number B is the correct one. Combining all the regional treasury into a single head office for better geographical coordination, right? So no, option A is the correct one. Option B says combining. See, that sounds good, but it's not vertical integration. This is more like geographical centralization. This is more like geographical centralization because it is dealing with location, right? Not with the integration of process like trading, risk, and settlement. It is dealing with location. That's why this is not completely correct. Option B is incorrect. Option C say pooling only treasury unit which handles similar asset class. So that is not vertical integration. That is product based grouping. This is what? This is product based grouping, right? For example, merging all the forex desks together or all the bond desks together. So vertical integration, however, connect different functions, not similar functions. So this is incorrect. What about D? Separating dealing room from risk management and settlement activity. That is actually opposite of the vertical integration, right? This is called segregation of duties, which is important for internal control. See, option number D is talking about segregation. Segregation of what? Segregation of duties, right? Which is important for internal control, but not what we mean by vertical integration. So this is also incorrect. So what is the correct answer? Correct answer is option number A. So remember, whenever they ask you about vertical integration, just add these: front plus middle plus back, right? They are working as a team. They are together working as a team. Same procedure, same policies and IT system. It reduces silos and improve efficiency. It ensures strong governance and a smooth information flow. It focuses on process integration, not location on or product grouping. You can think of it like a relay race. Instead of running separately, all these offices now pass the baton perfectly. I hope you like this simple breakdown. Now friends, have a look at the next question. The next question is asking you that according to the RBI norm, if a scheduled commercial bank has a capital fund totaling rupees 2000 crore, what is the maximum it can borrow in the call money market on a given day? Options they have given: 3000 crore, 2000 crore, 1000 crore or 2500 crore. So see, basically how much can the bank borrow in call money market in one day? That is the question. See, option number A, look at option number A, 3000. It looks tempting, right? But it is wrong. Because RBI has clearly said that bank can borrow up to, so what is the RBI say? RBI regulation says that bank can borrow up to 100% of its capital fund. 100% of its capital fund in the call market. So suppose if the capital fund is 2000 crore, as you can see here. So it means borrowing 3000 crore means 150%, which is above the limit, right? This will increase the risk and RBI does not allow that much leverage. So this is incorrect. What about option B? Yes, this is absolutely correct. RBI clearly say that a scheduled commercial bank can borrow up to 100% of its capital fund in the call money market on any single day. 100% of capital fund in the call money market in any single day. Please remember it. So that means it can borrow 2000 crore maximum in one day in the call market, not 2001, not 2500, 2500, exactly 2000.
Option number C is also wrong. 1000 crore is wrong because maximum is 2. When the question is asking you maximum, that's why B number option is correct. Okay, so key points to remember that if you talk about the call money, what is the meaning of call money? Call money means very short term borrowing, right? Call money means short term borrowing and usually 1 day. Usually the borrowing is for 1 day. RBI limits say maximum borrowing is how much? You can say maximum borrowing is 100% of the capital fund. That is the maximum borrowing, right? And capital fund includes two things. Capital fund includes paid up capital plus reserves plus surplus. See, whenever I say capital fund, you see this word they have written. See, three things are there in the capital fund. First of all, paid up capital plus reserves plus surplus, right? These three things combined together form the capital fund, right? So 2000 crore capital fund is the maximum 2000 crore borrowing limit. So always remember, borrowing limit in call market is 100% of the capital fund, and capital fund includes capital, reserves and surplus, right? I hope you remember this one line, that borrowing limit in call market is 100% of capital fund, right? Let me again write it down, right? So remember, let me write it down. This will help you. So remember, borrowing limit in call market. Borrowing limit in call market is 100% of capital fund. Please remember it. 100% of capital fund, that is the borrowing limit. Okay. Now friends, let's look at this question. When purchasing a bond between coupon dates in secondary market, what does the term dirty price represent? Right. So the question is about the dirty price. So we will clear one of the most commonly asked bond market question. What is dirty price? Sounds complicated, don't worry. By the end of this slide, you will know it exactly. So what is the meaning of dirty price? Option A says that clean price plus accrued interest calculated from the last coupon date up to the trade settlement date. Option B says that the market value minus accrued interest from the start of the bond tenure. Option C say clean price plus accrued interest from the settlement date to the next coupon date. Option D say clean price only with no adjustment for interest. So that's the question. What is the dirty price? See, let me give you one example to understand it. Option A, yes, this is the correct one. Why? Let's make it simple about the dirty price. This is the most frequently asked question in the examination and you can understand it very easily. Imagine that you are buying a bond and this bond pay interest. It bond pay you interest every 6 months. Okay, it pays you interest every 6 months. Now suppose the last interest was paid 3 months ago. Last interest was paid 3 months ago and you are buying the bond today. Okay, last interest was paid 3 months ago. You are buying the bond today. So the seller held the bond for those 3 months, which means the seller deserve interest for that period, right? See what I am telling you, that you are buying a bond that paid interest every 6 months. Suppose the last interest or coupon was paid 3 months ago and you are buying the bond today, right? So the seller held the bond for those 3 months, which means seller deserve interest for that period, and that is called accrued interest. That interest is called accrued interest. Now the bond clean price is the quoted market price without interest. So whenever you see this word clean price, what does it mean? It means the quoted market price. What they have quoted. Quoted market price is called the clean price and this does not include any interest. But when you actually pay it, you add this accrued interest to the clean price, right? So that's why dirty price become clean price plus accrued interest. Clean price plus accrued interest. So that is the actual price that the buyer pay in the market. Let me give you one example to make it crystal clear. Let's suppose that clean price is 98 rupees. This 98 rupees is the clean price. Okay. And accrued interest is 2 rupees. 2 rupees is the accrued interest. So what will be the dirty price? The dirty price will be 100 rupees, isn't it? It will be 100 rupees. That is what you actually pay, right? So that is the option number A. Option number A says the same. The clean price plus accrued interest calculated from the last coupon date up to the trade settlement. Yeah, this is the correct one. What about option B? The market value minus accrued interest from the start of the bond tenure. See, option number B is incorrect because we never calculate interest from the start of the bond. Only from the last coupon date we calculate, right? Only from the last coupon date. So remember, we never calculate interest from the start of the bond. Only from the last coupon date we calculate. The start of the tenure could be year back, which make no sense for current pricing. What about C? C says clean price plus accrued interest from the settlement date to the next coupon date. This one sounds tricky, but notice the term period they have given. From settlement date to the next coupon date, which means future interest, which has not been earned yet. Right? It is just like, future interest. Future interest has not been earned. So we only add interest earned till today, not for the future month. So this one is also wrong. What about option D? It says clean price only with no adjustment for interest. This is actually the definition of the clean price, right? Not dirty price. Dirty price always include accrued interest, which clean price exclude it. So friends, let's summarize the key point what we have covered here. So clean price, whenever you see this word clean price, just remember this word quoted price of the bond, what they have quoted, that is called clean price. And then you will see the word accrued interest. Accrued interest means what? Interest earned since the last coupon date till today, right? So last coupon date, you see what was the last coupon date, and till today how much interest you have earned, right? So that interest is what we call accrued interest. Second point. Third point, you can say dirty price is equal to clean price plus accrued interest, right? Plus accrued interest. So dirty price is the actual amount that the buyer pay to the seller in the market. Suppose you buy 1,000 rupees bond halfway through the 6-month interest period. You will pay half the interest to the seller as accrued interest. So the total price you pay is the clean price plus interest price, that is called the dirty price. So remember, next time someone asks you what is dirty price, just say it is not messy. It is just the full price that you pay, which includes clean price plus accrued interest. If this explanation helped you to understand, please hit that like button. Now friends, have a look at the next question. So today we are going to talk about something that every trader, especially those in treasury or dealing room, must understand. That is called, stop profit level. This question is asked most frequently. What does the stop profit level mean in the context of trading dealer activity? Sounds technical? Don't worry. By the end of this slide, you will know in the simplest possible way. So options they are saying it is the minimum loss that must be recorded at the end of each session. Option B, it refers to a stage where accumulated gain must be logged in and position should be closed. Option C, it is the total revenue generated by the dealer in the trading week. Option D, it is the profit threshold required for eligibility to trade in the next market cycle. So let's look at the option number A. What do you think about option A? It is wrong. Why? Because this is the total opposite of what stop profit means, right? Stop profit is about, locking profit. Remember, stop profit is about, let me write it down. Stop profit is about, locking profit. Okay, so not recording the loss. The term that relate to limiting loss is actually a stop loss. See, what is option number A saying? That minimum loss that must be recorded. See, this is the stop loss. This is called, stop. This is not called stop profit, right? So this is the opposite of what is stop profit. A stop profit is locking in profit, not recording loss. This question is option A saying loss, recording loss. So this option is incorrect, right? Because the stop profit has nothing to do with losses. Option number B, it refers to a stage where accumulated gain must be logged. Yes, that is the correct one. Let's make it super easy. Let's make it super easy using one example. I'm giving you one example to make it more clear. Let's say that you are a dealer. And you are trading in government bond. Okay. Now you made a good profit. Let's say rupees 10 lakh profit you make. And your organization has a rule that says if the profit reaches 10 lakh, right? Book it. If a profit reaches 10 lakh, book it. Don't wait for more. So the 10 lakh profit is your what? Stop profit level. It is your stop profit level because your organization say that whenever your profit reaches 10 lakh, book it. So even if the market might move further in your favor, you close your position and lock the profit because the market can reverse anytime. It is just when you are gambling and someone say, bhai ab nikal ja, you are in profit. Don't risk losing it again. So stop profit means, a pre-decided point where you exit with profit to protect your gain from turning into loss. It's all about discipline and risk management. I hope this is clear, right? What about option C? Option C is, it is total revenue generated by the dealer. No. Revenue means total money earned. That is more like a sales. That is more like an income, not a stop profit. A stop profit is like a limit, right? Is like a limit point. It is not a total number. So option number C is obviously incorrect. What about D? D says it is a profit threshold required for eligibility. There is a point they have written that trading eligibility. You can see they have written trading eligibility.
You know it very well that trading eligibility does not depends on how much profit you made earlier, right? Trading eligibility has nothing to do with profit. It has nothing to do with profit you made earlier. A dealer trade as per the daily strategy and limit. Dealer trade as per the daily strategy as well as the limit. This option is also incorrect. So what is the correct one? The correct one is option number B. Right. So remember, stop profit level is the fixed profit point where the dealer must close the trade and book the profit. That's it. Right. And purpose is to protect earned profit from being lost due to sudden market reversal. Suppose market got reversed and whatever I have earned, it is on verge of losing. So I don't want that. I booked my profit. That's it. Right. There is a point. So think of it like playing a game. You have won a good amount before you get greedy and loses it all. You decide, bus, I am cashing out now. That is your stop profit. So I hope it is crystal clear now. Stop profit. Please hit the like button if you think that the way I am explaining is helping you understand the concept. Now friends, have a look at the next one. The question is asking again question for bonds. You can see the bonds is the most asked question, repeated question in the examination. Question they are asking you, when comparing bond with the identical maturity, how does the market price of a floating rate bond, so it is start talking about floating rate bond, typically respond to the shift in interest rate compared to a fixed rate bond. So basically on one side you have floating rate bond, other side we have fixed rate bond. So market price of a floating rate bond responding to the shift in interest rate, how? The question is that. Option A say that floating rate bond shows greater price swing than fixed rate bond. Option B say that floating rate bond remains stable while fixed rate bond are more sensitive to rates. Option C say both type experience equal price change. Option D say that fixed rate bond experience less price movement than floating rate bond. So let's look at the option number A. If we look at the option number A, is it correct? No, it is not correct. Right? Why? Because floating rate, this is incorrect. Because this is actually the opposite. Right? This is actually the opposite. Because floating rate bond don't swing widely. Their price are stable. Remember, floating rate bond, their price are stable. Their price are quite stable. Because their coupon. Why? Because the coupon, obviously bond have a coupon. Because their coupon, that means the interest payment, keep adjusting with the market rate. There is no reason for the price to fluctuate a lot. Right? So remember, very very important thing I'm telling you, that to the context of floating rate bond, remember their coupon, right, or the interest payment, they keep adjusting with the market rate. Coupon adjust with the market rate. So there is no reason for the price to fluctuate a lot. So price does not fluctuate a lot. It is the fixed rate bond that sees bigger up and down in the price when interest rate move. So that's why option A is wrong. What about option B? Option B say floating rate bond remain relatively stable, whereas fixed rate bond are more sensitive to rate change. What do you think about it? Let's understand this with a simple example. Yes, this is the correct one. So let me give you one example to make it more clear. Suppose that you buy a fixed rate bond that pay 8% coupon every year. Right? Every year it pay 8% coupon. Now if the market interest rate rise to 10%, new investor can earn 10% easily. So your 8% bond become less attractive, isn't it? It become less attractive. Result is that its market price will fall down. That to maintain the equilibrium. On the other hand, suppose we have a floating rate bond. You have taken a floating rate bond. So what will happen? It automatically increases its interest payment as the market rate rises. So its return stays in line with the market and price does not fall much. That is why, so you can see now in the fixed rate bond, stability is not there. Because as suppose market interest rate rises to 10%, automatically bond price is falling. But in the case of floating rate bond, there is nothing such like that. It's quite stable. Right? So return stay in line with the market. That is why floating rate bond are say price stable, while fixed rate bond are rate sensitive. So remember, this is a very very important thing. This question is asked. Difference between floating rate bond and fixed rate bond. So question may be asked that which is more stable. So answer is floating rate bond is more stable as compared to fixed rate bond. Option C says that both experience equal price change. No, that is wrong. Because the whole difference lie between these two bonds, lie in how their price respond to rate change. See, basically rate is changing, right? And since rate is changing, how price is responding? That is what floating rate and fixed rate bond decide. Option D say fixed rate bond experience less movement than floating rate bond. This is totally opposite.
Fixed rate bond actually, experience more price movement. So this option is also wrong. So what we learned from this discussion is that, fixed rate bond, they pay constant interest rate, right? Fixed rate bond, they pay constant interest rate. Price fall when market rate rise, and price rises when market rate fall. While, floating rate bond, interest adjust with market interest rate, price remain relatively stable. I told you now, in the case of floating rate bond, price remain relatively stable. And in the rising interest rate environment, just remember it, in the rising interest rate environment, floating rate are preferred. They protect investors from price drop. So suppose interest rate is rising, such an environment is there. So which one will you prefer? Floating rate or fixed rate? Obviously floating rate you will prefer. This concept is key in the interest rate risk management, right? So you can think of the floating rate bond like an auto adjusting fan, right? You can think of it like, just one example to remember it. You can think of floating in rate bond like, auto adjusting fan, right? If the room get hotter, it speed up automatically. While fixed rate bond are like, manual fan. It stay at one speed no matter how hot it get. So you have to suffer when the environment change. That's it. This is the way to remember it. Now friends, have a look at this question. Very good question it is. Friends, again I am telling you, if you want study material for CTP examination, through which you can easily crack the examination in the first go, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. Right, now see this question. The question is, a risk desk manage a long call option portfolio worth $8 lakh with a delta of 0.30. To achieve a delta neutral hedge, what action to the desk take in the underlying asset? So the option they have given you, right, buy $24,000 of the underlying, B, short sell $2,40,000 of the underlying, C, buy $2,40,000 of the underlying, D, short sell $24,000 of the underlying. So very good question. First of all, you must understand what the delta means. Here you will see this term, as you can see, delta. How much delta they have given? 0.30. What does it mean? Let's first understand delta. So whenever I say this word delta, please understand, delta, it means how the option value change. It indicates how the option value changes when the underlying asset price change. So asset price is changing, how the option value is changing. That is what delta tells you. Right. So remember, for if it is call option, suppose it is call option. So for call option, delta is positive. Call option delta is positive. It means, if the price goes up, call value decrease. Price goes up, call value decrease. That's called delta probability. Means it simply tells you now, if option value change, how the asset price changes. Right. So for call option, delta is positive. Means if price value goes up, call value decrease. Now in this case, you can see delta they have given is 0.30, which means for every $1 rise in the underlying value, for every $1 rise in the underlying, right, the portfolio gain 30% of the move in the value, right? So there is a formula that you can use to compute it. Let me write down the formula. So your total exposure, you can write it like this. Your total exposure is equal to portfolio value multiplied by delta. Just remember it. Total exposure is equal to portfolio value multiplied by delta. Now in this case, total how much to portfolio value they have given? Portfolio value they have given I think it is $8 lakh, and delta they have given 0.30. Just do the calculation. So portfolio value I am just writing here 8 lakh multiplied by 0.30. How much would that be? That would be $2,40,000, isn't it? So this means your portfolio behave as if you own $2,40,000 worth of the underlying stock. Right? Your portfolio behave as if you own this much. You own $2,40,000 worth of the underlying stock. Your portfolio is behaving as it. Right? Now, second thing to understand, what is the meaning of this hedge? Right? What is the meaning of this hedge? Hedge means, since you are long call, you can see now you have a long call option. You can see what they have written, long call. Since you are long call, you already benefit when the price rise. Price is rising, you are benefit because it is a long call option. To make your position delta neutral, which means not affected by price movement. When I say delta neutral, it means not affected by price movement. To make the position delta neutral, you need to take an opposite position in the underlying. That means you have to short sell, right? So what is opposite of long call? Opposite of long call is short sell, right? So you have to short sell $2,40,000 worth of underlying asset. This will offset the delta and make your portfolio neutral to the price change. So which is the correct one? Option number B is the correct one, right? $240,000 short sale of the underlying. That make is option number B correct. So I hope answer is clear. Just remember this formula, very important. Delta equivalent is equal to value of position multiplied by delta. This will help you understand the concept. So you can think of delta hedging like a balancing a seesaw. You might have seen a seesaw, right? So you can think of it like, balancing a seesaw. So you call option tilt it to one side, and to balance it you put an equal weight on the other side. When both are equal, no matter which way the market move, you stay steady. That's it. That's called delta equivalent. So in short, we can say, just let me write it down. In short, just let me make summary. You can say that that long call positive delta, right? So what is the learning from this question? Whenever long call is there, our delta is positive, right? How can we hedge it? We can hedge it by sorting. We can hedge it by sorting the underlying, right? We can hedge it by sorting the underlying. That's it. Right, I hope this is crystal clear now. Now friends, let's look at the next question that we have. While designing an index linked bond portfolio, the question is, while designing an index linked bond portfolio, which risk is most closely monitored to ensure that fund performance replicated benchmark as accurately as possible? While designing so the question is, index link, this is the key point. Index linked bond portfolio you are designing. Which risk is most closely monitored to ensure that fund performance replicated benchmark as accurately as possible? Option they have given: concentration risk, tracking difference risk, credit spread risk, and regulatory risk. See, if we talk about the concentration risk, when it happened when the portfolio is too heavily invested, right? Concentration risk happen, when portfolio is too heavily invested in few security. Right, your portfolio is too heavily invested in few security, increasing the risk if those security underperform. This is not our main concern in an index linked portfolio. Here we are talking about, index linked portfolio, because the focus is on, replicating the benchmark. You can see future fund performance replicated benchmark. This is our main focus, right? So this is wrong. What about option B? Option B is saying tracking difference risk. Yes, this is the correct one. What does it mean in the simple word, tracking difference, or we can say either we call it tracking difference risk or we can call it tracking error, right? So tracking error, it measures how closely your portfolio follow the benchmark index. See, you have your portfolio, right? And you have your benchmark index. So tracking index, basically what it does, it measures how closely your portfolio follow the benchmark index. And for an index linked fund, the goal is not to beat the benchmark, but to mirror it as accurately as possible, right? The goal is what? The goal is to mirror it as accurately as possible. Let me give you one example, it will be clear. Suppose that benchmark index, benchmark index, it goes to 5% in a month. In a month, it goes to 5%. And if your portfolio, so again I'm telling you that benchmark index is suppose 5%, portfolio grew only 4.8%. The difference of 0.2% is the tracking difference. So there can be many causes of this tracking error, like transaction cost, timing of trade, slightly different security selection. So portfolio manager monitor this carefully to make sure that fund return are very close to the benchmark. That's why option B is the correct answer. What about option C? Credit spread risk? No, because credit spread risk is the risk of bond price changing due to change in the credit worthiness of the issuer. Here, what matter? Issuer credit worthiness. How much credit worthy is the issuer? And the bond price is changing because of that, right? So while important in general bond investing, in the case of index linked bond portfolio, right, the main goal is tracking the index, not worrying about the outperforming based on spread. What about regulatory risk? So regulatory risk is the risk of losses due to change in the law or regulation, right? It is important for fund manager, but it is not the primary risk. So what is the main risk? Is the tracking error, which measure how closely your portfolio mirror the benchmark. For index link or passive fund, the goal is replication, not outperformance. A small deviation can happen due to transaction cost, timing, or security selection.
You can think of it like a recipe, exactly, right? So benchmark is the exact recipe. So your benchmark is the perfect recipe. You can think of it like a recipe. Benchmark is a perfect recipe, and your portfolio, it can be like, dish that you cook. So tracking difference is the slight taste difference if you miss a pinch of salt or add sugar too much. That's it. I hope it is crystal clear now. That is what we call tracking error. Now, friends, if you want me to continue more, I will bring the part 3 lecture also in the upcoming session. Just write yes in the chat box, in the comment section. I will bring
Particular date, it maintained only 540 crore. The prevailing bank rate they have given 7%. Now, if the RBI penalty for non-compliance is, how much penalty is there? Bank rate plus 3% per annum. That is the penalty that RBI charges. So the question is, what is the penalty amount for a day's default on the shortfall? That's the question. Very good question it is. Let me show you the option. Option A says that interest at 7% for a day on 60 crore. Option B says that interest at 10% for a day on 600 crore. Option C says that interest at 10% for a day on 60 crore. And option D says that interest at 7% for a day on 550 crore. So let me show you the entire question in a single slide. So this is the question. So friends, in the question, as you can see, required CRR have given, right? First of all, what we will be interested in finding the shortfall. Right? What is the shortfall in CRR? Very simple. You see how much is the required minus how much is the maintained. Right, so this difference will be the shortfall. As you can see here, required is 600 crore. Right, you can see clearly that required is 600 crore and they have maintained only 540 crore. How much is the shortfall? Obviously there is a shortfall. So 600 minus 540. So this will give you 60 crore. So that is the shortfall, right? Think that you were supposed to keep 600 crore but had only 540 crore. So you are short by 60 crore, isn't it? Okay. Now they are asking to calculate the penalty rate. They have mentioned clearly that penalty is bank rate plus 3% per annum, and bank rate they have also given 7%. I think this is the simplest question possible. See, don't get frightened by seeing the lengthy question. No. Everything is given in the question. Just go through each and everything minutely. So what is the penalty rate? What would be the penalty rate? It is very simple. You first write the base rate, right? To find the penalty rate, what you have to do? First of all, what you do, right? You write the base rate here. Okay. So it is base rate plus how much? 3% extra. Right, clearly they have written base rate plus 3%. So 7% base rate plus 3%, which is extra. So total become penalty rate become 10%. So that is your penalty rate 10% per annum. Right, this is the penalty rate per annum. Now one concept is that this particular penalty apply only on the shortfall and the period for the default. Please understand. Till when this penalty will apply? See, two things are very, very important. First of all, it will apply on the shortfall only. And second thing is that it will apply for a period of default. Can you tell me what is the period of default? Can you please tell me what is the period of default? It is clearly written for a day default. So means what? Single day, right? So penalty will apply on the shortfall, and that too, the period of default, here the period of default they have mentioned is 1 day. So can you calculate what is the 1 day penalty? Very, very simple. The rate they have given you, 10% they have given, isn't it? 10% is the annual rate, and they have to calculate the penalty for a single day. How to go about calculating the penalty for a single day? Very simple. Just apply the formula, right? Penalty is 10% of what? 10% of obviously the shortfall. Shortfall is how much? 60 crore. So just take 10% of 60 crore. And since this will give you the annual penalty, but you have 10% of 60, right? So what would that be? What would be the 10% of 60? Right, very simple. It is nothing but 6, okay? And since we have to calculate it over 1 day, so we'll multiply it over 1 upon 365. Okay, this is a unitary method, basic unitary method, which you can rely on, right? Now friends, now just apply the formula, right? So it will be how much? 6 crore divided by 365. So approximately if you get the value, it will be 1,64,384, or we can say 1.65 lakh, right? For that day. So if you look at the option that we have, so option number A says that interest C 7% for on 60 crore. What option number A is saying? See, this is the wrong rate, right? Why? Because penalty rate is bank rate plus 3%, so 7% is wrong. Option number B say interest at 10% for a day on 600 crore. So again it is wrong amount. Why? Because penalty is charged only on the shortfall, not on the entire amount, right? That is the point. What about option C? Option C is yes, correct. Right. Option D is also wrong. Why? Because they're saying interest is 7%. Again, this is wrong. So friends, like imagine you promise to keep 600 rupees in the bank locker for safety, but you keep only rupees 540. Just I am giving you one example to understand it more clearly. Imagine that you promise to that you will keep 600 rupees in a locker, but you keep only 540 rupees. So the regulator, they charge a penalty like a late fee, and that fee is charged only when you missed it. Only what you missed, that is the 60 rupees, right? That penalty will be charged on 60 rupees only. So you don't pay the fee on the whole locker amount, rather you pay only on what you missed. So remember what we learned from this question. The key learning from this question is that let me write down the basic learning. Please note it down. That suppose if they ask you to calculate the penalty, right, just remember the formula. Whatever is the bank rate, just let me erase it. Yes. So if they ask you to calculate the penalty, what you need to do? Just write the bank rate. Please note down the formula. Just write the bank rate plus 3%. So it will be mentioned in the question, right? And then multiply it by shortfall, which means how much shortfall it is in terms of amount, and multiply it by time, right? And one more thing is that how to find the shortfall. So to find the shortfall, the formula is very simple. You write the required and you subtract the maintain. Required minus maintain, that is the shortfall, right? And what is the time here? Time is the period of default, right? Time is the period of default. How to find the time? Very simple. Just divide days by 365. That will give you the time. I hope this is clear, crystal clear now. Now friends, let's see the next question. Again, this is a numerical based question. Please go through this question once more. So the question says that a zero coupon bond is there, right? It has a face value, they have given 2,000 rupees. So first of all, zero coupon bond, face value they have given $2,000, I think, not rupees, $2,000. And it is maturing in 8 years. Fine. Now, one more point they have given that if the market required yield, so yield of market is 7.4% per annum and compounded semi-annually. This one is very important. Compounding is to be semi-annually, right? Now friends, question is asking you what is the closest approximate price of this bond? Very good question, right? Please see the key terms which I mentioned here, right? Now options are, options, let me show you 1134.80, 1105.10, 11, these are the 4 options. So first of all, try to solve it on your own. Let me explain. So first of all, do you know the meaning of zero coupon bond? Do you know when I say zero coupon bond, what does it mean? Let me explain. So friends, zero coupon bond means here, but it will pay nothing. It will pay nothing till maturity and then pay the face value of $2,000. How much is $2,000 at the year end, right? At the year end, right? So see, let me show you the cash flow, how it will look like. So initially you have invested how much? $2,000. So this is your investment, $2,000 invested. First year, 0. Second year, 0. Third year, 0. Till 8th year you will get 0. And then till the 7th year. And the last year, last year you will get this $2,000, whatever you have invested, isn't it? Right, but they are offered at a discount. This will not exactly cost you $2,000. It will cost you a little bit less. Fine. Now that is the point. That is about the zero coupon bond. Okay. So basically, it is not offered at $2,000. They will offer you certain discount. You will buy this at certain discount, and this will be redeemed at the face value. Remember, zero coupon bond are bought at the discount value and redeemed at the face value. Right. Now we have to find the price. What the question is asking us to find? Calculate the closest approximate price of this bond. That is what question is asking you, right? So now, how to go about finding the price? Do you know the formula? See, the price is very simple. Let me show you the formula here. Let me show you the formula. See, now basically what we need to do, we have to discount it. We have to discount the price. How to go about discounting it? Very simple. See, this is your cash inflow, $2,000, and just you discount it to the today's date. How to go about discounting? Very simple. So we are trying to find the present value, which is nothing but future value, divided by 1 plus r whole to the power. I think you are familiar with this formula, right? Okay, friends. Now, first of all, we must understand one thing they have written is that, in the question they have mentioned clearly that it is to be compounded semi-annually, right? It is to be compounded semi-annually. So what is R? What is R will be, sometimes I or R. So the IR will be, capital R divided by 2. Isn't it? Because in a particular year there are 2 semi-annual. And what is the capital R they have given? Capital R they have given is 7.4. So it will be how much? 7.4 divided by 2. That would be 3.7%. right? So this is our, R, small r, right? Interest rate. And what about N? Can you tell me what about N? See, capital, so this N will be capital N multiplied by 2. So what is N they have mentioned? 8 years, right? And 8 years. So 8 multiplied by 2. So you can simply think like this. In a particular year, there are two frequency, right? Two compounding frequency. So in 8 years, there will be 60 compounding frequency. I hope it is crystal clear right now. Isn't it? Now let's discount the future value of $2,000 to the present terms. So what will be the number would look like? Look at it here. So 2000 divided by 1.037 to the power 60. Isn't it? So this will, if you calculate it using the calculator, the closest option you will get 111.8.33, which is near about 111.8.33. Is it clear? Right. So that is how we find the closest approximate price of the bond. Right. So friends, remember, think of the bond like a promise. Someone promised to pay you $2,000 after 8 years. If the people require 7.4% return, you will pay less today for that promise, right? How much you are paying? You are just paying 111,118.33. You are just paying that, right? So we calculated what that less amount is. Again, I am repeating. You can think of a bond like a promise, right? Someone promised to pay you $2,000. Suppose I promise to pay you $2,000 after 8 years, right? After 8 years, I promise that I will pay you $2,000. So, and how much return I require? I require is 7.4%, obviously, right? So obviously you will pay less today for that promise. The higher the required return, the lesser you pay now. Suppose instead of 7.4, it goes to 8%. So this rate is increasing, right? So what will happen? The bond price will decrease, isn't it? The higher the required return, the less you pay now. That is what. How do we calculate it? We calculated what that less amount is, and that less amount is 118.33. So remember, the formula that you need to remember is this formula, right? To compute the present value of a zero coupon bond. Please let me know if this concept is clear or not. Friends, if you are looking for study material for CTP examination, we have fully fledged coverage of study material in forms of PDF, videos, mock test, as well as such kind of previous year questions. You can WhatsApp me on this particular number to get detail related to the CTP examination. Many aspirants have cracked the paper using our content. You can also crack in the simplest way possible. Now friends, let's switch our focus to the next question that we have. This is the third question, right? I request you to please try to solve it on your own first and then see the explanation. This will help you to understand the concept. So the question is saying that there is a portfolio, right? And it is generating an annual return of 12%, right? Risk-free rate they have given 5.5%. Standard deviation of the portfolio return they have given 4.5%. You have been asked to calculate the Sharpe ratio. Exactly, this question appeared in the examination. You have been asked to compute the Sharpe ratio, right? Very good question it is. So let me explain how to go about calculating the Sharpe ratio. First of all, you must understand what is the meaning of this term so-called Sharpe ratio. Let me explain it here. Let's understand the meaning of this term. You know it very well. It measures that how much extra return you earn for each unit of risk you take. Very, very important. Each unit of risk you are taking, how much extra return? Extra return is how much? Right? That is called the Sharpe ratio. Now let's plug in the number. Right? Now let's plug in the number. So friends, the formula of Sharpe ratio is very simple. Right? First of all, you write the portfolio return. Portfolio return minus risk-free rate divided by what? Standard deviation. Standard deviation. Now friends, let's plug in the formula, plug in the value that we have. So how much extra return you earn for each unit of risk that you take. Now in this case, as you can see, annual return they have given 12%. Risk-free they have given 5.5%. It is very simple, right? Just plug in the formula. 12 minus 5.5 divided by 4.5. So how much would that be? I think 12 minus 5.5 will give you how much? 6.5 divided by 4.5. That will be 13 by 9. It will be approximately 1.44. Isn't it? 1.44 is the correct answer. Yes, option B is the correct one. Yeah, this one is the correct one. 1.44. Right. So friends, you can think of it like this. Let me explain a way to think about it. Suppose that you invest in a portfolio. Right. It gives you extra 6.5% return. You can see now, risk-free rate is 5.5. What is the meaning of risk-free rate? Suppose you invest in a government bond. And government bond has nothing to, it is the safest bond. That is, there is no risk in there. So the government bond yield will be 5.5, and you are investing in a portfolio where return they are given is 12%. So how much extra return they are generating? Tell me. How much extra return they are generating? Obviously, nothing but 12 minus 5.5, which is equal to 6.5%. The 6.5% extra return they are generating, right, above the safe option. But yes, you took 4.5 unit of risk. What does the standard deviation indicate? A standard deviation is indicating that how much risk you are taking. Think about it. For 4.5 unit of risk you are taking, you are getting 6.5% return. Now the question is, for the 1 unit of risk you are taking, how much return it is generating? That's called the Sharpe ratio. This is the simplest way one can understand. Think about it like this. Unitary method. You know about unitary method? I think you know it very well. See, what I am telling you, that for 4.5 unit of risk that you are taking, it is generating you how much return? 6.5% return. So for 1 unit of risk that you are taking, how much return is being generated? Just divide by that. It will be nothing but 13 by 9. It will be how much? 1.44. That is the correct answer. So option number B is the correct one, right? So that is what Sharpe ratio tells you, that reward per unit of risk. Just remember this keyword. It tells you reward per unit of risk. See, this way we understand each and every concept. See, whenever I provide you a question, I explain you each and every part of it, right? So that you have a clear understanding of it. So better see, two things to remember here. Again I am repeating. Please remember this formula. Let me again show you the formula. Please note down this formula in your notebook or somewhere else. Please note it down. This is the super important formula. Portfolio return minus risk rate upon standard deviation. And second thing you need to remember is that higher the Sharpe ratio, base risk adjusted performance. So the question may ask you whether Sharpe ratio should be higher or lower. The answer is should be higher, right? Now friends, let's have a look at this part of the question. This is one of the most, familiar question. Every time you ask in the examination, they are asking you to calculate the convexity of the bond. So now let's see how to go about calculating this question. Now friends, think about it. What data they are given? 7 years, 7% coupon bond. They are currently trading at $105.180. Suppose bond price increased to 106.50. Okay, it has increased to this much, and yield drop by 10 basis point. And bond price decreased to this much when the yield rises by 10 basis point. So what is the convexity of the bond? Very good question it is. Right, options they have given: 210.24, 305.50, 155.65, and D none of them. Very good question. So first of all, what is the meaning of convexity? Let me show you the formula. What is the formula that we use to compute the convexity? See, let me write it down the formula here. Just wait a minute. Yes. So if you want to compute the convexity, right. So first of all, you write up P plus, P minus 2 times P naught divided by P naught multiplied by delta y divided by 2. Right. So this is the formula that we use to compute the convexity. Now in this case, what is P1, what is P minus, what is P naught? Let's understand. So you can see, right. So friends, please understand, very, very important thing I am telling you, that, see, price P naught means what? P plus. What is the meaning of P plus? P plus means, price if the yield fall. Sorry. Yes, correct. Price if the yield fall. Okay, you know it very well that, price and yield are inversely proportional. I think you know it very well. Whenever yield will fall, price is bound to rise. Okay, so P plus means what? Price is rising. Okay, and when price will rise? When yield will fall. Okay, so what is the price when yield fall? It is nothing but P plus is how much? 106.50. Now what is P minus? P minus indicates, decrease in the price. No, sorry, decrement in the price. Obviously, when the yield will rise, price will decrease. And what is the decrease in the price? Okay, it decreases to 103.95. Okay, this is P minus. Okay, now you may ask me what is P naught? Yes, very good, I will answer it. So P naught is the current price. What is the current price? This is 105.180, isn't it? 105.180, that is your P naught. Okay, very good. So we know P plus, we know P minus, we know P naught. Now you have to just plug in the formula. Let me apply the formula here. And what is delta y? What is delta y? Yes, delta y is the change in the yield. And remember, this has to be written in terms of decimal. They have written, 10 basis point. Okay, so 10 basis point is what, it simply means 0.001, right? 0.001 in terms of decimal. Now plug in the number. So now we know what is our P plus, what is our P minus, what is our P naught, and what is our, delta y. Just plug in the number. So P plus will be how much? 106. 0.50 plus T minus will be 103.95 minus 2 times P naught 105 plus 180. I request you to please solve the question on your own, and if you really think that this video is helping value to your preparation, please hit that like button. It will encourage me to make more such content. Now what is P naught here? P naught they have given 105.180, and what is delta Y they have given? Delta Y they have given 0.001 upon 2. So if you calculate it, you would get 210.24. That is your convexity, isn't it? So now if you look at the option, you can see directly that option number is the correct one, right? So other options are not matching the data, that's why they are wrong. I hope this is crystal clear right now. So friends, now the question is, how can you interpret this convexity? Now that we have calculated this convexity, what's the meaning of it? What is the physical interpretation of it? Let's have a look. You can think of the duration as the slope of the road. Suppose this is the road, right? Suppose this is the road. Okay, you know, it has a slope. So this slope is, you can think of the duration, right? You know, it tells you, this duration will tells you how steep price change or when the yield moves a little. You know it very well, that when the yield will change, price will bound to change. And this slope tells you that what is the effect in price when the yield is changing. That is what this slope tells you. Now, if you look at the convexity, if you talk about the convexity, you know, convexity is like the curvature of the road. Right? It is like the curvature of the road. It tells you how the slope itself changes. Yes, it tells you the rate of change of slope. Convexity tells you that rate of change of slope. See, slope tells you rate of change of price with respect to yield, and convexity tells you rate of change of slope. That's the difference, right? How the slope itself changes when the yield moves further. And you know it very well. Suppose there is a bond which have high convexity. Suppose there is a bond which have high convexity. What happen, you know, when the rate fall down, bond price increase a bit more than the duration predicted. See, suppose that yield is decreasing. Duration is predicting that there will be, you know, bond price will rise just by 0.1. But you know what happened in reality? Convexity predicts that it will rise by 0.2%. Right? So that is the indication that, you know, this bond has high convexity. So what I am telling you, suppose there is a bond which have a high convexity. It tells you that when the rate fall down, bond price increase a bit more as compared to the duration, what duration predict. And when the rate rise, what will happen? When the rate will rise, you know what will happen? That, you know, price fall extra bit less than, right, duration predict. So that extra band is very, very helpful, right? This extra band is very, very helpful. It cushions bond price when the rate swing, isn't it? So you can think of it like a trampoline. Have you seen a trampoline? High convexity versus a flat plank, low convexity. Suppose this is the flat plank, right? It has a low convexity, and trampoline, you know, it is a high convexity. So the trampoline responds more smoothly and gives back more when you bounce up and down. So friends, please remember what you learned from this question. First of all, you must note down this convexity formula. This will surely help you, right? So this is the formula that we use to compute the convexity, first point. And you know, use observed price change for a small delta Y change in the yield. And one more thing is that question may be asked whether convexity should be higher or it should be lower. Remember, convexity should be higher. Suppose our convexity increases, what does it indicate? It indicates that you have a better protection against the interest rate swing. So extra price gain when the rate fall and a smaller loss when the rate rise. That is, it's in practical. Remember, you know, duration tells you the slope, convexity tells you the band. If you like this style, please hit that like button. I will explain each and every concept in the lucid manner, as much lucid as possible, so that you can understand in the layman terms. I hope this question is very clear to you. Now, have a look at the next one. So friends, as I told you already, 40% of the syllabus of the question paper is about the numerical. That's what we are focusing on right now. Now the question is asking you to compute the annualized yield on what? 91-day treasury bill. Face value they have given 100, currently trading at 98.80. And option they have given, these are the options, these are the 4 options. You have been asked to compute the annualized yield. Yes, very good. Again, I am telling you the formula. So I request you, please have a sheet of paper, right? A4 size sheet of paper. Till now, we have discussed 3 formulas. You remember it? Please note it down. They will surely help you in the examination. Now there is the 4th formula, which I am telling you right now. So this is the formula that you need to remember to compute the annualized yield. That is what we are focusing on, right? Annualized yield of a bond. What is the formula? Face value minus purchase value upon purchase, sorry, just wait a minute, not purchase value, it's wrong. Face value minus purchase price upon purchase price multiplied by 100. Sorry. And one more thing is that Okay, since we are computing the yield, right? We are computing the yield. So what we need to do? 365 upon day to maturity multiplied by 100, right? So this is how we go about computing the annualized yield, right? Face value minus purchase price upon purchase price into 365 upon day to maturity 200. Now let's plug in the number. How much face value they have given? Face value they have given 100 rupees. You can see how much present price they have given 98.80. So it will be how much? 100 minus 98.80 divided by 98.80 multiplied by 365 divided by 90 multiplied by 100. Right. So that is the point. So this gives you the discount, right? If you look at the numerator here, if you just look at the numerator, this gives you what? This gives you the discount. So divide the discount by the purchase price. Okay. So divided by discount by purchase price, if you compute it using calculator, it will give you how much, 0.01214. This will give you, right? And if you compute it, this will give you how much? 4.01098 multiplied by 100. And if you compute finally, this will give you 4.87%, right? If you round it off, it will be 4.87%. Now friends, let's look at the option. I think nearby is 4.89. So this will be the correct answer. Okay. So friends, this is a very, very important formula that you need to remember. This is called treasury bill yield. Imagine that. Let me explain what is happening here. Imagine that you buy a coupon for how much? So you buy a coupon. You have invested how much? 98.80. You have invested today. Okay. And it will be redeemed at 100 rupees in 91 days. So after 91 days period, you will redeem it at 100 rupees. Is it clear? Please try to understand what this question is asking you to compute. I am explaining it. So after 90 days, 91 days, you will get 100 rupees. That is using redeeming. So basically, how much is the gain? That gain is how much? 1.20 rupees gain, isn't it? So that 1.20 rupees gain over the 91 days is your return. Right? This is what your return says. And if you want to compare it with annual return, we scale up to a year. Yes. So if you look at this particular formula, this thing is used for scaling up. Is that we are scaling it up? That's why our numerator is higher and numerator is lower. That's why we are scaling it up. Isn't it? Right? And that gives you roughly the annualized return. See, this is the very simplest thing to understand. Please try to understand. I have invested 98.90. After 91 I am getting 100 rupees. So how much is the return we are getting? Return is I am getting in terms of rupees is 1.20. Isn't it? This 1.20 I am getting over 91 days. Right? So, okay, sorry. Yes, this 1.20 I am getting over 98.90 purchase price. Right? And just we have to scale it up. How to scale it up? Very simple. You just write the 365 in the numerator divided by 90 in the denominator. And by 100%. This will give you the yield. This is one of the most favorite question that we have asked every year. Right? Please understand this question, very, very important from a Jameson point of view. Now friends, let's have a look at the next question. So now we will solve a quick MCQ on delta hedging. Yes. So this concept is delta hedging. Let's understand it. So a risk manager at a bank, he has written or sold put option. He is totaling how much? I think it is 15 lakh. Right? 15 lakh dollar with a delta of how much? Minus 40%. How should the bank hedge its position using the underlying bond? That's the question. Very good question. Options are 4 options they have given you. Now friends, delta, what is the meaning of this delta? Delta tells you how much the option position changes for a small change in the underlying. Right? How much the option position change for a small change in the underlying. Let me explain. What is the formula for delta? So for the whole option position, if you compute the delta equivalent, it will be how much? It will be notional amount multiplied by delta. Let's plug in the value. How much is the delta equivalent they have given? You can see clearly they have given 15 lakh dollar. So just write 15 00 000 and multiplied by what? Multiplied by the delta amount. What is the delta value they have given? Minus 0.40. So it will be minus 0.40, isn't it? So after calculate, this will give you minus 6 lakh. Right? So this is your delta equivalent. Now this minus 6 lakh, it means the option portfolio behaves like a being short How much? $6 lakh of the underlying, because the delta is negative. To neutralize that, when I say neutralize that, what I mean to say, to make delta 0, that is when you will neutralize it. To neutralize that, we must take an opposite position of how much? We must take an opposite position of plus $6 lakh, right, in the underlying. That means, bank should buy bond worth $6 lakh. After buying, what will happen? This will get neutralized and finally our delta will be 0, right? If you look at the option that we have, so option A is saying sell bond worth 6 lakh, correct, incorrect. Yes, this is the correct one, right? See, combined with the $6 lakh from the written put, the net is 0. So a small move in the bond price won't cause a first order profit or loss, right? So you can think of this put position, let me explain. So this is the kind of put position. So you can think of a put position as owing someone $600, right? As owing someone $600 every time a price rises slightly, which means you lose when the price rises. To stop losing, you take the opposite side. You buy something that gains $600 when the price rises. That cancels the loss. So if you are owing $600, buy plus 600 worth of thing, simple offsetting. So just remember in one word, if I want to summarize all this thing, whatever I have talked just now, just remember this key point. Please remember it. So whenever you see this word, delta hedge. Right. So delta hedge, you take the opposite. You take the opposite position equal to how much? Notional multiplied by delta. You take the opposite position. If the result is negative, suppose the result is negative, buy that amount. See, if the result is negative, you buy that amount. Or if the result is positive, right, you sell that. Summarize this delta hedging in just 1 minute. Compute the delta equivalent and take the opposite position. That's it. Right. That is how you can compute it. And if I hope this is crystal clear right now. Now friends, let's see the next question that we have. Yes, high kurtosis. Very good question it is. So the question is asking basically kurtosis, which is a concept in statistics that help us understand the shape of return distribution in finance. So the question is, which of the following best characterize, right, basically a probability distribution for a portfolio return that exhibit high kurtosis? Options are, the distribution has a flattened center with a very short tail, indicating low frequency of extreme value. Option B says that it features a prominent central peak around the average and exhibit higher chance of outlier return due to heavy tails. Option C, the distribution is uniform with no pronounced peak or tails. And option D, there is a broad spread in the middle and extremely thin tails, meaning very few extreme gain or losses. These are the options that we have, right? So friends, let's understand. Let's see first of all, let's understand the meaning of high kurtosis. So whenever I say that kurtosis is high, it means the distribution is very peaked at the center, right? Distribution is peak at the center. Please remember it, right? So that is the meaning of high kurtosis. Distribution is peaked at the center, right? Which means most value are close to the average. Like if you draw the normal distribution curve, it will be something like this. Yes, all maximum values are near the normal. This is the average. Okay, but it has also a fat and heavy tail. It will also have a fat and heavy tail, right? Which means that more chance of extreme events like big gain or big loss. That is called high kurtosis. So whenever I say this high kurtosis, it means two things. Please understand it. It means that it is peaked at the center, which means most value are close to this average. It also means that it has a fat or heavy tails, which means that more chance of extreme event. So in finance, if a portfolio has a high kurtosis, you might usually see a stable return. Yes, in the context of finance, what you will see the stable return. But sometimes, sometimes very big surprises, either very good or very bad, right? Think of it like this. Most of the time, you are driving on a smooth road at average speed, but occasionally you hit a huge pothole or a speed bump that shake everything. That is a fat tail. That is called, fat tail. You hit a pothole or you hit a speed bump that shakes everything. So that is a fat tail. It is quite rare but extreme outcomes, right? Now let's look at the options that we have. Option A says that flattened center with very short tail. That's completely wrong. Why? Because that is actually low kurtosis. It indicates what? It indicates low kurtosis. Right? It means everything is more spread out in the middle and extreme events are very rare. Opposite of what we want right now.
What about option B? Yes, it is the correct one. You can see now, prominent central peak around the average and higher chance of outlier return. Yes, very good. This is the correct one. What about C? C says that distribution is uniform. See, that is when outcomes are equally likely, right? Like a rolling of fair dice, no peak, no fat tail, definitely not kurtosis. What about D? It says that there is a broad spread in the middle and extreme thin tail. Again, this means very few extreme. That is low or normal kurtosis, not too high. So friends, please remember what we learned from this question is that whenever you see high kurtosis, two things must keep into your mind. See, if I say high kurtosis, it means tall peaks. Let me write it down. It means tall peaks plus tall. It will be very tall, right? Very tall plus fat tail. Just remember these two words, right? And more chance of outlier, more chance of extreme event. And this is important for portfolio risk analysis because extreme loss are more likely. So high kurtosis means high chance of extremes, even if average low. Now friends, let's see this particular question. It is asking you, a portfolio manager, he decides to invest in a long-term bond despite current low yield, right? A portfolio manager, he decides to invest in a long-term bond despite current low yield. Apart from anticipating a further decrease in the interest rate, what is another strong reason for such a strategy, right? So very good question. Options are maximizing short-term profit, meeting future liability commitment, increasing trading volume. D says gaining media attention. C, what do you think is correct? So let me explain. So what happened? Many institutions like banks, right? Many institutions like banks and insurance companies, pension fund, they know that they have to pay a large sum in the future. For example, pension payment, insurance claim, or maturing deposit. So buying long-term bond that mature around the same time as those payment means the institution will have the money exactly what is needed, right? When needed. See, I think you know it very well that these kinds of institutions like pension fund, mutual insurance and banks, they know it very well that they have to pay a large sum in the future. They are familiar with this thing, right? What? To pay large sum in future. Now you think about it. How do we get this large sum? So what they do? They invest in a bond which have a longer maturity and maturity around the same time as those payment means, right? It means that institution will have money exactly when required. So this practice is called ALM, asset liability management, right? Matching the timing and size of the asset to the future liability to reduce the risk. Obviously, so this ALM, what they are doing, they are reducing the risk, right? I hope it is clear because they have a future liability of paying the depositors, and then to meet that future liability, what they require what some kinds of investments in the bonds, right? Even if yield are low today, matching future cash need is often more important than chasing a small star return. Imagine that you must pay your child college fee in the 10-year. You buy a 10-year safe bond now so that you are sure that money will be there at the right time. You are not trying to make quick money. You are securing a future payment. That is what you are doing. Now let's look at the option. So the question is why? Why this is one of the strong strategy? Option A, maximizing short-term profit. See, this is wrong because long-term bonds are held for medium or long horizon, not for short-term gain. Buying long bond when yield are low is usually not a play for quick profit. Option B, meeting future liability commitment. Yes, that's the correct one, right? Now option C, increasing the trading volume. See, this is wrong. Why? Institutional strategies like ALM, they focus on holding and matching cash flow, not boosting the trading activity. Increasing volume is not a meaningful reason to buy long bond for liability matching. What about the gaining media attention? This is also incorrect because this is wrong and this is irrelevant. Portfolio decisions should be driven by risk management and the cash flow need, not publicity. Media attention is not a legitimate investment rationale. So the correct answer to this question is option number B. Please remember, the primary reason is matching the future liability. This is the primary reason. Matching the future liability, that is our ALM. This ensures that funds are available when the payment fulfilled due. Long bond can provide predictable cash flow at the right time even if current yield are low. And this is not for short-term profit. Trading, not for trading volume or publicity. Please remember it. So one line you can remember it. If you pay money later, buy an asset that pay when you must pay. Right? That is an ALM. I hope this is crystal clear right now. Friends, I'm just wrapping up this session right now. If you want to see, we have 100 questions available. And this PDF is available in our course. Course name is CTP course.
which includes unit-wise theory, unit-wise MCQs, previous year question, as well as the capsule content. If you want to grab this, please WhatsApp me on this particular number, or in the description section of the video, you will get the link to access the course. So if you want me to bring the part 2 lecture of it and explain like I'm explaining right now, please just write yes in the chat box, in the comment section. Right, I will bring the part 2 also. I hope this video was useful for you. Please hit the like button, share with other CTP aspirants, and so it like they move in an opposite direction. You can think of them like seesaw, right? So if the interest rate goes up, suppose interest rate goes up, what will happen? Bond price will go down, and vice versa. For example, imagine you own a bond paying 5% interest. You own a bond paying 5% interest. Suppose the new bond goes down. Suppose interest rate goes up, so bond price will go down. Just I am giving you the example. Suppose you own a bond that pay 5% interest, and now if the new bond just pay only 6%, so what will happen? This bond will become less attractive. Your 5% bond will become less attractive, so its price will drop. So there are 3 bond price scenario. Let's have a look. So let me write down here bond price. Let me show you the table only. So yes, this table I'm talking about. See this table. These are the 3 scenario. See, this is not just a MCQ session. I'm trying to give you the concept that will help you solve such kind of question. First thing is that if the bond price is less than the face value, so this is called selling at discount. Because market price of the bond is less than the face value, it means you are selling at the discount. And in that case, YTM, that is yield till maturity, is larger than the coupon rate. And if the market price of the bond is more than face value, then we are selling it at premium. And in that case, coupon rate will be higher than the YTM. And if the market price of the bond is equal to the face value, you are selling at par, and YTM is equal to the coupon rate. So let me give you one example to make it more clear. For example, suppose a $1,000 bond is there, right, with 5% coupon. $1,000 bond, 5% coupon, and suppose it is sold for $900, right? So obviously it is a discount because you are selling at just rupees 900, where the face value is $1,000. So in this case, YTM is higher than, in this case, the coupon rate is 5%. So in this case, your YTM will be larger than 5%, right? Because you are paying less for the same income. YTM will be larger than the 5% because you are paying less for the same income. Because you are basically, what is happening, that same $1,000 bond with 5% coupon sell for $900, right? So you are paying less, so its YTM is increasing. YTM is what? Yield. So yield you are getting more because you have to pay less because it is a discount, right? And suppose if you sell the same bond, if you sell right, so suppose if you sell it for if you sell it for $1,100, which is a kind of premium, so in this case YTM is lower because you are paying extra, so your return is less. Obviously, since you are paying extras to buy this particular bond, you have to pay $1,100, but its market value is just $1,000. So in that case, basically face value is just $1,000. So in that case, you are paying more. Since you are paying more, so your YTM will decrease. So please remember this table, and using this table you can answer all the questions. Let's see the option. Option A, if the bond is trading at premium, is YTM is higher than the coupon rate. Option B, if the bond is trading at par means market price is equal to the face value. If a bond is trading at par, coupon rate is equal to YTM. Option C, when interest rate fall, bond price also fall. Option D, bond price and market yield always move in the same direction. So see, which option tells you the correct picture? So obviously it is option number B. Yes. So if the bond is trading at par, its coupon rate and YTM will be same. B number is correct. What about A? A says that bond is trading at premium, its YTM is higher than the coupon rate. See, just now I told you, suppose a bond is trading at a premium, it means that you have to pay more, and since you are paying more, so YTM will be less. So this is not the correct answer. What about option C? If interest rate fall, bond price also fall. This is just the reverse, because price rise when the rate drop. We know it very well. So C is incorrect. What about option D? Bond price and market yield always move in the same direction. See, this is opposite. They move in the opposite direction. So option D is also incorrect. So the correct answer to this question is option number B. I hope that makes sense to you. Now friends, let's look at the next question that we have. The next question is related to the certificate of deposit. So the question is like this. Suppose you are thinking about saving money safely while earning interest. So a certificate of deposit could be a great option. But how does it work? Let's see this particular question. The question is, which of the following correctly describe the key properties of a certificate of deposit? So option A say that a certificate of deposit is a flexible saving account with no fixed term, offering variable interest and unlimited withdrawal. Option B say that CD is a time deposit offering fixed or variable interest over a predetermined time and is insured and typically incur penalty for early withdrawal. Option C say that CD is an equity linked investment tied to a stock market performance and carry higher risk but potential higher return. And option D say a CD allow continuous additional deposit throughout its term and is not insured by any government agency. So basically, first of all, what is CD? A CD, you can think of CD as, is a kind of time deposit, right? You agree to lock your money away for a fixed term, like 6 months, 1 year or 5 years. In return, the bank pay you interest. What you will get in return? The bank pay you interest. Plus, you also get interest usually at the fixed rate. Let me give you one example to make it more clear. For example, suppose you deposited $5,000, right, in 1 year certificate of deposit, right, at 4% interest. So you deposited $5,000, 1 year certificate of deposit, 4% interest. So after a year, you get back how much? You get back, after a year, you get back $5,200. Your original money plus $200 as interest. So that is the point. That is about CD, certificate of deposit. So what are the key terms, key features of CD? So if you talk about the key features of CD, first of all, the term is fixed, which means, you can't withdraw early. You can't withdraw. This is the first point. Second point is, guaranteed interest. Guaranteed interest. Unlike a stock, your rate is locked in. Your rate is locked. Guaranteed interest you get. And I told you that it is FDIC and NCUA NCO, which means up to $2 lakh. Remember, in the US, if we talk about $2.5 lakh, right, it is insured. Your money is safe even if the bank fail in the US. And early withdrawal penalty is there. If you withdraw early, if you take money out soon, you will lose some interest. So friends, let's look at the option. Option A says it is a flexible saving account with no fixed term. This is completely incorrect. Because CD have a fixed term and penalties are there. It is saying that unlimited withdrawal. No. There are penalty for early withdrawal. Option B is saying that it is a kind of time deposit offering fixed or variable interest over a predetermined term and is insured and typically incurs penalty for early withdrawal. Yes, completely correct. B is the correct one. What about option C? It is equity linked investment. No, it is completely wrong. CD are low risk investment and does not depend on stock. And D say it allow extra deposit. No, it is false. Once you open a CD, you can't add more money later. So let me give you a real life example to make all this concept more relatable to you. Suppose you have $10,000, right? Suppose you have $10,000. Suppose you have $10,000. Suppose you have $10,000. So that you won't need for 2 years. So this $10,000 you won't need for 2 years. So you have two options. Option number 1 is to put it in saving account. Option 1 is to put in the saving account. It's quite flexible, but it offers you low interest. And option 2 you have is to lock in for 2 year CD, 2 year certificate of deposit. You lock it in for 2 year certificate of deposit at 4.5% interest. You lock it for 2 years certificate of deposit at 4.5% interest. And after 2 years, right, after 2 years you will get how much? After 2 years you will get $10,900, right, dollar. So out of which 10,000 is your principal plus 900 is your interest. But if you withdraw early, you might lose 3 months of interest as penalty. Right, if you withdraw it early, you might lose, that is called withdrawal penalty. Early withdrawal typically incurs penalty. So let's recapitulate what we have covered in this particular question. So what I told you that these points are regarding the CD, certificate of deposit. So the first point is that they are like time deposit. CDs, they are like time deposit. Okay. Then we talked about that higher interest than regular saving. Right. So they offer you higher interest rate as compared to regular saving. But there are penalties for early withdrawal. Yes, there are penalties for withdrawal. For withdrawal there are penalties. Then I told you it is quite safe and it is insured. Quite safe and insured. Like FDIC, NCUA,
up to 2.5 lakh dollar in US. And I told you they are not flexible. Not flexible means what? No extra deposit or easy access before maturity. So these are the 5 points which we need to keep in mind regarding the CDs. Now friends, let's switch our focus to the banker acceptance, or we call it BA. So ever wondered how big companies safely pay for good across border? So enter the banker safety acceptance, or BA, a handy financial tool that make international trade smooth and secure. Let's break it down in simple terms. What is this banker acceptance? So the question is, which of the following correctly defined banker acceptance? Option A negotiable equity security guaranteeing ownership right in a bank. Option B, a short-term debt instrument issued on a foreign exchange contract with no bank guarantee. Option C, a time draft guaranteed by a bank for a future payment, negotiable in the secondary market, commonly used in the international trade. Option D, a long-term corporate bond secured by bank collateral. So first of all, the question is, what is this BA, or what is this banker acceptance? See, it is like, short-term IOU. It is like, short-term IOU. What is IOU? Like a post-dated check. Short-term IOU, like, post-dated check, right? That a bank guarantee. So it is used mostly in the international trade. They are used mostly in the international trade, right? To ensure that seller get paid on time. So mostly this banker acceptance is used in the international trade to make sure that seller get paid on time. To make sure that seller get paid on time, right? For example, take the case of US importer. Take the case of US importer, right? Which buy electronic from Germany. This US importer, it buy the electronic from Germany. Now the German seller want payment security. So the importer bank issued a banker acceptance promising to pay in 90 days. So basically that is the use of this banker acceptance. I told you now that is used in the international, it is used in the international trade, right? Suppose a US importer is there, and this particular US importer, he buy electronic from Germany, right? The German seller want payment security. So the importer bank issues a BA promising to pay in 90 days. Now let's look at how does it work. First of all, if we look at the how does it work, then there is something called, bank guarantee, BG. The bank say that we will pay if the buyer can't. That is called BG, bank guarantee. Second point is that it is short term. This is for short term, which means usually last 30 days to 180 days. It usually lasts 30 days to 180 days. Third point I told you, they are tradable. Tradable means what? It can be sold to other investor at a discount. At a discount, you can sold it to the other investor before the due date. And the fourth point is risk is quite low, which means since a bank back it, yes, bank is backing it, so low risk is there, right? So friends, let's look at the option. Option number A say a negotiable equity security guaranteeing ownership right in a bank. No, this is wrong, because BAs are debt. Remember, banker acceptance are like debt, right? They do not own ownership in a bank. What about option B? A short-term debt instrument issued on a foreign exchange with no bank guarantee. See, this is wrong. This word is wrong. No bank guarantee is wrong. Actually, the whole point is the bank promise. The whole point is the bank promise. This is the whole point. What about option C? A time draft guaranteed by a bank for future payment, negotiable in the secondary market, commonly used in the international trade. Yes, it is used in the international trade, negotiable in the secondary market, and used by the bank for future payment. Yes, all these points are covered. That's why option C is the correct. What about option D? A long-term corporate bond secured by bank collateral. No, this is also wrong. It is not a long-term corporate bond. Rather, it is a short-term corporate bond. It is quite short-term. So this long-term word is wrong. So if I provide you the real-life example, take the case of Mexican car part. Supplier sell to Canadian buyer. Problem is that the supplier worry that buyer might not pay. Solution is that the buyer bank issues a banker acceptance saying that we will pay $1 lakh in 60 days. So the supplier can wait 60 days for full payment, and supplier can sell the banker acceptance early for $98,000 at discounted price to get the cash now. So let's recapitulate what we have covered regarding the banker acceptance. First of all, I told you that they are just like bank guaranteed IOU. First point I told you regarding this banker acceptance, that they are the bank guaranteed IOU, right? They are the bank guaranteed IOU, guaranteed by bank. First point. Second point is, they are for short term. They are for short term. Third point I told you, short term basically means 1 to 6 months. Third point I told you, they are used in the international trade. Sorry friends, they are used in the international trade. And the fourth point is that they are not stocks. They are not long-term bond. They are neither stock, they are neither long-term bond. Rather, they are safe liquid investment. So these are the points that we need to keep in the mind. Now friends, let's look at about settlement risk. The question is, which of the following statement about settlement risk is accurate? Yes. So let's see the option. Settlement risk arises when a party fails to fulfill its obligation at settlement, such as delivering security or cash. Option B. Settlement risk is exclusive to the stock market and does not apply to the foreign exchange. Option C. Settlement risk can be fully eliminated by simply using clearinghouse. Option D. Settlement risk refers only to the timing delay in settlement but not to actually non-delivery. So friends, imagine you sell your bike online, ship it first, but the buyer never pay. That is the settlement risk. In a nutshell, in finance, this risk happens when one party does not hold up their end of the deal. Let's break it down with a real world example. First of all, we are talking about the settlement risk, right? So the danger that one party deliver but the other party does not. This is the danger that one party deliver but other does not. Right? That is called settlement risk. It is also called, Hostad risk. It is also called Hostad risk, which is named after a 1974 German bank collapse during a foreign exchange trade. So suppose, let me give you one example of this settlement risk. Suppose you wire $10,000. You wire $10,000 to buy stock. You wire $10,000 to buy stock. But the seller never transferred the share. The seller never transferred the share. So that is the settlement risk. Now the question is, where does it happen? Yes, this is a very or bond or forex or derivative. Fine, not just one market. And most commonly, it is most common in the forex trade. This settlement risk is most commonly seen in the forex trade. Why? Due to time zone difference. Yes, this time zone difference plays a critical role. The reason is, time zone difference. Right? And for example, one bank pays in euro before receiving dollar. Right? And if you talk about the types of settlement risk, so there are two types of settlement risk. The first one is called default risk. What happened in the case of default risk? Suppose two parties there. Party A send money. Party A send money. But party B never deliver. Party B never deliver. Right? The goods. Party B never delivered the goods. So this is called, default risk. And the second kind of risk that we have is called the timing risk. What is timing risk? Suppose party B deliver late. Party B delivered late, leaving party A exposed in the meantime. So these are the two kinds of settlement risk. First one is the default risk, second one is the timing risk. Now the question is how to reduce the settlement risk. So if we want to reduce the settlement risk, so we can use this DVP system or PVP system, delivery versus payment, right? So it ensures that both sides exchange assets simultaneously. Both sides exchange asset simultaneously. This is ensured by DVP versus PVP system. Second one is the clearinghouse. Yes, clearinghouse also plays an important role. They act like a middleman. They act like a middleman to guarantee trade. This clearinghouse act like a middleman to guarantee trade. Then the another way is netting. Netting is another way to reduce the settlement risk. So bank offset mutual debt to reduce what is on. Offsetting the mutual debt to reduce what is on. So let's look at the other option that we have. So first of all, option A says that it arises when a party fails to fulfill its obligation at settlement, such as delivering security or cash. Yes, this one is correct. What about B? It is exclusive to a stock market and does not apply to foreign exchange. This is completely wrong. I told you now, it often huge in the forex. There is a huge forex risk. Right, settlement risk is the huge in the case of forex. What about option C? It says that it can be fully eliminated by simply using a clearinghouse. No, they reduce the risk, but they cannot remove it entirely. What about D? This refers only to the timing delay in settlement, but not to actually non-delivery. So see, this is option D if we talk about. And this is only about delay. No, it's not about delay. It includes complete failure also. So let me give you one example of the settlement risk to make it more clear. So take the example of US company. Suppose US company buy €1 1 million euro of goods. Suppose it buy 1 million euro of goods from France. Okay, France, payable in euro. That has to be payable in euro. The risk is that US bank send euro at 9 a.m. but the French bank failed before confirming dollar receipt due to time zone. The result is that the US company loses $1 million with no goods. That is called, settlement risk. So let me summarize what we have covered so far in the settlement risk. I told you, it is just like, you paid, but they did not receive. You have made the payment, but they did not receive. That is settlement risk. Second point I told you, it happened in all market. This kind of settlement risk, it happened in all kind of market. It happened in all market, right? Especially forex market. Especially it happened in the forex market, and another name of this I told you, Husted risk. Husted risk name is same as this one. Then I told you it includes default. It includes default and delays. Default and delays are included. And how to reduce it? It can be reduced by DVP or PVP, right? It can be reduced by clearing house, and it can be reduced by netting, but never fully gone. Now you see why bank and trader worry about settlement is so much. Now friends, have a look at the next question. Friend, if you want such kind of content in form of videos, in form of PDF, right, you can enroll in our CTP course. CTP course, that is a course which is available on our app. App name is JIV and CIV made simple. Or for more detail, you can WhatsApp me on this particular number. Now friends, have a look at this one. Such type of numerical question are being asked regularly in the examination. So if you want to see how your money grow, let's break down how this rupees 20,000 which is you have invested at an annual interest rate of 8%, right, in 2 years, how it compounded annually. So the question is, what will be the future value of your investment? So first of all, let's understand what is this CI, what is this compound interest. So this is like, interest on interest. So you earn return not just on your original money, but also on accumulated interest. For example, like a snowball rolling downhill. What is the formula for calculating the future value? This is nothing but principal multiplied by 1 plus r whole to the power t. That is future value. So in this case, what is the principal? Principal is the 20,000 rupees. What is 1 plus r? R is 0.0. What is t? T is a 2 year. Fine. So compounded annually, t is equal to 2 year and compounded annually, so n is equal to 1. So let's calculate it one by one. So it's quite simple to calculate, right? So what will be the interest for first year? Interest for first year will be 20,000 multiplied by 8%, which will be 1600. So total will be how much? Total will be 21,600. Now what will be the interest for year 2? 21,600 multiplied by 6%, sorry 8%. That will be how much? 1728. And if you add this 21,600 plus 1728, this will give you 2,328. So near about 472. This is the nearest option that we have. Context of bond. Let's understand the meaning of put in the context of bond. So basically a put option let bondholder demand early payment. It let bondholder demand early payment. Right. So put option let the bondholder so that bondholder can demand early payment. Early repayment before maturity. So bondholder can demand early repayment before maturity through the put option. This is the first point. So there are two types of put option. The first is called soft put. What is the meaning of soft put? Soft put, it means flexible repayment. Your repayment is quite flexible. That is called flexible repayment. And what is the meaning of hard put? So hard put, it means strict cash only. It is quite strict. It says cash only. That's it. So basically this soft put is a kind of flexible repayment. So what happened in the case of soft put? The issuer can repay you in. So in the case of soft put, in the case of soft put, whoever has issued the bond, they can repay you. The borrower can repay you. The borrower can repay you in cash. The borrower can repay you in subordinate notes, and like new IOU, he can repay in stock or he can repay in mixture. Right. For example, suppose you hold a 10,000 rupees bond. Let me give you one example. Suppose you hold 10,000 rupees bond with a soft put. Suppose you hold 10,000 rupees bond with a soft put. Okay. So at redemption, what happened? At the time of redemption, when you want to redeem, obviously there is a time of redemption of the bond. At the time of redemption, the company might give you 5,000 cash plus 5,000 in share. right? So this is a kind of, soft put. So hard put, it is only cash repayment. Hard put means cash only repayment. So in the case of hard put, what happen? The issuer must repay in cash. No substitute for that. So same, take the case of same 10,000 rupees bond, right? With a hard put. Suppose it is a hard put. Okay. Same 10,000 rupees bond with hard put, right? So you get 10,000 rupees in a cash. So basically soft put is riskier for investor because you might get stuck with share or IOU instead of cash, and hard put, it is safer. Let's look at the question. The question is, the bond with soft put provision differ from the hard put. Option A says that soft put allow bondholder to redeem only in cash at the predetermined date. No, that is wrong, because soft put include all the case, some part cash also, some part stock also, IOU also, not completely in cash. So option A is wrong. What about option B? Option B says that a soft put permit redemption in cash, subordinate notes, a stock, or a combination, while a hard put restrict redemption to cash only. Yes, this is the perfect answer. This is the correct answer to this particular question. What about option C? Short put means the bond cannot be redeemed early under any circumstance. That is completely wrong. Because short put does not mean that bond cannot be redeemed early, right? That is completely wrong. And option D says that soft put forces redemption only through the bond issuer conversion into equity at maturity. No, soft put offer choice. Soft put will offer you choice, right? So not force conversion. So let me give you a real life example to understand this soft put. So suppose your friend repay a loan by cash, by new IOU or his bike. So that is a kind of soft put. And what is hard put? Suppose your friend must pay cash. Your friend, he must pay cash. So in case he must pay cash, right, that is a kind of hard put. No bike, no IOU. So let's recapitulate what we have covered so far in this particular session. So we have talked about the soft put. What is the meaning of soft put? I told you, issuer can repay in cash, issuer can do the cash payment, he can repay in notes, he can repay in stock, or he can have combination of all this, right? Then we talk about the hard put. What is the meaning of hard put? Hard put, I told you, it is just cash only prepayment. It is the repayment will only be made in the form of cash. So one more thing I told you, the soft put are riskier. Why soft put are riskier? Because you might not get cash. And hard put, hard put are quite predictable. Why it is quite predictable? Because cash is guaranteed. Since cash is guaranteed, so this hard put is predictable. So now you will never mix up soft and hard put. I hope this is clear now. Now friends, let's switch our focus to one question on state government security valuation. So question is, according to the RBI valuation norm, how are state government security typically valued? Right, this is a very good question. So ever wondered how banks and mutual funds decide the value of a state government bond? That is what we are going to discuss. So how they decide the value of a state government bond? The RBI has a simple rule. What does RBI say? That take central government rate and add 0.5%. So let's see the question. Option A says that based on actual market price only without any adjustment. Option B, at uniform markup of 25 basis point of central government security of equivalent maturity. Option C, at a 50 basis point markup above the yield on comparable central government security as published by FBIL. Option D, using book value accounting or carrying cost, whichever is lower. So this is a very good question. So there is a golden rule. The golden rule is 50 BPS markup. 50 BPS markup. So what does it say? That SGS means a state government security. They are always valued. SGS are always valued 0.5% higher. They are always valued 0.5% higher than CGS of the same maturity. Remember, this is the RBI rule. This is called golden 50 BPS markup, which says that a state government bond or SGS, a state bond are always valued 0.5% higher than the CGS of the same maturity. Right? So that is what 50 BPS markup, golden rule. Why it is so? Because the states are slightly riskier than the central government. This is very much important that states are riskier than the central government. Right? Like choosing between national brand versus a state brand. Let me give you one example to make it more clear. Let us take one example here. So for example, let's suppose that a 10-year central bond. 10-year central bond is there. So they yield 7%. 10-year central bond yields 7%. And a similar state bond, right? A similar state bond will be valued at 7.5%. So basically that is why since state bond are slightly riskier than the central bond, so higher the risk, higher the rate. That is the basic rule. So where does the data come from? Yes, the data come from FBIL. What is FBIL? Financial Benchmark India Limited. They publish, central bond yield data every times. So basically, the data which is published by FBIL, this is used by bank, right? To use this rate, bank use the rate that is published by FBIL plus add 0.5% for state bond. Since they are more riskier, so more reward in the form of interest rate. But there are some exceptions. What are exceptions? Suppose a state government bond was traded in the market within 5 to 15 days. Suppose a state government bond was traded in the market within 15 days, right? So in that case, it actual trade price override the 7.5%. It actual trade price override the 7.5%. Let me give you one example. Suppose take the case of Tamil Nadu. Suppose Tamil Nadu 10-year bond. Suppose Tamil Nadu 10-year bond was recently sold at 7.3% yield. Recently sold at 7.3% yield. So what will be the value? It will be valued at 7.3%, not 7.5%. This is the very important thing. Again I am repeating. Suppose Tamil Nadu 10-year bond was recently sold at 7.3%. So it will be valued at 7.3%, not 7.5%. Let's see the option that we have. First option say based on actual market price only without any adjustment. See, this is wrong because RBI mandate 50 BPS rule. Remember, there is a 50 BPS rule unless recent rate exists. Then option B, at a uniform markup of 25 basis point of central government security of equivalent maturity. This is also wrong. This was the old rule. This was the old rule, right? Updated to 50 BPS now. Option C say at a 50 basis point markup of the yield on comparable central government security. Yes, this is the correct one. Option D say book value. So this is not for bond. Basically what RBI use? RBI use yield based valuation. RBI used yield based valuation. It is saying using book value accounting. No. It is no longer book value accounting. Rather it is yield based valuation. So let me give you one example to make it more clear. So take the case of central bond. Take the case of central bond. So central bond, just like branded sugar, right? Just like branded sugar. So branded sugar, they offer you 7% interest on the bond. And if we talk about the state bond, right? Take the case of a state bond, like local kirana store. Local kirana store, right? They offer you 7.5% interest. Same product, but you pay slightly more for trust issue. Let's recapitulate what we have covered so far in this particular session. So in this particular question, I told you that a state bond is equal to, right, central bond yield, central government bond yield plus 0.5% always. Remember it. Second point I told you, source, right? Source I told you, this is the FBIL's published central government yield. FBIL published yield, that is the source. Then one exception I told you, right? I told you one exception. What is the exception? It is that recent market trend. Yes, exception is the recent market trade. Recent market trade override this, 0.5% rule. Recent market trade override the 0.5% rule. That is the exception. And the answer is why? Why so? Why it is riskier? The reason is that, states are riskier than the central government. In terms of risk, state bonds are riskier than the central government. That is the point. Now you know why your debt fund state bond is priced that way. Now friends, let's look at one more question, very very important from examination point of view. So imagine you are buying a chocolate bar today versus a promise to get one next year. The price difference is like the spot rate curve. It tells you the exact cost of money at different future date. That is the question. Which statement best describe the spot rate curve or zero coupon yield curve? So options are, it represents the yield to maturity of a coupon paying bond at different maturity. Option B say, it is constructed from zero coupon bond yield and used to discount each cash flow at a specific maturity rate. Option C say, it shows forward interest rate for future period derived from future contract. And option D say, it is the same as the traditional treasury yield curve based on par yield. So first of all, let's understand what is the meaning of this spot rate curve. So basically, it is a graph of interest rate for zero coupon bond. So when we talk about this spot rate curve, so basically it is a kind of graph. Graph of what? It is a kind of graph for interest rate. Interest rate for what? Interest rate for zero coupon bond. It is a graph of interest rate for zero coupon bond. What is the meaning of zero coupon bond? Zero coupon bond are those bonds that pay no interest. Bond with no interest, that is called zero coupon bond. So basically this spot rate curve is a graph of
graph of interest rate for zero coupon bond. Right, suppose we have zero coupon bonds, we have their interest rate, we are going to show it on graph, that is called a spot rate curve. So for example, let me give you one example, like 1 year zero coupon bond yield is 5%, 2 year zero coupon bond yield is 6%. So the curve plot these rate over the time. So basically on the y-axis you have the rate, on the x-axis you have the time, and you plot this rate over the time. Why it is useful? It is useful because it provides you accurate bond pricing. It provides you accurate bond pricing, which means instead of using one average rate, which is the YTM, the spot curve discount each future cash flow at its own rate. For example, let's take the case of 2-year coupon bond. Suppose take the case of 2-year coupon bond. Okay, so year 1 coupon is discounted at the 1-year spot rate. Year 2 coupon is discounted at the 2-year spot rate. That means it shows you the accurate bond pricing and how it is built, how this kind of a spot rate curve is built. Since most bond pay coupon, so there is a math trick that is called bootstrapping. That is what we call bootstrapping. You see this word written here. So basically this bootstrapping extract implied zero coupon rate from them. Like figuring out the price of plain flour by subtracting the cost of egg and sugar from the cake total price. That is called bootstrapping, right? So bootstrapping is used to derive the spot rate from the coupon bearing bond price. Now let's see the option that we have. Option A say it represents the YTM of a coupon paying bond at different maturity. So that is wrong. Basically that is called normal yield curve. That is not called spot yield curve. That is called normal yield curve. What about option B? It is constructed from zero coupon bond yield and used to discount each cash flow at its specific maturity rate. Option B, option B is correct. That is what I am talking about. It is constructed from zero coupon bond yield and used to discount each cash flow at specific maturity rate. Option C, says that it shows forward interest rate for future period derived from future contract. So that is wrong because forward curve are derived from spot curve, not the same thing. And option D say that it is same as the treasury per yield. No, par yield. No, that is wrong. Par yield curve use bond price at face value. Par yield curve use, they use bond priced at face value. Right. While a spot curve use zero coupon rate. I already told you that, par yield curve, they use bond price at face value, but they while a spot curve use zero coupon bond, right? So that is what the difference between zero coupon bond and this kind of thing. So basically let me give you one example to make it more clear. So first of all, you can think of this spot curve as as a menu of today's price. You can think of a spot curve as a menu of today's price for rupees 100. Today's price for rupees 100, delivery in 1, 2 or 5 years, right? So 100 rupees in 1 year will cost 95.25, 100 rupees in 2 years will cost 89 rupees. So traditional yield curve is the average all these things into one combo meal rate. So let's recapitulate what we have covered in this particular slide. I told you about a spot rate curve. I told you about a spot rate curve. What it is? This is a kind of zero coupon bond. This is a kind of zero coupon bond yield. Yeah, zero coupon bond yield across maturity. Zero coupon bond yield across maturity. That is called a spot rate curve. First point. Second point, I told you that you need to discount each cash flow separately. Yes, discounting of each cash flow is to be done separately. Discount each cash flow separately. And the third point I told you, it is built by a bootstrapping. This kind of a spot rate curve is built via bootstrapping. I hope that makes sense to you. Now friends, have a look at one important concept, right? So this is based on let's talk about this. So if 1 USD is equal to this much rupees, if 1 USD is equal to this much Canadian dollar, what is the cross rate for 1 Canadian dollar in INR and what concept does it represent? So basically what is the meaning of this cross rate? Let's first understand it. Basically whenever we say cross rate, it is a kind of exchange rate. Exchange rate between two currencies. It is a kind of exchange rate between two currencies like INR and CAD, Indian rupees and Canadian dollar. It is calculated using a third currency like dollar. It is calculated using a third currency. Why? Because USD is the most traded currency globally. It's act like a bridge. Now let's see this particular question. In this particular question, $1 they have given 61.50 rupees and $1 they have given CAD 1.1377. Okay, so we have to find that how much CAD, how much both are related,
right? So basically, if we equate both of them, right? So we can say, we just equate both of them. We can say 61.50 rupees is equal to CAD 1.1377. Okay, so basically we can say that 1 CAD will be equal to 61.50 divided by 1.137. So that will be equal to, we can say 0.8789 1 CAD. Fine, this much dollar. Now you have to convert, so 1 CAD is equal to this much dollar. So basically what we have done here, see, yes, we have seen 1 CAD is equal to how much USD. That is what we have done just now. So basically, yeah, so what we got is 1 CAD is equal to this much. How much we get is this will get 54.05. Just wait a minute, let me correct it. So if you just equate both of them, you will get 54.09. Fine. You will get how much? 54.05. This much rupees. So 1 CAD, 1 Canadian dollar is equal to 54.05 rupees. That is the correct answer. So let's see the option that we have. Option A say 53.40. That is incorrect. That is incorrect. Right. Because this is incorrect math. What about option B? 69.98. That is incorrect. What about option C? Yes, it is correct. Option D is also incorrect. Right. So imagine you are trading apple and oranges, but no one trade them directly. So instead what you do? Everyone trade apple for banana and orange for banana first. So to find out how many apple is equal to 1 orange, you first find out how many banana is equal to 1 orange and then convert banana into apple. So that is the meaning of cross rate. So basically, whenever we say cross rate, let's understand what we have covered in this particular question. So I told you about the cross rate. What is the meaning of cross rate? Cross rate is a kind of exchange rate. Cross rate is a kind of exchange rate for two currency. We are finding the exchange rate for two currency via third currency. Via third currency, we are finding exchange rate for two currency. And the formula is quite simple. Suppose we want to find INR oblique CAD, which is equal to INR oblique USD divided by CAD oblique USD. That's it. And USD is act like a bridge currency. This US dollar, it acts like a bridge currency. Right? That is the point. Now friends, let's look at the last question of today's session. The very good question which was asked in the examination. It is regarding the strips. Yes, just wait a minute. Yeah. So it is regarding the strips. Very good question. Question is, which of the following statement best describe strips in the context of government security? So very good question it is. Imagine taking a chocolate bar with layer and splitting into individual pieces. That is exactly what strips do with the government bond. So what is strips? So first of all, let's talk about the full form of it. So basically its full form is separate trading of registered interest. Separate trading of registered interest and principle of security. Separate trading of registered interest and principle of security. So what they do is split a regular government bond into coupon payment. So if we talk about the strip, what they do, they split a regular government bond, that is called government security, is split into coupon payment. Government security is split into coupon payment plus principal repayment. Right. Let me give you one example. For example, let's take one example. Suppose 10-year government security with 10,000 rupees face value plus 6% annual coupon. 6% annual coupon. Right. It can be stripped into 20 coupons. It can be stripped into 20 coupons strips. Okay. So which is almost 300 rupees each. Paid semi-annually. Fine. And one principal strip is there. One principal strip is there. Which is how much? 10,000 rupees at maturity. So that is what it does. Basically it converts a government bond. This is a 10-year government security of 10,000 rupees face value. It is converted into two parts. First of all, 20 coupon strip is generated. 20 coupon strip, rupees 300 each. Right. And one principal strip which is rupees 10,000 at maturity. So let's summarize what we have covered in this particular question. Right. So basically if you talk about the key feature of this strip, this is a kind of zero coupon bond. Remember, this is a kind of zero coupon bond because each strip pay no periodic interest. Each stripe they pay no
zero periodic interest, just one lump sum at maturity, and they are traded separately, which means investor can buy, investor can sell individual strip. For example, only the 5-year coupon or the principal. And one more thing is that they are SLR eligible. Yes, they are eligible for SLR. You can see that bank can count them toward a statutory liquidity ratio. And why does the strip matter? Strip matter because of flexibility they offer. Investor can pick a specific cash flow. For example, only 3-year coupon. Yes, they can do that. Pricing clarity. Since there is zero coupon, their price directly reflect the time value of money. So let's see the option that we have. Option A say that strips are equity instrument issued by RBI carrying annual interest and market linked pricing. No. Again, it is wrong because they are not equity instrument. They are basically debt instrument. First of all. Option B say short term treasury bill. No. They are not short term treasury bill because I told you this is also wrong because I told you they are long term zero coupon bond. They are long term zero coupon bond. What about option C? Yes, this is the correct. Zero coupon security created by separating coupon and principal component of fixed coupon GSEC and are eligible for SLR. Yes, completely correct. Option D say corporate debt instrument. No, it is again wrong. Strips come from government bond, not corporate. Think of a magazine subscription. Regular bond, you get 12 monthly issue plus one free gift, which is the principal at the end. Similarly, in the strip, what happened? The publisher let you buy or sell each issue separately. Only the July edition or just the gift. That is the point. So let's recapitulate what we have covered regarding the strips here. So I told you, whenever we talk about these strips, you must remember they are unbundled government security, right? Which includes coupon payment plus principal. They are traded separately. Second point I told you, they are zero coupon bond, which means no periodic interest. No interest is being paid. Only just one payout. Third point I told you, they are SLR eligible. Right? Bank can use them to meet reserve requirement. And the fourth point is that they are not equity. Right? They are not equity and neither corporate debt. They are neither corporate debt. So friends, before ending our lecture, let's summarize what we have covered so far in this particular lecture because revision is must. So let's see whatever point we have covered, just summary, because why we go through this question to have a conceptual clarity. So let's see what concept we have gone through. So first of all, we started with the first question we started with a kind of bond and YTM relationship. I told you that interest rate increase, bond price decrease, interest rate decrease, bond price increase. And one more point, if market price of bond is less than face value, then in that case YTM exceed coupon rate and vice versa. Then we discuss about CD, which means certificate of deposit. I told you higher interest rate, they offer higher interest rate than regular saving account. Yes, there are penalties for withdrawal. It is safe and unsecured, and they are not flexible. Right? These are the points, right, that you talk about. Then we talk about banker acceptance. What are the point regarding banker acceptance that is worth noting? I told you that banker acceptance is that first of all 100% bank guarantee. Short-term instrument generally for 1 to 6 months, right? Not stock. As you can see, instrument type is short-term debt. Guarantee is bank guaranteed. Negotiability, yes, they can be negotiable. They are transferable in the secondary market. We are talking in the context of banker acceptance. Maturity typically 30 days to 180 days, and primarily they are used to facilitate international trade payment. Then we talk about the settlement risk. What I told you that settlement risk is key point. Let me summarize. Yes, I told you that you paid, but they did not receive. Right? That this is also called hostage risk. You paid, but they did not receive. It is called settlement risk. It is another name is the hostage risk. So default risk and delays risk, two types of risk. It can be it can be minimized or it can be taken care of using DVP, delivery versus payment, or PVP. Right? These are the point. Then we talk about the time value of money, how to find the future value. Then we already discussed the formula. We talked about what is the meaning of soft put and hard put. I discussed soft put, it helps issuer can get in the form of cash, notes, stock and combination. It's quite riskier. When we talk about hard put, just cash only. If you have to make repayment in cash and the face value of bill is given ₹100. So now the question is, what is the yield of the treasury bill? Options are 9.65%, 9.86%, 10.39% and 10.65%. So friends, first of all understand the question. First remember that treasury bill are short-term government security. They are issued at a discount and they are redeemed at the face value. So you earn money by buying low and getting ₹100 at the end. So you earn money by buying low and you get ₹100 at the end. Right. So there is a formula that we use to calculate the yield. And what is that formula? Yield is equal to 100 minus P upon P, the face value, right? So remember, for treasury bill, rupees 100 is the face value always. Now P is the purchase price. What is P? P stands for the purchase price. Okay. Then comes D. What is D? D stands for the tenure of the bond. And in this case, as you can see, the tenure of the bond is 91 days. As you can see here, tenure is how much? 91 days. Okay. So now this is the formula which will be used. So it is just substitute the value. So 100 minus purchase price. What is purchase price? It is, the purchase price is 97.50, as you can see written here. Discounted price means purchase price. So 100 minus 97.50 divided by 97.50 multiplied by 365 by 91 into 100. So this formula you have to apply. So it will give us 2.50 upon 97.50 multiplied by 4.010989 and multiplied by 100. So ultimately it will give you 10.39%. So option number C is the correct one, right? So I hope I request you to please remember this formula. Sometime what happen, they give you the price and they ask you the yield, and sometimes they give you the yield and ask you the price. So both way you can find the concern. So what we learn from this question is that treasury bill are short-term loan you give to the government, and you buy them at cheaper rate. Like in this case, you have bought them at 97.50 rate, right? And you will get rupees 100 later. So this difference between these two number is your profit. The difference between 100 and 97.50 is your profit. And if you want to find the annual return, what is the meaning of yield? Yield just means annual return. So if you want to find the annual return, you can use the formula y is equal to 100 minus P upon P into 365 upon D into 100. So after putting the value, the answer is 10.39%. So the next time you get a treasury bill MCQ, don't panic. Just plug the value into the formula and solve the step by step. Now friends, have a look at the next question. Next question is, which of the following is not included in the computation of NDTL for CRR and SLR purpose? Right. So there are 4 options which has been given. So friends, options are interest accrued on deposit, borrowing from RBI and refinance from NABARD, Exim, etc., credit balance in the current account, liability arising from the interest-free code receiver deposit. So these are the options. So not included in the computation of NDTL. That is what it is asked. So first of all, let's go through the option number A. That is the interest accrued on the deposit. This means that interest that is yet to be paid but already due on saving or fixed deposit. So what is the meaning of interest accrued? Interest yet to be paid. But this particular interest, it is already due. It is already due on saving and fixed deposit. So even though the customer has not withdrawn it, the bank owes it. So it is a kind of liability. And yes, it is included in the NDTL as other demand and time liability. Yes, in the section other demand and time liability, other DTL, this particular interest accrued is included, right? Please remember. For example, let me give you one example to make it more clear. For example, suppose your FD earned rupees 500 interest. Okay, so by quarter end your FD earned rupees 500 interest, right? So the bank has to pay you. So it is recorded as a kind of liability. Fine. Now let's look at option number B. That is borrowing from RBI and refinance from NABARD, Exim, etc. So this is the correct answer because it is not included in NDTL. It is not included in the NDTL. Why? Because these are the kind of loans that bank take from another institutions like RBI, like NABARD. These are kind of loan that bank take from RBI, NABARD, Exim Bank. But remember, NDTL include liability to the public and other bank. Try to understand what I'm telling you, that this particular NDTL, it includes what? Liability to the public, right? Liability to the public and other bank, not from the institution like RBI. Yes, these are loans from RBI, NABARD, Exim Bank, but NDTL does not include such kind of loan. NDTL basically include liability to the public and other bank. So this is excluded. You can think of it like this. If I borrow from my boss, that is RBI, it is not a general liability to the public or other bank. So it stay out of NDTL. Then comes option number C. What is option number C? Option number C say credit balance in current account, right? So these are balance other bank keep with us. It is like one bank depositing money in another bank current account. So these are called liabilities to the banking system. Yes, it is a kind of liabilities to the banking system, and yes, they are included in NDTL. Even though it is not the public money, yes, it is still a liability. So bank adjust it with asset held in another bank and take the net value while calculating the NDTL. What bank do? Bank adjust it, right, with the asset held in the other bank. Obviously, a bank A will have some asset held in the bank B. So adjustment is done, and that is why this particular thing is excluded, right, while calculating NDTL. Means that in short we can say it is included after netting off. Yes, after netting off we include it. Option number D say liabilities arising from interest-free court receiver deposit. See, this is the kind of a special case. This is the kind of a special case. These are, court ordered deposit. Like when a case is pending. Suppose a particular case is pending, right? Like when a case is pending and the money is kept with a bank interest free. So case is pending, money is kept with the bank interest free. Since it is not money that bank can freely use, it is not considered a regular liability. So it is excluded from the NDTL. Because it is not the money that bank can freely use. Okay. So it is excluded from NDTL. But wait, this is the tricky part. Although it is excluded, the question asks for what is not included. And option B is a better match because it is clearly and completely excluded. So the final answer is option number B. Right. So let's summarize what we have learned in this particular question. That what is NDTL? I told you NDTL means how much money bank owe to the public and other bank in form of saving, current and fixed deposit. So in short, if we talk about NDTL, is how much money the bank owe to the public, right? How much money bank owe to the public, that is called NDTL, right? In the form of saving account, in the form of current account, in the form of fixed deposit account. So basically this NDTL help RBI decide how much money bank must keep as CRR as well as the SLR. And what are included in NDTL? Remember it, very very important. So first of all, I told you interest accrued, that means interest payable on deposit. Yes, it is included. Then current account balance of other bank, right? This is included. But what is excluded? Borrowing from RBI, borrowing from NABARD, borrowing from Exim Bank. These are excluded. And there are some special cases like court receiver fund. These are excluded, right? Hope that this breakdown make it super clear. Friend, if you are looking for a study material for CTP, that is Certified Treasury Professional course, in the form of PDF, in the form of unit-wise MCQs, in the form of previous year question, you can enroll in our course. The detail of the course is provided in the description section. Many aspirants have cracked the examination by going through the course. You can also easily crack the examination. For more detail, you can WhatsApp me on this particular number. Now friends, have a look at the question number 3. So the question number 3 is on your screen. It is also one numerical based question, very very important from examination point of view. Have a look. So friends, what is the question? You are analyzing a 3-year corporate bond with face value of 100 rupees, offering annual coupon rate of 12%, prevailing YTM is 8%, bond is trading as 110.50. What is Macaulay duration in year of the given bond? Yes. So what is in simple term, when we talk about this Macaulay duration, it simply means average time it takes to recover the bond price from its cash flow. I'm again repeating, average time it takes to recover the bond price. How much time it takes to recover the bond price from its cash flow, right? So that is called Macaulay duration. So basically it consider both the timing, it consider both the size of each payment. Yes, timing is also considered and size is also considered. Now, as you can see here, that this particular bond is paid semi-annually. You can see this word written here, semi-annually, right? So what is the meaning of this term semi-annually? You know it very well. Twice a year, right? So basically, since this bond pays semi-annual coupon, that means 2 payment per year for 3 years. So can you tell me how many period will be there? See, in every year, 2 period, right? So total is a 3 year. So it will be 6 period in total, right? Total it will be 6 period. Now let's calculate step by step. First of all, calculate the coupon amount. What is the coupon per period? What is the coupon amount per period? As you can see, it is 6%, I think. It is 12% annual. So semi-annual it will be 6%. Okay, so 6% coupon of the face value. What is face value? 100 rupees. What is 6% of 100 rupees? It is rupees 6. Right? Because 12 rupees it paid every year, but every half year, our period is half year. So every half year, you can see YTM is given 8%, but this 8% is annual. So what will be the YTM for 6 months? It will be 8 by 2, which is equal to 4%. Now have a look at the cash flow. So for cash flow, what we will do? We will create a particular table. This tabular method is the most preferred one for computing this, McLeod duration. So first we will write period, then we will write the cash flow, then we will write PV at the rate 4%, and then we will write PV multiplied by TI. Okay, PV multiplied by time. Now, so basically these are the columns that we have: period, cash flow, PV means present value at the rate 4%. Now, so we have 6 period. 1, let me write down. 2, this is 3rd, this is 4th, this is 5, and this is 6. Okay. Now, what are the cash flow? Coupon amount 6 rupees, 6 rupees, 6 rupees, 6 rupees, 6 rupees, and finally you will receive 6 rupees along with the face value, which is equal to 106. So these are the cash flow. Now we want to calculate this is present value factor, right? So what is the present value? How to calculate the present value? So basically to calculate the present value, how do we do it? So future value upon 1 plus r whole to the power n. So for the first case we write n is equal to 1. So it is nothing but 6 divided by 1 plus 0.04, which is equal to 5.77. In the second case, it is equal to 6 divided by 1.04 chi square, right, which is equal to 5.55. In the third case, 6 divided by 1.04 ka cube, which is equal to 5.34. 6 divided by 1.04 to the power 4, which is equal to 5.13. 6 divided by 1.04 to the power 5, which is equal to 4.93. And finally, in the last case, 106 divided by 1.04 to the power 6, which is equal to 83.78. Right. So these are the present value. Now in the last column, what we will do? We will multiply the present value with the time. So what is the time? This period I am talking about. So first of all, in the first row, it will be 5.77 multiplied by 1, right? Which is equal to how much? 5.77. In the second row, it will be 5.55, this one, multiplied by this one. Okay, so this will give us how much? This will give us 11.10. In the third row, this will be 5.34 multiplied by 3, which will give us 16.02. Similarly, 5.13 multiplied by 4, which is equal to 20.52. 4.93 multiplied by 5, which is equal to 24.65. And finally, 83.78 multiplied by 6, which is equal to 502.68. So now as you can see, total present value, if you add all this value, 5.55, 5.34, 5.13, if you add all of this, you will get how much? You will get total present value as 110.50. This is the total present value, or we call it summation of PV. And if we calculate summation of PV into T, so this will give us, if you add all of them, you will get how much? 580.74. Now let's apply these two in the McLeod duration formula. So what will be the McLeod duration? Summation of PV into T upon summation of PV, which is equal to 580.74 upon 110.50. Okay, so the answer will be how much? 2.63. This will be the McLeod duration. So option number B will be correct. 2.63 will be correct. Right. I hope that makes sense to you. Now let's summarize the point we have covered in this particular slide. What I told you, that McLeod duration is a kind of average time. Right. This is a kind of average time to recover the bond price. You have to recover the bond price. Average time it takes to recover the bond price is called McLeod duration. And it uses present value of each cash flow multiplied by time. Semi-annual coupon bond means you have more frequent payment, reducing the duration. And always remember, always divide PV into time by the price. Okay. So if the payment are semi-annual, convert period into year at the end. Right. So I hope that makes sense. I have explained each and every option, each and every step, how to go about calculating the duration. Now friend, let's look at the second part of this particular question. The question is, if yield increases, what happened to the bond duration? Very good question. Duration increase, duration decrease, duration remain unchanged, and duration become 0. First of all, let's understand what is the meaning of this duration in the simple word. I told you now that duration is the kind of average time. Average time it takes for a bond holder. Suppose there is a bond holder, how much time it will take for a bond holder to recover the money? Because bond holder have invested the money, right? So how much time it will take to recover the money, right, that they have invested in the bond? So it is not just about time. It's also about, value of future payment. It's also about value of what? Future payment. It is not just about time. Now the question is, what happened when the yield increase? As you can see, yield is increasing. The question is, what will happen when the yield increase? So as you can see, if yield will increase, then discount rate will decrease. And what will happen if discount rate will decrease? What will happen? Those future payment will get discounted more heavily. They get discounted heavily. The future payment will get discounted heavily. That means, for further payment lose more value compared to the nearer one. So it simply means, further payment will lose value instead of the compared to the nearer one. So the weight shift toward earlier payment. Weight shift toward earlier payment, right? And since weight shift toward earlier payment, so what happened? Your duration becomes short, right? Your duration becomes short or duration decreases, right? Let's go through each and every option. Option number A say duration increase. Wrong. It is wrong. Why? Because if the yield increase, future cash flow are worth less today. Duration actually fall because we recover value faster. Because as you can see, yield increasing, discount rate decreasing, future payment get discounted heavily, further payment lose value, weight shift toward earlier payment, and duration decreases. Now option number B say duration decrease. Exactly. Because higher yield means lower present value of the long-term payment, shorter average time to recover payment, and duration goes down. Let me give you one example to make it more clear. Suppose you lend rupees 100 and you expect rupees 50 next year. You expect rupees 50 next year. You have lent rupees 100 and you expect rupees 50 next year, and rupees 50 you are expecting after 5 years. In the next year you are expecting 50 rupees and 50 rupees you are expecting after 5 years. Now in this case, suppose interest rate increases. So what will happen? That 50 rupees in the 5 year is worth much less now. So most of your value is recovered today. So obviously your duration will get lower. Why it is worthless? Because if you calculate the present value, it is future value upon 1 plus r whole to the power n, right? So if interest rate is increasing, this one is increasing, so this is decreasing, so present value is decreasing, so the worth of this 50 rupees is very less. So what happened? The duration shift toward the earlier value. That's why the duration of the bond decreases. Means you can recover the amount early, right? So that's why option number B is the correct answer here. Whatever, which of the following correctly describe its formula? So 4 formula are given here. Option A is portfolio return minus market return divided by beta. Option B is portfolio return minus risk-free return divided by standard deviation of the portfolio return. Option C is portfolio return minus risk-free rate multiplied by standard deviation of the portfolio return. Option D is portfolio return minus benchmark return divided by standard deviation of the benchmark return. So these are the 4 options. So friends, you can think of the Sharpe ratio as a way to measure how much return you are earning for every unit of risk, right? For every unit of risk, right? How much return you are earning. That is called Sharpe ratio. Basically, it compare your portfolio return to risk-free investment. So what are risk-free investment? What are the example of risk-free investment? So like, government bond. Government bond is a kind of risk-free investment. So basically what you do, it compare, on one side you have your portfolio return and the other side you have your risk-free investment. Okay, so both comparison is being done, portfolio return versus risk-free investment. And then after comparing, it divide it by how much your portfolio fluctuate. That is called a standard deviation. So now the formula for Sharpe ratio is very simple. You write the return, subtract it with the rate, risk-free rate, and you divide it by the standard deviation of return. You divide it by the standard deviation of the return. So basically you are getting extra return per unit of total risk. So let's break down each and every option. First of all, let's look at option number A. It says portfolio return minus market rate divided by beta. It is wrong formula because this is actually for trainer ratio. This formula is actually for trainer ratio, not Sharpe ratio. It use beta. Trainer use beta, which only consider market risk, but Sharpe use total risk. What about option B? Option B say portfolio return minus risk-free rate divided by standard deviation of the portfolio return. Yes, it is the perfect formula. Because this is the exact formula for the Sharpe ratio, you take the extra return over safe investment and divide it by the volatility of the portfolio. Right? So what you do here, that you take the extra return over the safe investment. So this is your safe investment and this is the extra return you are getting. You take the extra, means you define the difference. So this is the extra value, right? And you divide the extra return by the volatility of the portfolio, and volatility is measured by the standard deviation. So suppose, let me give you one example. Suppose your portfolio give 10% and suppose risk-free rate is 5%. Okay, and the standard deviation is suppose 2%. So what is the Sharpe ratio? Sharpe ratio is 10%, which is your return. 10% is your return. Then you subtract risk-free rate, which is 5%. 10% minus 5%, and you divide it by the standard deviation, which is 2%. So which is equal to 2.5. So which means 2.5 unit of return per unit of risk. So basically in the numerator we have return only. In the denominator we have, risk. Right. So basically 2.5 unit of return per unit of risk. So this is the option. Option number B is the correct answer. What about option C? This they have multiplied it. Instead of dividing, they have multiplied. So it is quite incorrect. Option D is also incorrect. So what we learned from this discussion is that, this particular Sharpe ratio, it tells you how efficiently your investment give return for the risk you are taking. Means how efficiently your investment is giving return for the risk you are taking. It uses risk-free rate, okay, as baseline. It measures the total risk. It measures the total risk using the standard deviation. How do we calculate it? We write the portfolio return. We write the portfolio return. We subtract the risk-free rate and we divide it by the standard deviation of the portfolio. Right? So this will give us the Sharpe ratio. So remember, if the question asks about Sharpe, you always look for risk-free rate and standard deviation. If you see beta that is basically for trainer ratio. Now friends, have a look at the next question. So the next question is another based on commercial paper CP. So question is ABC Limited and reputed Indian corporate with net worth of 200 crore. They plan to raise short-term working capital via the issue of commercial paper. Okay. The company already has a standard fund-based facility from a leading public sector bank. ABC Limited has a credit rating of A3 and they want to issue CP worth 10 crore with maturity of 90 days in demat form. They appoint a scheduled bank as the issuing and paying agent, that is IPA. After 40 days, ABC Limited wishes to buy back the CP from the investor. So basically every aspect has been taken care of in this particular scenario. Right. So basically they have a net worth of 200 crore. Right. They want to raise money via CP and they have a standard credit rating of A3. They want to issue CP worth 10 crore, maturity 90 days, demat form. Okay, they have appointed IPA. After 40 days they wish to buy back the CP. Now the question is, which are the following conditions make ABC Limited eligible to use CP? Option A, net worth of 50 crore and a bank loan under default. Option B, net worth of 200 crore and a standard fund-based facility. Option C, credit rating below A3. Option D, no working capital sanction from any bank. So basically if we talk about this CP, which is a commercial paper. So commercial paper is short-term IOU. It is a kind of short-term IOU. Basically who issue it? Company issue it. Right? To borrow money. Why company issue it? Company issue it to borrow money for a few months. Usually up to 1 year. Usually up to 1 year without giving a collateral. But because it is unsecured. Yes, it is unsecured. Because it is unsecured, only company with a strong financial can issue it. There are some eligibility criteria. So minimum credit rating is A3, right, or better. Minimum credit rating is A3 or better. And first point. Second point is they must have a standard fund-based facility. This is very much required. a standard fund based facility, right? It is required from a bank. And the third point is, suppose it is corporate, suppose it is LLP, or suppose it is a trust, corporate, LLP or trust. So net worth must be 100 crore or more. So these are the three conditions which make ABC Limited eligible to issue CP. First of all, credit rating of A3 or more. Second point, standard non-default fund-based facility from a bank. And for corporate, LLP and trust, net worth must be 100 crore or more. So let's look at the option. Option is a net worth of 50 crore. No, RBI require minimum 100 crore as net worth. 50 crore is too low. And if the bank loan is under default, the company is clearly not financially healthy. What about option B? Net worth of 200 crore and standard fund based facility. It is perfect because ABC Limited has 200 crore net worth, a standard bank facility, credit rating of A3. So all eligibility box are ticked. So yes, this is a criteria. Credit rating below A3, they are ineligible because A3 is the minimum accepting criteria. A3 is the minimum accepted criteria. Anything below A3 like B or C, it means high risk. And then we have option D, no working capital sanction from any bank. This means company has no verified credit track record. Company has no verified credit track record. So RBI want company to have an existing fund based limit. It shows the bank has checked them, so this condition also failed. So let's summarize the point. First of all, what we talked about is the CP is a kind of short-term borrowing tool for financially sound company. And I told you the eligibility rule. The first one is that its net worth must be greater than or equal to 100 crore. Second point is that its credit rating must be more than A3. Third point is that it should have a standard bank fund-based facility. It should have a standard fund-based facility. Okay, so remember, if a company want to issue CP, it must be financially strong, not just big. Now friends, have a look at the next question. So the next question is, this question is also related to the same case study. It is asking you, what is the minimum maturity and the form of issuance required for ABC Limited CP? CP means commercial paper. Option A, 30 days physical certificate, 15 days demat form, 7 days demat form, 1 day physical certificate. So I told you this CP is a commercial paper. It is a kind of short-term borrowing tool used by company to raise money quickly. It is usually used for working capital need. And it is unsecured. It is quite unsecured, meaning no collateral, and it is issued at a discount for a fixed maturity. And as per RBI guideline, the minimum maturity for CP is 7 days, and the maximum maturity is 1 year, right? So, and one more thing is that CP is issued in demat form. CP is issued in demat form. Demat means electronic form, especially since bank can only invest in demat CP. Now let's look at the option. Option A says that 30 days physical certificate. So 30 days within the allowed range, but there is a problem that physical certificate are not the norm anymore, right? CP are issued in demat form only. Option B say 15 days and demat form. Yes, it is correct. Demat form is correct. But minimum maturity should be 7 days, not 15 days, right? So option C, yes, option B is also not the correct one because demat form is correct. Option C is 7 and demat form. Yes, this is the absolutely correct answer. This is the perfect answer. Minimum maturity, just told you 7 days, and demat form, yes, this is very much important. So what we learned from this discussion is that commercial paper is a short-term money tool for a company. Minimum maturity, I told you, it is just 7 days, and it is issued in demat form only. Right, bank can invest in CP only in demat form. So the final answer is option number C. Now friends, have a look at another question based on the same discussion. ABC Limited buy back the CP 40 days after issuance. Which of the following is true? Option A, that this buyback is allowed as minimum 30 days have passed. Option B, buyback is invalid as CP cannot be repurchased. Option C, buyback must be done at face value only. Option D, buyback must be done on 90th date only. So tell me, so ABC Limited buy back the CP 40 days after issuance. So which one is correct? Let's first understand, can a company buy back it on CP? This is the question. Can you buy back on CP? Can you buy back on CP? See, the answer is yes. Yes, company can buy back their own commercial paper before maturity, but only under certain condition. The condition is that the commercial paper must be at least 30 days old. The commercial paper must be at least 30-day old, right? And the buyback should happen through the secondary market. This is another condition, that buyback should happen through secondary market, not privately. It should not happen privately. So these two conditions must be fulfilled. First one I told you, it should be 30 days old, CP must be at least 30 days old, and the second condition is that buyback must happen through the secondary market. It should not happen through privately. Now as per the RBI rule, you must remember that buyback of CP is allowed through secondary market only. First point, it must be done after 30 days from the issue date, and it is always done at the market price. It is always done as the market price, not necessarily at the face value. Now in this case, what we are observing is that CP was issued for 90 days, right? CP was issued for 90 days. As you can see in this particular question, let me come back to this particular question. Let me show you that here you can see that CP was issued for 90 days. As you can see, maturity is 90 days. And ABC Limited want to buy back on day 40. Yes, ABC Limited want to buy back the CP from investor on day 40. Since 40 is larger than 30, so the buyback is valid. Because I told you, minimum 30 days, right? It must be done after 30 days from the issue date. After 30 days. And yes, it is being done after 40 days. So obviously it is valid. Before 30 days, it is not valid. Now, in this case, CP was issued for 90 days. ABC Limited want to buy it back on day 40. So obviously, let's go through each and every option. So option number A say, the buyback is allowed at the minimum 30 days have passed. Yes, this is correct. As per RBI guideline, buyback is only allowed after 30 days. Since 40 days have passed, this is absolutely valid. What about option B? Buyback is invalid as CP cannot be repurchased. What do you think about it? See, this is wrong. Why it is wrong? Because CP can be bought back, but through the secondary market and only after 30 days. So this statement is not correct. Because it is saying that buyback is invalid. No. Buyback is not invalid. Rather, it can be bought back. Option C say buyback must be done at the face value only. Totally wrong. Because CP is traded in it is talking about face value. See, CP, they are traded in the secondary market. They are traded in the secondary market, right? And the price constantly fluctuate. So buyback always happen at the market price. Remember, buyback always happen at the market price, not face value. Then option number D say, buyback must be done on the 90 day only. This is also wrong. Totally wrong. Because CP is mature on the 90 day, but company are allowed to buy it back before, as long as 30 days have passed. So the day 40 is fine. So let's summarize what we learned from this particular question, because learning is very much essential. I told you that CP can be bought back by the issuing company. Yes, issuing company can buy back the CP. This is the first point I told you. Second point I told you that buyback must happen after 30 days. Third point I told you, the buyback is done through the secondary market. Remember, buyback is done through the secondary market and it is done at the market price. So someone asks you whether buyback is possible at the face value. No, remember, buyback is not possible at the face value. And the fourth point is I told you, no need to wait until maturity. No need to wait till maturity. You need not wait till maturity, right? So I told you in this particular case, since 40 days have passed, so buyback is allowed. So the key takeaway is that the buyback of CP is allowed, but not too early. Wait 30 days and then go to the market. Simple. I hope that makes sense, right? Now the last question of this particular case study is that, as you can see, why might a bank choose to invest in ABC Bank CP? Option A, CP has high credit rating but long-term maturity. CP is risk-free and interest-free. CP offer higher yield than interbank money market with short-term credit exposure. Option D, CP is a physical security with high liquidity. Now the very good question it is. Let's first understand what is CP. I told you it is a kind of short-term debt instrument issued by company to raise money quickly. And why bank prefer CP? Because it offer better return. CP, CP offer you better return. It offer you better yield as compared to call money, as compared to overnight lending. So if you compare to call money, if you compare to overnight lending, this CP is offer better yield. And the credit risk is short term. Yes, the credit risk, of this CP is very short term. Okay. And it is a kind of tradable instrument. So there is a good liquidity. Let's go through each and every option. If you go through the option number A, it says that CP has high credit risk but long-term maturity. It is completely wrong. Why? Because CP actually has low to moderate credit risk. And it is a kind of short-term instrument. It is usually 7 to 365 days. So this statement is incorrect. Option B say it is risk free and interest free. It is again wrong. CP is not risk free. Though it is issued by top rated company, there is still some credit risk. Also it is not interest free. It is issued at discount and redeemed at face value. So investor earn interest indirectly. Option C say it offer higher yield than interbank money market with short-term credit exposure. Try to understand. CP usually give better return than call money or interbank lending. And since CP mature in a few weeks or month, the credit exposure is short-term, which reduces the risk. Let me give you one example. For example, suppose that interbank call money rate. Suppose interbank call money rate is 5% and suppose CP is offering you 6.5%. So the bank earn more, right? So the bank is earning more. Bank is earning more by investing in CP with only 90 days exposure. And option D say CP is physical security with high liquidity. This is partially wrong. Yes, CP has high liquidity, but it is not a physical certificate anymore. I told you already, it is always issued in the form of demat form. So let's summarize the point which we have just covered. First of all, why bank invest in CP? Because it offers higher yield than short-term bank-to-bank lending. And you know, credit risk is low, right? And it is only for short time, limited to short period. And you know, CP are quite tradable, right? So bank can sell them before maturity if needed. And CP is always issued in, demat form. So option C is the correct answer. Now friends, have a look at this question. You know, from bond, many questions they are asking, right? In this question, they have provided you the data, like, face value, they have given 1,000 rupees. Coupon rate, they have given 12%. And it is paid semi-annually. And 3-year maturity is there, right? And the required rate of return is 10%. So they have asked you to calculate the value of the bond. So friends, how to calculate the value of the bond? First of all, what is the face value? Face value of 1,000. What is the coupon rate? Coupon rate is 12% annually. So which means 6% every 6 months or every bi-yearly. So what will be the coupon payment? If you calculate the coupon, it will be 1,000 multiplied by 6%. Okay, that will be how much? 60 rupees every 6 months. Now what is the maturity? If you look at the maturity, I think it is 6 years, but it is 3 years, sorry. It is 3 years. So it is 3 years. How many periods are there? 3 multiplied by 2. So there are 6 periods. Okay, 6 half-year period. And what is the required rate of return? What is required ROR? So required ROR, as you can see, is 10%. Required ROR is 10% and that is per annum. And we want to calculate it after 6 months. So it will be 5% every 6 months. So everything you have to compute 6 month basis. Now we will use the present value formula. So bond value it can be categorized into 2 parts. First of all, what do? You calculate the present value of coupon payment, all coupon payment plus, that is called annuity. So in that case, you apply the annuity formula to calculate the present value of all the coupon payment, and then you calculate the present value of the final principal amount. You calculate the present value of the final principal amount. That is called lump sum. That is called lump sum. So now in the question, they will provide you present value interest rate factor. So let me give you, so they will give you PVIFA, that is called, present value interest rate factor. Please remember. So PVIFA 5% for 6 month coupon is, they have given you 5.074. This data will be given in the question, don't worry about that. And PVIFA for 5% interest at 6% at 6 month coupon, they have given you, try to understand, this is PVIF, present value interest rate factor, and present value interest rate factor annuity. So these are two different. So they have given you 0.746. Now this data is available. So what we will do to calculate so we will calculate separately. Let's calculate the present value of coupon. How do we do that? So multiply this 60 rupees with 5.0746. Okay. So with the PVIFA, how much you will get? So you will get 304.48. 304.48. So this is the PV value of the coupon. And what is the PV value of the principal? What is the PV value of the principal? So that is nothing but 1,000 rupees multiplied by 0.746, which is nothing but 746 rupees. So the total value of the bond, total value will be the sum of these two, which is 304.48 plus 746. And if we add both of them, we will get 1050.48. Right? If you go through the option, so nearest option is option number B, and yes, it is the correct answer. So friends, remember, let's summarize what we learned from this question. You know that bond pay rupees 60 every 6 months for 3 years. What we do, we discount those cash flow using the required return. And what is the required return? Required return is 5% per period. We add the present value of all the coupon payment and we add the present value of the face value. And we use this PVIFA and use this PVIF from the standard table. There is a standard table and in the examination they provide you the data. And remember, if the coupon rate is larger than the required rate, so bond always trade above par. And you can see bond is trading at 1050 rupees. So remember, if the coupon is more than the required rate, the bond price goes above rupees 10,000, right? So friends, I hope this concept is clear now. Now friends, if you really think that this video is adding values to your preparation, please hit that like button. This will encourage me to make more such and such content, right? Now friends, have a look at the next question. The next question that we have is related to Mr. Raj. Mr. Raj is a corporate treasurer. He is managing a 10 crore floating rate loan, right, which is linked to 6-month LIBOR. He is concerned that interest rate may rise above 7%, which could increase his interest expense significantly, right? So he feared that interest rate may rise above 7%. So what he did, he buy a interest rate, cap with a strike rate of 7%. One of its settlement period so LIBOR at one of the settlement period, so the LIBOR at 8.5%. Okay. Now as you can see, one of the settlement period, so the LIBOR at 8.5%. Now the question is, what is the main purpose of the Mr. Raj buying an interest rate cap? Option A, to benefit from falling interest rate. Option B, to protect against interest rate falling below 7%. Option C, to reduce loan principal. Option D, to hedge against the rising interest rate above 7%. This is a very good question. Now the question is, what is the meaning of this interest rate cap? See, this is like, insurance policy. This is like, insurance policy for whom? This is insurance policy for borrower, right? It set a maximum limit, and that maximum limit we call the strike rate. That maximum limit we call the strike rate on how much interest they have to pay on a floating rate loan. So they set a maximum limit on how much interest they have to pay on the floating rate loan. In this case, as you can see, Mr. Raj, he has 10 crore loan. Mr. Raj has 10 crore loan. It is linked to 6-month LIBOR. It is linked to 6-month LIBOR. And suppose LIBOR rises above 7%. If LIBOR rises above 7%, so the cap kicks in. Cap kicks in, right? Because they have set the cap at how much? They have, as you can see, they have set the cap at 7%. Yes. So if the LIBOR increases 7%, cap will kick in, right? So he will only pay up to 7%, and the difference, suppose the rate as you can see is 8.5%. So what is the difference? 8.5 minus 7%, which is how much? 1.5%. So this 1.5% is paid by the cap seller. This will be paid by the cap seller, right? So that is the point. Now let's go through each and every option. Option A, to benefit from falling interest rate. See, cap don't help with the falling interest rate. See, if the interest rate fall, right, Raj pay lower interest anyway. That is the benefit of a floating rate loan. The cap only have help when the interest rate rise. Option B, to protect against interest rate falling below 7%. This is again wrong. That sound more like a floor, not a cap. Cap help when the rate go above a certain level. Floor help protect the minimum interest income, which is not the case here. To reduce loan principal. Again, it is completely incorrect. Interest rate cap has nothing to do with principal. They only manage the interest payment risk. Option D say to hedge against rising interest rate above 7%. Yes, this is the perfect. That is exactly why Raj bought the cap. He is afraid that LIBOR will go above 7%, which means higher interest outflow. So the cap makes sure that his cost does not rise beyond 7%, no matter what LIBOR does. So let's summarize what we come to know in this particular question. So friends, I told you that we talked about interest rate cap. It is a kind of ceiling. Let's summarize. Interest rate cap is a kind of ceiling on how a high interest rate payment can goes up. In the case of Mr. Raj, you can see he has a floating rate loan. Interest rate move with the LIBOR. He want to avoid paying more than 7%. So he buy a cap at 7%. If the LIBOR go to 8.5%, he still pay only 7% and the cap seller pay the rest. Now the question is, how much Mr. Raj received from the cap in the settlement period when LIBOR rises to 8.5%? Very good question. Right. So friends, let's understand the concept first. When LIBOR rises above the cap rate, and the cap rate is how much? 7%. Right. So Mr. Raj get a payout from the cap seller. Yes, he will get a payout from the cap seller. This compensate him for the extra interest he would otherwise have to pay on his loan. And if you want to calculate the cap payment, this question is most frequently asked. Remember the formula. Just take the notional value, just multiply it by the LIBOR minus the cap rate, just multiply it by days and divide it by 360. Because days to convert into year, we multiply it by 360. Now let's plug in the value. What is the notional value? 10 crore. 10 crore is the notional value. What is the LIBOR rate? So LIBOR rate has risen to 8.5%. What is the cap rate? Cap rate is 7%. So this is nothing but 0.085. This is nothing but 0.07. Now let's apply the formula. So 10 crore, 10 will get 9 rupees as interest, because if you find 9% of 100, you will get 9 rupees. So this is the step number 1, means what the bond give you. So the bond give you rupees 9 as interest. Second thing is how much investor get paid. How much investor get paid. This thing you have to look upon. So you know the bond was bought at rupees. It was purchased as rupees 105. It was not purchased on rupees 100, right? The bond was bought. The bond was bought at rupees 105, right? So this is the point. Now, if we apply the current yield formula, if you remember the current yield formula, right, it is very easy to understand. So basically what you do in the case of finding the current yield or CY, you write the annual coupon in the numerator. Okay. And in the denominator, what you write? You write the purchase price. Annual coupon divided by purchase price multiplied by 100. So what is the annual coupon that you have? So annual coupon is 9 rupees. And what is the purchase price? You bought it at 105, multiply it by 100. So you tell me, 9 is how much percentage of 10.105? So that is nothing but 8.57%. So the correct answer is option number B, right? So even though, try to understand, even though the bond is paying 9 rupees per year, but the return based on what the investor actually paid, which is 105, is only 8.57%. So remember, whenever we find the current yield, we see that at what price the bond was purchased. If we don't see the face value, rather we see the market price of the bond. We compare it with the market price of the bond. That is the crux of this particular question, and we get 8.57%. Now friends, let us go through each and every option. Option A is 9.45%. This would be correct if the interest was higher or the price was lower, obviously, right? Not applicable here. 8.57% is the clear answer. So let me give you one example to make this concept more clear so that you can remember the formula for lifetime. Imagine that you buy a juice bottle. Suppose you buy a juice bottle worth rupees 100. This is the MRP. 100 is the MRP, and you buy the juice bottle, but you pay rupees 105 for it, right? You paid rupees 105. So you still get the same juice. That is 9 rupees coupon. Here juice is the coupon, right? You still get the 9 rupees coupon. But your cost is higher. So your return is bit lower than expected. So you expected obviously 9% return. But since you paid larger, so your return will be 8.57%, which is lower than the expected return. So that is what coupon yield is all about. So what we learned from this question is that, so first of all, you must understand what is coupon. Coupon is the fixed percentage on face value. Coupon is the fixed percentage on face value. This is the first point. Second point we talked about is the current yield. What is the current yield? This is the return. Current yield is the return based on purchase price. Now one more thing. If you buy above face value, right? If you buy above face value, what will happen? your current yield will go down. As you can see, in this case, current yield go down to 8.57% because you buy above face value. And what is the formula for current yield? It is quite simple. In the numerator you write the coupon, in the denominator you write the price you have paid and multiply it by 100. So that is the formula for current yield. And you should ignore any kind of capital gain or capital loss or maturity value. So that is how you calculate the current yield on bond in the simplest way. I hope it is clear now. Now if any question is asked related to current yield, you can easily answer. Now friends, have a look at the second question, which is based on the treasury function. Right, I have also bifurcated the topic name for your easy understanding. You can understand that yes, this topic is super important because questions are most frequently being asked based on them. So the question is, which of the following correctly match the role of front office, middle office, back office in the treasury function? Right, so you can see options are given. Function, you should know the function of all these office: front, middle, back. So what are their function? So have a look at the option. Option number A say front office validate and settle deal, middle office execute transaction, and back office manage funding and liquidity. B say front office handle funding, risk and liquidity management, middle office support deal validation, and back office execute market transaction. C say front office execute and analyze funding, cash and risk, middle office handle reporting and analysis, and back office validate, settle and account for deal. And D say front office handle internal audit, middle office only deal with IT infrastructure, and back office analyze trading pattern and market risk. So these are the options which has been given to you. So now friends, let's break down what each office does using a simple analogy. Okay, I will give you a simple analogy so that you can remember it for the lifetime. So first of all, let's start with the front office. So you can call them as, director. Imagine a movie production. You take the example of a movie production. Okay, so suppose movie is being produced. So director and the actor, they are the front office. So they are the one in the action. Basically they are doing deal. They are doing deals. Okay, they are managing the risk. They are in action. They are doing deal. They are managing risk. They are handling the cash flow. Yes, they are handling the cash flow. So basically what they do, they make the real-time decision. Let me write it down. They make the real-time decision in the market. Who? Front office. Okay, so we are currently producing a movie. Just try to imitate it. Now, after that comes middle office. Now, who are the middle office? Middle office are the analyst and the planner. In the movie production, in terms of movie production, you can think of them analyst and the planner. They are the analyst. They are the planner. So what they do? They monitor the performance. Right? They monitor performance of each and every cast crew. Right? They check the risk. They create report. Yes, risk checking is also their part. Okay. See, here we also managing risk, but here checking the risk. Right? And then creating the report creation they have to do. Also they have to ensure that the deal made by the front office follow the rule. Whatever deal is made in the front office, they should follow the rule. So basically you can think of them as a strategy and control team. And the third team that we have is called back office. So the back office are administration team. You can call them as admin team. So they handle all the paperwork. All kind of paperwork are being handled by the back office. Any kind of confirmation that has to be given, any kind of settlement that has to be done, any kind of accounting work that has to be done, all are handled at the level of back office after the deal are done. Without them, no deal is complete. Now, I hope I have provided you the example, each and every function of each and every office. Now let's go through each and every option. First of all, if you look at the option number A, so it says that front office validate and settle deal. No, this is wrong. Front office does not handle validation and settlement. No, this is not handled by front office. That is the back office job. I told you now. Any kind of paperwork is being handled by the back office. So and obviously middle office execute transaction. No, they don't execute transaction. And back office does not manage liquidity. So this is completely wrong. Okay. Option number B. Yes. In the case of option B, handle funding risk, and it is partially correct. Yes, front office role is partially correct. And back office they are saying execute market transaction. No, that is wrong. Back office never execute market trade. That is a front office job. So option B is also wrong. If you go through option C, yes, this is completely correct, because front office, what they do, they execute and they manage risk and cash, right? That is the role of front office. In the case of middle office, I told you reporting and risk analysis is being done by the middle office, and back office, they confirm and settle the deal. You can see validate, settle and account for the deal. So yes, option number C is completely correct. What about option D? In option D, they say that they handle the internal audit. No, that is wrong. Front office does not do audit. You must remember that middle office is not only IT. It is written that middle office only deal with IT infrastructure. No, it is wrong. And back office does not do any kind of market analysis. That is the middle office territory. Any kind of market analysis is done by the middle office. So let me give you one real life example of it. For example, let's say a bank want to buy foreign currency for a client. So try to understand. Suppose a bank want to buy foreign currency for a client. Okay. So in this case, what will happen is front office FO, what they will do? They will talk to client. They will execute the currency trade. So trading will be executed by the front office. Executing trade. Okay. Now what middle office will do? Middle office will check if the deal is within the bank risk limit. There is a risk limit of the bank. So whether the deal is within the risk limit. And what the back office will do? Back office will confirm the deal. Back office will settle the money. Settlement is done here. And accounting work is done by the back office. So this is the clear bifurcation of the role performed by all these three offices. So what we learn from this discussion is that, the learning is that, whenever you see this word front office, just remember this front office, they are the deal maker. So let me write it down. So FO, they are the deal maker. Okay, they execute the trade execution is done, they manage the risk, okay, and they manage the liquidity also. Then we talk about the middle office. So middle office, they are the controller. They ensure that the risk which is taken are within the limits. So they report, they monitor, and they help maintain check. Okay, that is middle office. And the last is the back office. Back office are the executors. Okay, so they handle confirmation, they handle settlement, and they handle the records. So in one word, if I say, if I just summarize this thing in one word, so you can say FO, they are in action, like in the movie. MO, they are monitoring. M for monitoring, you can think of them like that. And BO, they are the administration, admin. Okay, action, monitoring and admin. Just remember this word and the entire picture will come into in your front. That is how treasury team functioning in the bank or corporate setup. Friends, if you are preparing for CTP examination and if you are looking for a study material for CTP, that is Certified Treasury Professional course, you can install our app JIV and CIV Made Simple. I have created a course in which you can see two folders are there, previous year question. I have added one previous year question part 1. I am adding more and more, and also I have separate folder for theory and MCQ PDF. If you go through this particular folder, you will see module wise content A, B, C, D, E, and inside each module, like you open module A, you will see unit wise content. And suppose you open the unit 1, you will see theory PDF and MCQ PDF. So theory PDF caters to all the important points written in the bullet format. As you can see, every point is written in the bullet format, and MCQs PDF cover the MCQs based on them. So this is a complete course on CTP, and this will help you to get a good marks in the examination of CTP. If you want to enroll in this particular course, what you can do, you can WhatsApp me on this particular number. So I am writing down the number here. So please, you can WhatsApp me and you can get detail how to access this course, or in the description section you can check out the course link. You can directly click on the course link and can access it. So this is the WhatsApp number. You can WhatsApp me on this particular number. Now friends, I hope it is clear. Now let's go to the question number 3, which is based on option risk metric, that is the Greeks. Let's try to understand. Question is, which of the following statement about Greeks in the option trading is correct? Okay. Option A says that Greek represent the different country where options are traded. B says that Greeks are used to determine the final price of option contract. C says Greeks are mathematical measures used to assess different dimension of risk in option position. And D say Greeks refers to currency fluctuation affecting option in European market. So which option do you think is correct? First of all, let's understand what is the meaning of this Greek. Basically, what happened in the case of option trading, Greeks are not people or not countries. Rather, they are just risk indicator. In one word, I will say they are risk indicator. That's it. Okay. So they help the trader understand how sensitive their option is to different factor. Yes. So basically, this is the option. how sensitive their option is to the different factor. Like, what are the factor? Like, price change. This is one factor. Like, time left. This is another factor. Like, interest rate. This is third factor. And market volatility. This is the fourth factor. So basically, these are the factor, and this Greek tell you that how sensitive their option is to different factors. Okay. Now let's go through each and every option. Option A say Greek represent country. No. That is completely incorrect. It might sound fancy, but totally wrong. Greek are not about geography and nationality. It's just a name. Option B says that Greek determine the final price. No, this is wrong. Basically, Greek tell you how much price might change when something else change. Okay. Like if a stock price goes up or down. I told you that these are the factors. So how the price will change, that is what Greek tell you. Option C say they are mathematical measure used to assess the different dimension of risk in option positioning. Yes, that is absolutely correct. Because the Greek help the option trader manage the risk. One word I will say, they help the option trader manage the risk. For example, delta. Have you heard the name of delta? So this delta show how much the option price will move. This delta is a kind of Greek. It shows how much the option price will move if the stock move by 1 rupees. Suppose a stock move by 1 rupees, how much the option price will move. That is what delta tell you, right? And another Greek is theta, right? These are the Greeks, you must know. Delta, theta. So what theta tells you? Theta shows how much value the option lose. How much value the option lose every day as it get closer to expiry. That is theta. Then we have Vega. You know Vega? Vega is another kind of Greek. Vega shows how option price change with volatility. So it shows how option price gets affected with volatility. Vega. Then Gamma. Gamma is another kind of Greeks. They show how delta change. How delta change. And finally we have Rho. Rho means they show sensitivity to interest rate. So basically, and what about option number D? Let's look at option D. It says that Greek refers to currency fluctuation affecting option. No, that is wrong. Because it has nothing to do with European market or European country. So let me give you one example to make it more clear. Let's say you are driving a car. So car is just your option trading. You can treat the car as option trading. You are driving a car. You want to know how fast you are going. So that is your delta. How fast you are going, that is your delta. You want to know how fast your speed is changing. Speed is changing. How fast is your speed changing? So that is your, that is your gamma. Okay. You want to know how much fuel you are burning per hour. So that is your theta. You want to know how the wind affect speed. So wind affecting speed, your Vega. And you want to know how much a change in fuel price would affect your trip cost. So that is your Rho. So basically, these the delta, Rho, Vega, Gamma, Theta, these are like Greeks. They don't drive the car, but tell you how your drive is reacting to different things. So friends, let's summarize the fact. What we come to know from this particular discussion is that Greek. If you talk about the Greek, just remember this point, that Greek are the risk indicator. In one word I will say, Greek are the risk indicator. Okay. And second point is that they help the option trader understand that how time, how price, how volatility, right, how interest rate, they impact their option value. What are the impact of this factor on option value? That is what you can understand with Greek. And the most common Greek are delta, Rho, Gamma. These are the most common Greek. And theta. Okay, Vega. And it is useful for risk management. It is not useful directly. So the next time someone say Greek in option, don't book a trip to Athens. Just think of risk tool for option trading. I hope that makes sense. Now friends, if you really think that this video is adding value to your preparation, please hit the like button. Next question is based on aggregate gap limit in spread. Have a look at it. So friends, question is, what does the aggregate gap limit in spread management primarily refers to? Option A, the maximum difference allowed between a bank asset and liability in a single currency over the day. Option B, the maximum cumulative mismatch in foreign currency position across all tenor, typically capped at a multiple of bank capital. Option C, a limit on the ratio of rate sensitive asset to rate sensitive liability in an interest rate gap analysis. Option D, the regulatory minimum liquidity ratio that bank must maintain based on demand deposit. So let's understand this using a simple scenario. Suppose a bank deal with foreign currency every day, right? Like suppose dollar, euro, and Japanese yen. These are the foreign currency. So basically they buy, they sell, they hold different currency over different time period. The time period may be 1 day, it may be 1 week, it may be 3 months. Okay. But what if the bank buy too much of a currency and does not sell enough? Yes. Suppose bank buy too much currency and does not sell it. What will happen? And or mismatch start building across different tenor. So that is where AGL aggregate gap limit comes into picture. Basically what it does, it control the total currency mismatch. It control currency mismatch. AGL control the currency mismatch and the bank is allowed to take across all tenor. Let's see option number A. The maximum difference allowed between a bank asset and liability in a single currency over a day. So what do you think? Is it correct? It might sound okay, but it is too narrow. AGL is not just for 1 day. You can see over a day. No, it is not just for 1 day. Rather, it includes all the future period. It includes all the future period. I told you 1 day, 1 week, 3 months, etc. etc. Option B say maximum cumulative mismatch in forex position across all tenor. So option A is wrong. Option B say yes, AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. That is what AGL tell. AGL, that aggregate gap limit, tell the bank that you can't have a foreign exchange mismatch beyond a certain limit. And if we talk about this limit is set at 6 times the bank capital. This limit is set at 6 times bank capital. So this AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit. So suppose, let me give you one example to make this concept more clear. Suppose a bank has 1000 crore. A bank has 1000 crore in the capital. Suppose a bank has 1000 crore in the form of capital. So it cannot have FX mismatch. It cannot have FX mismatch beyond 6000 crore. That is the meaning of it. Okay. So that is what this FX mismatch tells you. That AGL tells the bank that you can't have a foreign exchange mismatch beyond a certain limit, and this limit is set at 6 times the bank capital. So suppose bank has 1000 crore in capital, so it cannot have foreign exchange mismatch larger than the 6000 crore. What about, yes, option B is perfectly correct. What about option C? A limit on the ratio of rate sensitive asset to rate sensitive liability in interest rate gap analysis. This is wrong. Basically that is the part of interest rate risk analysis, not FX gap. Here we are dealing with foreign exchange gap. What about option D? The regulatory minimum liquidity ratio that bank must maintain based on demand deposit. Again this is wrong, because this is about liquidity management like SLR, CRR, not foreign exchange. Let me give you one example to make it more clear. So you can think of water tank, right? Water tank. So this is your FX portfolio. Your water tank is your FX portfolio. Okay. Now with multiple pipe. Suppose there are multiple pipes, and you can think of this pipe as time bucket. So this pipe are time bucket. So bringing in and taking out water. So the water you can think of like currency. So water tank, FX portfolio, foreign exchange portfolio, multiple pipes means time bucket, and water is currency. Now suppose more water comes in. Suppose more water comes in than goes out across multiple pipe. So tank of overflow. So that overflow is your foreign exchange mismatch. Suppose more water is coming in and less water is going out. And so what will happen? So obviously the tank will overflow, and that overflow is called foreign exchange mismatch. Okay. So this AGL, that is aggregate gap limit, is just like, you can think of this AGL as the height limit. You can think of them height limit. This height limit on how much extra water. Try to understand, very very important and easy to understand example I am taking you. So this height limit is tell you how much extra water. Extra water means mismatch. How much mismatch is allowed in total across all pipe. how much extra water is allowed, that is what AGL tells you. Okay, so what we learned from this discussion is that, let us summarize the fact. I told you that AGL is the total allowed currency mismatch. Just remember, total allowed currency mismatch. Okay, in foreign exchange across all time bucket. And I told you it is capped by RBI at 6 times total capital. Remember, it is capped by RBI at 6 times total capital. This is the second point. And I told you this help in managing the foreign exchange risk. Foreign exchange risk management, it help in managing, right, over the time, not just daily. Remember, it is done over the time, not daily. And it is used in treasury to prevent excessive foreign exchange exposure. So remember, AGL is your foreign exchange risk boundary. If the bank cross this boundary, it is like playing cricket without boundary rope. High risk and no control. I hope that makes sense to you. I have explained each and every option in the lucid manner. Now friends, have a look at the next question. So before solving this ATM ITM, let us move to the next question, that is based on NDTL. Yes, first of all solve this question. So this question is based on calculating the NDTL. A bank has the following figure in crore: demand liability, time liability, other demand and time liability, liability to other asset with the banking system. What is this NDTL? So let's understand this step by step. First of all, what is this NDTL? Net demand and time liability. Basically, it tells us how much money the bank has taken in from the public. How much money the bank has taken from public plus public and other after removing what it hold with other banks. Removing it holding with other bank. Okay, so how much money the bank has taken from the public and other after removing what it hold with the other bank. It is very important number, right? This NDTL is very important number, because using NDTL only you can calculate the CRR, you can calculate the SLR, you can calculate the liquidity as an LAF. So let's understand the step by step. What is the formula for NDTL? So NDTL, the demand liability plus time liability plus other liability and time liability plus liability to other, right, minus asset with the banking system. This is the formula for NDTL. So what is the demand liability? We have 1500. What is time liability? 3000. What is other demand and time liability? 500. What is liability to other? 1000. And what is the asset with the banking system? 700. If you calculate it, this will give you 6000 minus 700, or we can call it 5300 crore. Right? 5300 crore is the correct answer. Option number A is the correct answer. Right? So imagine, so let me give you one example to make it more clear. Suppose a bank is there. It collect 6000 crore in various deposit. It collects 6000 crore in all types of deposit, demand liability, time liability, other liability. But 700 crore is what? 700 crore is just lying with other bank. It is just lying with other bank, this 700 crore, not with the customer. So in reality, the bank net liability to the public is just only how much? 5300 crore, not 6000 crore. That is what NDTL shows, the true liability after removing internal banking asset. Okay, that is what NDTL. That's why we subtract asset with the banking system. So what we learned from this discussion is that whenever you are asked to calculate NDTL, just remember all external liability, because these deposits are the kind of liability for the bank, because it has to pay interest on that. That's why it is liability. So you add all external liability and you subtract the asset with banking system. Then this will give you NDTL. And this is quite useful technique for calculating CRR, SLR, LAF, liquidity, etc. And bank on deposit with other bank are excluded. I told you. Suppose there is a bank deposit with other banks, they are excluded. And this concept is very much important in monetary policy and regulatory compliance. So remember, whenever you see this NDTL in a banking system, remember, it is what the bank owes to the outside world after removing its own money parked with the other bank. I hope you have mastered the concept of NDTL using this explanation. Now friends, let's switch our focus to the swaption. What is swaption? So swaption, or question is, which of the following statement about swaption is correct? Option A. Swaption is a standardized exchange traded derivative, or we call it ETD. contract similar to equity option. Option B, a payer swaption give the holder the right to receive a fixed rate and pay a floating rate. Option C, a receiver swaption allow the buyer to pay a fixed rate and receive a floating rate. Option D, a swaption is an over-the-counter option that give the buyer the right but not the obligation to enter into swap agreement. So friends, let's first understand what swaption is. So if we talk about the swaption, it is combination of two words, swap plus option. Right, swap plus option. It means basically what you are doing, you are buying an option. So why it is a combination of two words, swap and option. So let us understand what this swap and option is. So swap means you are buying an option. You are buying an option to enter into swap later. You will enter into swap later, right? And for that you are buying option. Is it clear? So you are buying option to enter into swap later, but only if you want to. There is no obligation. You have the right. You can enter into swap later. There is no obligation. You can think of it like, booking a movie ticket with a cancel anytime option. Suppose you are booking a movie ticket and you have the option to cancel it anytime. Okay. So, but you pay a little extra. That is the premium. Yes, you have paid a little extra. That is the premium. But if you don't want to watch the movie later, you are not forced to do. Similarly, with swaption, the buyer pay a premium to get the right, but not the obligation to enter into interest rate swap in the future. Because this is the characteristics of option. Option means you have the right but not the obligation. Okay, and you are paying for that a premium amount that you can enter into interest rate swap in the future. Because basically swap means IRS swap. Now let's go through each and every option. I think I have provided you sufficient information you can easily answer it. Option A say that swaption is a standardized ETD contract similar to equity option. No. This is wrong. They are not traded on stock exchange. They are basically OTC. They are OTC, over the counter, which means can receive floating. So basically it is also wrong. Why it is wrong? Because receiver swaption gives the right to receive fixed and play floating. What about option D? Basically, swaption is an OTC option. OTC option means, it gives the right, not the obligation to enter a swap. This is the perfectly correct option. So basically, if we talk about, swaption, it is just like, privately agreed OTC option. Privately agreed OTC option to enter a swap. It is a privately agreed over the counter option to enter a swap. Okay. Where the buyer has full control to say yes or no on the swap start date. So let us give you an example to make it more clear. Let's say you are a company expecting interest rate to rise in next 3 months. Okay, you are expecting that interest rate will rise in the next 3 months. You are not sure yet, but you want to be ready. So what you do? Okay, you are not sure, but you want to be ready. So what you do? You will buy a payer swaption. You will buy a payer swaption. What will happen? Means you are paying a small premium today. Obviously, premium has to be paid. You are paying a premium that gives you the right to lock in the fixed rate later. If the rate goes up, you will exercise the option and protect yourself. And if the rate stays low, you will let it expire, no pressure. Right? That is a swaption. So let's summarize key point about swaption. What we have learned? Swaption is the option to enter into swap later. Swaption is the option that we can enter into swap later. So what happened? That buyer pays premium for the flexibility. Premium has to be paid. It is a kind of, OTC contract. It is a kind of OTC contract. They are not traded on exchange. And two types of swaption I told you. Payer swaption. Payer swaption means you pay fixed. You pay fixed and you receive floating. You pay fixed and you receive floating. And the second kind of swaption is, receiver swaption. So receiver swaption means you receive fixed and pay floating. Okay. So you can choose whether or not to enter the swap. So just remember, a swaption gives you the power to choose, not the obligation to act. It is a perfect tool for managing interest rate risk with flexibility. I hope that is clear to you. What is everything about swaption? Every aspect we have discussed regarding the swaption. Now, have a look at the next question. What best describe novation in the context of loan transfer? Novation, yes.
So option A, it is a partial transfer of a loan where only the right, not obligation, are assigned to a third party. Option B, it refers to securitizing a loan by pooling it with other loan and issuing security. Option C, it involves the cancellation of the original agreement and substitution with the new one between the borrower and the new lender. Option D, it is a method by which the loan originator sells the loan without informing the borrower. So let's understand what novation means in very basic way. Basically, novation simply means, old agreement cancelled. Old agreement is cancelled and new agreement created. Old agreement cancelled, new one created between the borrower and lender. So old agreement cancelled, new created between borrower and the lender. So basically what happened, that the original lender step out of the deal completely and the new lender steps in with the borrower full knowledge and consent. It is like saying, hey borrower, I am not your lender anymore. Here is your new lender and you both will now sign a new agreement. So let's go through each and every option. Option A says that it is a partial transfer where only rights are assigned. What do you think about it? No, this is wrong. This is wrong. Why? Because this is a kind of assignment. This is a kind of, not novation, rather this is a kind of assignment, not novation. In assignment, what happened? The new party only get benefit. In assignment, the new party only get benefit, not responsibilities. Okay, that is, okay, so this is the kind of assignment, not novation. What about option B? This is another thing wrong, because this process is called, securitization. This is called securitization. That is completely different concept. It involves packaging loan and selling them as security. What about option C? Cancellation of the original agreement and signing new one. Yes, this is exactly right. This is what we call as novation. So basically what happened? The old is cancelled and the new is signed. Right? And the borrower agreed to this. This is what novation is all about. What about option D? Selling loan without informing borrower. So that may happen in the case of assignment. That may happen in the case of assignment, but not in novation. In novation, borrower consent is very much necessary. Okay, you can't, here is you can see the word without informing the borrower. This is completely wrong. You have to inform the borrower. Borrower consent is required. So let me give you one example to make it more clear. Imagine there is a bank A from which you took the loan. So from bank A you take the loan. After some time, this bank A want to exit and they want to introduce bank B, right, as your new lender. So bank A will cancel the old agreement and you now sign a fresh agreement with bank B with the same loan term or new one. So this is what we call novation. Okay. So this is a kind of clean handover with full agreement from all sides. So what we learned from this discussion is that, just let me summarize, novation, whenever you see this word, this is a kind of new contract. This is a kind of new contract with new lender. We have a new contract with new lender. Okay. And original agreement is cancelled. Original agreement, what do we do? We cancel it. Okay. And what happened? Right plus obligation. Both right and obligation, they are transferred. Remember, right is also transferred, obligation is also transferred. And here, borrower consent is required. Borrower consent is needed. Okay. And it is opposite of assignment. This novation is, opposite of assignment. What happened in the case of assignment, where benefits are only transferred and original contract remain the same. So basically you can see that is a peculiarity of our session. We don't just discuss one question. We discuss multiple concepts related to that question, so that if any question appears in the upcoming examination, you can easily answer it. Right? And if you want such kind of video, such kind of PDF, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. Now friends, look at the last question of today's session. Which of the following statement about forward rate agreement is correct? FRA is correct. Option A. And FRA is a stock trading contract executed on a stock exchange. FRA is a contract to buy or sell foreign exchange at future date at a fixed date. Option C. An FRA is the over-the-counter contract where parties agree today on an interest rate to be paid in the future. Option D. FRA allow party to exchange fixed interest payment for floating payment over the life of the loan. So these are the four options. Now let's understand what FRA in the simplest way possible. FRA is called forward rate agreement. It is like, it is like a deal that you make today, right, to lock in interest rate for a loan or deposit that start in the future.
So basically what you do, you lock in the interest rate, right? For the loan or deposit that will start in the future. It's like saying, let's fix the interest rate now. I don't have to worry about the future changes. Now what is option A? So it is wrong. It is a stock trading contract executed on a stock exchange. This is wrong because FRA has nothing to do with, stock or exchange. It is an interest rate product. Remember, FRA is nothing, it has nothing to do with stock. It is a kind of interest rate product. Okay, what about option B? Is a contract to buy or sell foreign exchange at future date at fixed rate? No, this is forward FX contract, forward exchange contract, foreign exchange contract, right? Not a FRA. FRA deal with interest rate, not currency. Here the point is currency. Option C. It is an over the counter contract where party agree today on interest rate. Yes, this is the correct. It is a kind of private contract, OTC contract, where the two party agree today what the interest rate will be for a loan or deposit that is start in the future, customizable one. Option C is the correct one. Option D, it allows party to exchange fixed interest payment. That is wrong. That describes the IRS, interest rate swap, not FRA. Let me give you a real world example. Imagine you are a company that need to borrow 10 crore rupees after 3 months. So you need to borrow 10 crore rupees after 3 months. Okay. You are worried that interest rate might goes up by then. So what you do to protect yourself, you enter into FRA today. So you enter into FRA today and fix the rate at 6% for that future borrowing. Now even if the actual market rate becomes 7%, what will happen? The FRA ensure that you effectively pay 6% only, saving your interest cost. So what we learned is that FRA, so let's summarize the key point which we have just discussed now about FRA. So first point is that FRA, FRA is a kind of OTC product. Okay, it fixed the future interest rate. It is used for hedging. It is used for hedging and speculation. And underlying thing is the interest rate here. It is commonly used to lock a loan deposit rate in advance. Friends, we have several more questions available here as you can see. If you want me to explain all the remaining question, you can write yes in the comment section. I will understand that yes, you are interested in the remaining question. Now let's end our video with clear summarization of all the concepts which we have learned today. So the first concept I told you about, coupon. What is the coupon? Coupon means it is giving you fixed percentage on the face value. And this coupon yield is a kind of return. How do we find the coupon yield? What you will do? You will write coupon in the numerator, you write price that you have actually paid in the denominator and multiply it by 100 to get in percentage. So that will give you coupon yield. And remember, if you are buying larger than coupon, if your buying price is larger than the face value, your coupon yield will decrease. Okay, these are the 4 points which we have discussed. Now in the next question, what we discuss about front office, middle office and back office. I told you that this front office are the action. They are the deal maker. They trade, they manage the risk and manage liquidity. Middle office, you can think of them like monitoring. They are the controller. They report, they monitor and they maintain the risk. And then we have the back office. They are like administration. They execute, they confirm, they settle, they record. So remember, these are the key functions of these three office. Questions are most frequently asked. In the next question, we discuss about Greeks. I told you, Greek is a kind of risk indicator. There are several factors which determine the option value like time, price, volatility, interest rate. So all of these factors determine the option value. Delta, rho, gamma, theta, vega. These are, different kinds of Greeks. Then we talk about AGL, aggregate gap limit. So what does AGL show? AGL shows the total allowed currency mismatch. And RBI fixed the AGL at 6 times the total capital and affects foreign exchange risk management over the time. It helps in foreign exchange risk management over the time. So remember, total allowed currency